Come.
Hey, welcome to the big show. The big show, guys. Everyone, thank you for joining Grizzle Commodity One-on-One. It's the biggest event of the year and arguably the biggest resource conference, full stop. We got a killer lineup. Scott's going to hit us with that. But first, I got to say, listen, guys, this if you're seeing this, you know what Grizzle does. We took us a lot of work to put this together. Please hit that retweet, the like. You know what to do, the love. And if you are
Get that word out.
Exactly. If you are on YouTube, if you haven't already, please do subscribe to the YouTube channel. We put a ton of great commodity research, and also hit that like. Let people know what's going on. Scott, tell them.
Oh, man, we got a stacked lineup today. 18 speakers spread throughout the day. We're going to be going deep into the afternoon. This is a place you need to come. Everything commodities. We got oil, gas, copper, uranium. The list goes on. Insights off the hook as only Grizzle can do. So get ready for a big day. It's going to be fun.
Guys, this is it's the crown jewel of Grizzle. Grizzle Commodity One-on-One. Thank you for joining. It would not be possible without our lead partners.
We got to give a little shout out here.
Let's talk about it. None other than the Green Chicken, the #1 Substack in finance. That is Doomberg. And then Sprott, the king of physical commodity investing. Goehring and Rozencwajg, the original contrarian resource investors. Hilltower Resource Advisors, a boutique natural resources research firm.
And then we got Largo, a leader in vanadium, a metal critical to the energy transition. And then we have Canada Nickel, developing the next generation of low-carbon nickel. Dolly Varden Silver, a precious metals leader in BC's prolific Golden Triangle. Amerigo Resources, your copper leverage play with a compelling dividend yield.
Anfield Energy, a uranium leader in the U.S. nuclear renaissance. Grid Metals, Canada's next great lithium producer. Cerrado Gold, a low-cost producer with multi-million ounce potential. And Summa Silver, American silver. There is no substitute. And finally, Grizzle Research and Quant, your source for commodity insights and stock ideas. Guys, let's hit it.
Let's do it, baby.
Grizzle Commodity Con, we got the one, the only, Doomberg.
All right, everyone, he's become a legend in the commodities space. Some call him the rooster of Arbob, the fowl of fossil fuels, and my favorite, El Pollo in situ. But whatever you call him, you can't host a commodity conference without the green chicken, so we're very happy to have Doomberg back in the house. Welcome, Doomberg.
Guys, that's got to be the best introduction I've ever had. Thanks for having me back. You guys always put on.
You deserve it, my friend.
You put on a fantastic show, and what a privilege. You know, it always cracks me up when I see the advertisement for these, and there's all these serious organizations, and then there's the green chicken right on the same flyer, and it always gives us a good chuckle here in the chicken coop. So looking forward to a great discussion.
Well, you know what, Doomberg, I like the best on that flyer? It's like literally everyone's logos are pretty like, corporate state, and then you got this one green chicken, so they're all kind of black and white. They got this one glowing green chicken on the flyer. It's fantastic.
The future of logos.
It validates our marketing decision that, you can't be remembered if you don't stand out, and the green chicken stands out on that flyer for sure. So.
Boy, does it. Doomberg, we obviously could go on for hours. It's Grizzle Commodity Con. It's our flagship. You put out great work all the time. Yesterday, you dropped a great piece looking at natural gas, the glut of it in North America, specifically the U.S. Could you talk about just, what we're looking at here? The differentials within the country. How can we get it out? Just, coal. There's a lot of topics you touched on there. Great piece. Maybe you could give us a little synopsis.
You bet. The piece we published yesterday, as you mentioned, was called Guilt by Association, which sort of a play on words. As the world and OPEC Plus sort of tangles with the U.S. and the West over oil production and supply and cutting back supply to support prices, there's a second-order effect that's playing out in the U.S., which is elevated oil prices, increases drilling, especially in the Permian Basin. But in the Permian Basin, there's an awful lot of associated gas that comes with that oil. And frankly, there's no place to put it. And so what we're seeing within the U.S. is highly regionalized markets that are dislocated because of a lack of pipelines. So you can't really put the stuff anywhere. It's being produced in Texas. We're trying to export it as fast as we can, which is probably not the best use of our domestic bounty of natural gas, but nonetheless, it's better than flaring it or venting it, which is occurring at scale right now. And then there are other parts of the country, like California and New England, that have steadfastly and stubbornly refused to build out the necessary pipeline infrastructure needed to take advantage of this bounty of relatively clean fossil fuels, compared to coal and oil. Natural gas burns much cleaner and provides the opportunity for carbon capture using much simpler technology. But all fossil fuels are equally bad in the eyes of environmental Malthusians. And so California finds itself in a state where in December they were paying $55 per million BTU of natural gas. And today natural gas is selling for $1 per million BTU at the Waha pipeline wellhead there in Texas. And so you have the situation where we have so much gas we don't know what to do with it in some parts of the country. And then we have sticker shock of increasing energy bills in New England and in California. And, how insane is that? And then the rest of the piece we could talk about, we talked about how we could be displacing our coal use with that piece. We talked about how we could be rebuilding a solar supply chain, as long as we're going to be spending hundreds of billions of dollars on renewable energy. The upfront energy investments that go into that should be done domestically. Instead, we do it with China. And so, just highlighting the absurdities of the piece. The absurdities of our energy policy in that piece, sort of a classic Doomberg special, as we said before we hit publish, right down the middle, red meat for our readers.
For those who haven't had a chance to see, we did a fantastic episode with the one, the only Doomberg on the energy density ladder, and I think this really just hits on that. Doomberg, it just, I think back to that, the piece that we did, and you wrote about it extensively in the Substack, in your Substack. Could you just talk about that energy density ladder and, how are we kind of just stuck here? It just feels like there's just clear moves we can move up the rung. Obviously, in that piece, we talked about the ultimate prize, which is obviously nuclear, but just how can we be trapped in such a situation where, we continue to use, we're clearly getting cheap MMBTUs. It should be a no-brainer, but, you're stuck in this feedback loop with, we're still burning a lot of coal.
Yeah, and the energy density ladder here in this case is, coal is near the ground, and the next leg up would be oil, and then at the top of the hydrocarbon energy density ladder would be natural gas, as measured by the tons of CO2 emitted per BTU of useful heat that you can extract from it. It's even worse when you compare coal to natural gas, of course, because coal comes with all manner of nasties that end up going into the atmosphere if the pollution controls aren't as tight as one might like. Whereas natural gas burns so clean, we do it in many of our kitchens. With only the minimum amount of ventilation, because and we always like to say, if you want to compare coal to natural gas, you wouldn't barbecue indoors.
Right, that's a great one actually.
But many people have natural gas powered stovetops, and they only turn the ventilation on when they're cooking with olive oil and grease is splattering and whatever. So in the piece we did some math. And we looked at the Energy Information Administration's short-term energy outlook for 2023, and they estimate we're going to burn something like 440 million short tons of coal. And by our math, that equates to roughly 23 BCFs per day of natural gas. And we're fixing to export about 20 BCFs per day of natural gas. And so to a rough approximation, if we stopped exporting natural gas and we displaced all of our coal burning, we could radically reduce our carbon emissions. Now, of course, there's practicalities, there's limits, where we burn coal versus whether we have pipelines of natural gas there. But in general, at the high level, such sort of back-of-the-envelope comparisons illustrate the absurdities of our policy. And it's just such a shame. And in fact, in the piece we talked about sort of the craziest of them all is we allowed China to illegally create a monopoly in the solar space. The production of polysilicon is at the front end of that supply chain. The production of polysilicon is among the most energy-intense industrial manufacturing processes known to humankind, and China makes basically 90+% of it, and they import all their energy to do that, either cheap dirty coal or liquefied natural gas. And so you have this situation where we are dumping LNG onto the international market. China is participating in that market, whether the molecules they buy come from us or bought by from other countries like Qatar or Australia. But regardless, once it all goes on to the carriers, it becomes part of that international LNG energy market. And then we round trip that energy through Chinese factories that leverage slave labor, if you're going to believe the U.S. State Department, and we do. And then we get our energy-dense solar panels back from China and feel great about ourselves and pat ourselves on the back for being green. And it's just so crazy. Like, we have this enormous bounty. And if you listen to, the CEO of EQT was on Alex Epstein's podcast, Toby Rice, I believe his name is. And he's saying, at $4 per million BTU, we have essentially a limitless supply of natural gas. And yet we have this glut of natural gas that we can't get rid of because we don't have the necessary pipelines. And so natural gas is trading between $1 and $2, in the regions where we make a lot of it. And then New England is still importing LNG from Trinidad and Tobago. And California is paying, $8, $9 per million BTU natural gas when Henry Hub is at $2. It's just so absurd. But, as we like to say, the persistence of such absurdities is profoundly bullish for Doomberg. And so at least we have that.
Look on the bright side. Now, Doomberg, while we're talking about gas, I wanted to move a little bit over the pond to Europe. We had all these, the talk that they were going to run out of energy. The weather bailed them out this time. But it seems like they continue to double and triple down on renewables at the expense of the baseload power. I'm wondering if you have an opinion on what's going to come this fall once it starts getting a little colder. Is the media going to be copy-pasting articles from last August, this August? Like, what do you think are the chances that they run into some issues this coming winter?
And I'll add one thing too, Doomberg. The premature victory laps, which I found quite hilarious. That the fact, obviously, crisis was averted this time, but the fact that people are throwing up their feet on the chair and saying, "Job done."
Well, one of the things we've been cautioning is that it is important that leaders in Europe don't take all the wrong lessons from their good fortune.
Yeah.
And by the way, we're the first to cheer that Europe had a mild winter and obscene crisis was avoided. Now, the same people who are sort of spiking the football on, hey, this was all alarmism, fail to realize that Germany wasted $500 billion acquiring every BTU of energy it could get its hands on, regardless of cost, carbon footprint, or impact on the developing world. All three of those were profound. Germany retreated to the coal mines with the speed and efficiency of the evacuation of Dunkirk in World War II. And they brought back 16 gigawatts of coal. This is all in the name of being green. And this very week, as your conference is going on, of course, the final 3 nuclear reactors in Germany are being shut down, which is like the craziest policy in the world, and evidence that, in fact, the leaders in Europe are confusing good fortune with good strategy. We, for the record, hope to see another mild winter next year. And then if they get through next winter, then the sort of wave of LNG import and export facilities that are being constructed will come online, and hopefully we'll see a more efficient natural gas market globally, and Europe will have alternatives to its dependency on Russia that will be fully plugged in. We are not, for the record, and we weren't last year, sitting around hoping for travesty and chaos so that we could be, quote, validated for the predictions. We were trying to warn people while simultaneously saying we hope that we, I said, I believe on your show, our best case scenario is we come back on in a year and people accuse us of being alarmist. For the record, we have thousands of subscribers in Europe, and every one of them is precious, and we wish no ill will on anybody. But there's no question that the whims of Gaia smiled in Europe's favor. It was a historically mild winter. It's a historically mild winter. It's historically mild right now in many parts of the U.S., which is part of the reason why we have this glut of natural gas. And so, good, but let's not confuse luck with strategy. And based on the German insistence on shutting down their last 3 nuclear plants this very week, we fear that if we probably had a 4 or 5 sigma winter to the warm side, if we have a 2 or a 3 sigma winter to the cold side next year, what's the plan? I guess the plan is to keep burning coal. It's absurd on so many levels, but it is what it is, and this is the nature of Twitter and trolls and all of that stuff, and it's fine. It's
the beauty of Twitter.
Well, and we look to Doomberg for strategy and just how the big picture and just this idea that you get through this challenging year unscathed, and to shut down the nuclear plants just to me seems. There's a hopeless element that I see, and I'm just like, it just can't be. Like, is the ruling class just this clueless, or are we just so stuck in this dogma of whatever this, this virtue signaling. I'm just so confused on how this can be after you've come so close to, getting scathed.
Yeah, so I would say the scandal of nuclear and its fate in Germany is one that will be uncovered. And I suspect that when the true details of the motivations and the funding and who was behind it eventually become public, it's probably going to shock people. That's about as much as I'd be comfortable saying in an open forum. But we all have our suspicions. And if you just think about who benefits from this insanity, then that's a pretty reasonable place to start for looking for the origins of this, the genesis of this insanity. Now, again, one of the challenges is you can't really shock people into change without a huge amount of pain, but who's going to sit around hoping for a huge amount of pain? Certainly not us. But if there were to be a crisis this winter, we suspect that the existing fleet of nuclear reactors have not been sort of deconstructed to the point of irreversibility. And with enough pain and political upheaval, you could get new leadership in place that might undo some of these damaging decisions, one hopes. We don't have the technical expertise at that level of detail, but I suspect that the Germans aren't that stupid. And the manner in which they preserve their coal plants indicates that, with the right political change, perhaps, some of this could at least be reversed in the future. For example, if they didn't have those 3 reactors, this winter would have been really, really tough. And what did? They took those 3 reactors down. It's so crazy.
So,
I don't get it.
Just on that point, have we done an that's a great point. It would be great to just a visualization. Here's the attribution. Without these 3 plants, this is how this winter would have turned out. Irrespective, it may not put it on over the edge, but it would have significantly put the whole system under more strain. Someone needs to put that in a visualized form.
Yeah, that's we might do that for a future piece. For many weeks in the doldrums, nuclear was far outproducing both solar and wind combined onto the German grid. And so if you didn't have nuclear and then you hit the doldrums and you don't have enough coal to turn back on, then you have chaos. Our fear is that the German and Western European leaders, like the Belgians, are taking all of the wrong lessons from their good fortune. And it looks like that's going to be the case. So it's rather unfortunate, but it is what it is. So we'll have to observe. And other countries, to be fair and to be clear, are going in the exact opposite direction of Germany. Nuclear plants are being saved. New reactors are being turned on. Japan, even the United States. The future is bright for nuclear. And let's hope that the future isn't blight for the Germans.
Now, Doomberg, we try to help our readers stay ahead of what comes next and be prepared to think about it. As you look at next winter, if it does become a tougher environment, what are the ramp up their energy imports, and Russian pipelines were still basically completely out of the game? Are there things they can do in the coming winter?
So if peace broke out between Russia and Ukraine and the West and NATO, there is still some operability in the Nord Stream pipeline system. That could probably be turned on. Of course, the politics of that would be pretty tough to see that happening this winter. There is ever-increasing supply of LNG, but also I think the relief valve would be that they would continue to deindustrialize. They will prioritize their citizens over industry, and chemical sector and other energy-intense supply chains are already in sort of massive deceleration mode in Germany. Just look at BASF and what's going on with Ludwigshafen, which we wrote about long before it became sort of front-page news. Very predictable outcome of this. And so, again, another, wow, we made it through the winter. Well, define made it through. You spent, again, $500 billion or €500 billion, I should say. You robbed the developing world of much-needed energy. You were burning coal at an epic pace. And wind and solar underperform. The capacity factor for solar in Germany is 11%. It's crazy. And yet, the answer is always, well, the reason why our policy isn't working is because we haven't done enough of it. So I guess we'll see. But the relief valve will be industry first. They will not, and ultimately you'll end up with, not much more than a service economy, which is a shame, of course, because the German manufacturing sector, as we've written about, is just truly amazing, and the loss of it, even temporary, would be disastrous. And so when people say, "Oh, what made it through the winter?" you have to define what that means.
That's great.
Doomberg, on that attribution, on that piece, I'd love to, maybe throwing a suggestion, I'd love to see, if how the nuclear plants contributed in a positive way, but then also looking at how much the reduction of German industrial capacity also contributed to getting through that, getting through the winter. I think there just needs to be a visualization that just shows, on the positive side of the ledger, how nuclear, was a help, and how much it hurt industry as well.
Yeah, no, that's great genesis for a future piece. We're writing about the Twitter Substack fiasco next, but
you know what? Obviously, it is Commodity Con, but we've been missed not to talk about this. I'd love to. Doomberg, you've elevated the dialogue since the green chicken arrived on Twitter. It's been incredible in terms of insights. Your Twitter feed has provided, but that obviously is it's a funnel to where we get your deeper insights, the long form, the Substack. The chaos that ensued this past weekend, I'm just like, what? As a content creator, I'm just like so disillusioned with just with what happened. Please give me your thoughts on where we go from here.
Yeah, look, I mean, for commodity investors and analysts and researchers, Twitter has been and continues to be an invaluable resource. We grew up on Twitter, as you know. We built Doomberg across two tracks, Twitter sort of as our front end and Substack as our business. And historically, Substack isn't a place where people start. It's a place where people end up. And this is what we coach other people who are either writing Substacks or thinking about doing one, which is you can't just write great stuff and expect people to show up. You have to entice them. And Twitter, as the sort of public town hall online, is the place where you could differentiate yourself. Twitter has all kinds of warts, and the manner in which you use Twitter is really important. We have a very firm rule. If we would never write about it, we don't tweet about it. And that keeps us clean on all of the sort of red button issues of the day that we don't want to get involved in. So you'll never see us writing about the social issues or abortion or politics in general, outside of maybe ripping on Justin Trudeau. But broadly, but we wrote about Justin Trudeau, so that passed our rule. Twitter has gone through a period of chaos, regardless of your views of Elon Musk. It's undeniable that the platform is in a period of chaos. One of the main points we're going to make in the piece is that, if Elon wasn't the CEO, most people would say that Twitter is insolvent right now, given its debt load and its interest payments. And you have this very risky situation where the equity owners, which should really be wiped out, are still running the company, which means they have a radically different risk profile than the other stakeholders involved in the company. They have a YOLO bet. Like right now, if you're staring at a donut on your equity, you do whatever it takes to take a chance where in some scenario it might not be a zero.
What do you have to lose?
Right, you have to lose. YOLO, you only lose once. And so, but of course, Elon is Elon, and the equity value isn't quite zero. It's probably got a substantial optionality, given the volatility. The call option on him perhaps pulling something out of the bag is not zero, but at the same time, it's very risky, and it gives content creators for whom their livelihoods depend on Twitter pause. Enter Substack, who we're very loyal to, and in full disclosure, obviously we have a great business on Substack. We know the team very well, and we'll be likely an investor in their latest round where they crowdsourced writers to participate, and we would happily participate in size. We're in discussions right now with Substack leadership to do that, so of course we're not biased, but the prospect of a vertically integrated content creator ecosystem where people can find you within the Substack ecosystem and very quickly subscribe to you via email and then ultimately hopefully become a paid subscriber, that's very lucrative. And if you could do it all under one shop, it's very interesting. So our view is we're going to stay on Twitter, but we're a very small team, and we're not going to expand our team to participate as much as we were on Twitter while also replicating that on Notes. So in the weeks and months ahead, we're going to be spending 80-20 on Notes versus Twitter and see where it goes. And our hope is that Notes becomes a Twitter without the trolls. All of these types of social media platforms start out very good, and then the bots and the trolls come in and try to ruin it. So we'll see. There's a lot of challenges with Notes. We've given the team a lot of blunt feedback on what we think needs to be improved.
Oh, great. Thank you.
Yeah, they've mostly listened. We've been in the beta from the beginning, of course, given our prominent role on Substack. And the team has listened. I personally spent probably about 90 minutes giving very direct feedback on what needs to happen for that to be successful. We hope it's successful. We also hope Twitter succeeds, to be honest with you. Like, we're not, Twitter's great. Twitter's terrible. and Twitter's great. We've met many brilliant people. We have so many commodity experts. Anytime we write a piece, we know we could reach out to a dozen experts via DM, and boom, you get a response right away. That magic is there. And if you could learn to sort of, turn off the trolls or ignore the trolls as much as we have, Twitter can still be a magical place. And we would be amongst the saddest if it were to somehow turn into a shell of its former self or go away altogether. I mean, these things can go away. Look at MySpace. It happens. And so our hope is that Substack isn't spreading themselves too thin. There's a lot of emotions here for us, and it obviously cuts very deep. We've got 250,000 followers on Twitter and 150,000 emails on Substack, so we've obviously ridden both trains hard, and it would be a shame if either of them were disrupted.
But as a content creator, you have your aha moment, right? And you're like, you just really got to say to yourself, you're like, are we committing too much to this one platform, which we don't know what will happen, right? And I think to your point is where's the quality of the discourse going? And I think everybody, especially if you are in the business and you're in the world to learn, you don't want the trolls, you don't want the noise, you want to get distilled great conversation. And if that exists on notes on Substack, that's a very exciting world.
Yeah, you gotta know what the value is.
Let's also be very clear. Twitter was a B2B business where content creators drew eyeballs against which ads were sold, and the content creators didn't get any of that revenue, which is great. That's all part of the deal. We understand that. Yeah. But then in return, we get to draw eyeballs from Twitter to our business. That's the deal. Right? And so we created a lot of original content. All of the sort of big fin Twitter accounts do. Lots of people aren't allowed to tweet because of their job, but they are on Twitter. They follow. They get information. And the providers of that information, the benefit they get is they get to bring people to their podcast or to their conference or to their Substack. Pick your favorite. And that was always the deal. And now this transition from a B2B to a B2C, where the creators are expected to pay when, in fact, on YouTube pays the creators. And so this is a very difficult transition. And look, it needs to be said. Like all the jokes about titter and, the various, that turns off half the population. Like, and businesses don't want their brands associated with that. No, it's funny he painted the W such that, it's called titter now. Well, that's not funny to half the population. Yeah. And we don't want to give up half the addressable market. That's off brand for us. So you can imagine how the advertisers feel when they have to, there's going to be businesses for whom that's fine, but it is what it is. Like it matters, and this is why advertisers, at least initially left. He claimed in an interview with the BBC last night that they're coming back. We hope they are, but there's a real challenge here for people that are operating a certain type of business, that have a certain type of brand, that have a certain respect for their customers, and so it makes everybody have to choose, which is rather unfortunate.
Doomberg, you nailed it, right? Like it's just like at the end of the day, how everyone presents themselves, that can be across the spectrum, but how the platform itself presents itself. I don't want to see a Dogecoin stupid dog as the replacement of like that. To me is like, to your point, it's like someone's going YOLO on this thing.
Yeah, exactly. So I didn't mean to turn the conversation, but it's a fascinating one. It's on everybody's mind, and we'll be writing about it next. So.
Doomberg, as always, we are so thankful and grateful to have you as a longtime partner and a good friend. Look forward to keep doing. We got so many conferences coming up. Doomberg, guys, if you don't know this guy, the Green Chicken, lays it out. Substack's where you find the greatest content from the Green Chicken. Thank you very much, Doomberg.
Thanks. Always a pleasure, and looking forward to the next one, guys. Good luck. Fantastic conference, and congratulations.
Thank you.
All right, everyone, the Commodity Conference is just getting started. Don't go anywhere. Coming up next, we have an innovator in battery storage and a metal that you all benefit from, but not many people know, vanadium. Largo's coming up next.
Rise to body and soul.
All right, Grizzle Commodity Con guys, please hit the retweet. Please hit the like. Let everyone know what's going on. Scott, we got a dear good friend of the Grizzle family. Give it the intro.
So we're excited to talk to, one of the largest producers of vanadium in the world. Vanadium is totally being changed by the energy transition, and it's a metal that is not on everyone's radar like copper, but it basically should be. So we're very happy to have Alberto Arias. He's chairman of Largo. Welcome.
Thank you. Thank you for the opportunity to share our story with your investors.
So let's start off with your story, actually. You and your company are two of the most well-known ambassadors, I'd call you, of the vanadium industry. For anyone listening who doesn't know Largo and the innovative businesses you're building on the side, could you give us a brief overview of the company and then just very quickly touch on how vanadium is used in the modern economy?
Yes, no, thank you. Largo is the largest primary vanadium producer in the world. We have an operation in Brazil that has great competitive advantage because of the high quality of our ore resources. But we also have an emerging battery business in Massachusetts in the United States. So we have a two-pillar strategy as Largo to be an important player in the vanadium industry. We produce around 7% of the world's supply, and we have great competitive advantages because we're one of the lowest cost producers given the high quality nature of our operations. Now, vanadium is a metal that, as you said, is not as well known as copper, for instance, but it is very critical for its applications in reducing the carbon footprint in today's world. The main historical application of vanadium has been on the steel industry. Just adding a little bit of vanadium to steel increases significantly the strength of steel. So you can reduce the carbon footprint of construction infrastructure. By just adding vanadium, you need less quantities of steel and you're reducing the carbon footprint. But the real explosive growth that we see in the demand for vanadium is related to batteries. And there is this technology called vanadium redox flow batteries, which has been around for quite some time, but it's really taken off in recent years.
Why don't you jump right back into what you were talking about?
Yeah, well, I was talking about the importance of the growth of demand in vanadium. Historically, it's been on the steel industry, which is an important application for reducing the carbon footprint of infrastructure or construction. But where we see the explosive growth is in the vanadium flow battery industry. This long duration energy storage that's really taken off in a significant way.
Let's move to the vanadium battery a little bit. So that's a particularly large opportunity. Can you talk about your expectations for battery demand in the coming few years? And basically, how big of a deal will batteries be to the vanadium market, do you think?
Well, it's very interesting because last year we were talking about projections. And last year in this conference, I told you that people were projecting 41% compounded annual rate of growth on the vanadium demand for the battery industry. Nowadays, there's a lot of new data points that show how rapid this market is moving. Just on 2022, there was a similar amount, 400 megawatt hours installed just in 1 year. So what was installed in 40 years was installed in 1 year. And this year, between the announcements and the things that are in construction, it's 5 times what was in 2022. So we are really seeing an exponential rate of growth in the demand for these flow batteries. And it has a huge impact on the vanadium industry. There was a conference in China just a month ago in Chengdu in which they were saying, local Chinese companies were saying that vanadium flow batteries was going to take 30% market share of the long duration energy storage in China. And if you quantify that, that would require the entirety of the supply from now until 2030 to supply that kind of demand. Look, I've been in the metals industry for 30 years, and I have never seen a demand shock of this magnitude. This is very exciting for the price outlook for vanadium in the medium term.
Yeah, we threw up a chart that you have in your deck that's great that just shows how explosive the demand is potentially. Where we're getting to this year, you could have 10% of vanadium production going just to these batteries, and then it could get to 100% in a few years the way it's looking. Yeah. So, I mean, the supply-demand outlook looks very, very favorable for vanadium, which is why it's definitely on our radar.
Yeah, yeah, Alberto, that is a phenomenal. Can I just ask on the Chinese demand front? Is it so they've obviously from a perspective of vanadium VRFBs, they've decided that is like, you know, from a cost competitive perspective, they're seeing that will be, you know, in line with other long storage solutions as well, right? That's fair to say.
Yeah, I think China is leading the way in this revolution of vanadium flow batteries. And what is important for the industry, it is that it is a reality. It is a reality and it's taking great traction. Now, why China has chosen, it's because it works. First of all, that's the most important factor. But also China is a big producer of vanadium. But that has a huge importance for the vanadium supply-demand balance. Why? Because vanadium price outlook, sometimes you have vanadium price spikes. You know, the price of vanadium can take off, and these prices take off when China becomes a net importer of vanadium instead of a net exporter of vanadium. Like, if there is such amount of demand that is being generated by this industry in China, likelihood is that you're going to have China as a net importer of vanadium, and that has a big impact in the price outlook for vanadium.
Now, just talking about some of the unique things you're building here. So your Largo Clean Energy division is pioneering vanadium battery deployments like what they're doing in China. Can you tell everyone about this division and the coming operational milestones that we should be watching for?
Right. Yeah, we have manufacturing facility. A very important milestone is the installation of our first battery in Mallorca, Spain. Our first client is Enel, is a big Italian utility, and we're going to be doing the commissioning in the coming months. But that is something that is a critical milestone for us.
Great. Now, continuing on the innovation topic, you own a large stake in the only publicly traded physical vanadium fund. The ticker, I think, is VAND. It's Largo Physical Vanadium. So with vanadium prices and the NAV of the fund, I just looked, they're up about 30% since September. Can you tell us how the fund works for people that don't know it? And for anyone who'd like to invest in, say, physical vanadium as well as a company like Largo, two options.
And I might add, because we got a lot of, you know, those that will be listening through the entire live stream. There are a lot of we have Sprott coming up. So those that know the Sprott ETF, please think of this as you think of what Alberto's about to say.
Yep.
Yeah, well, Largo Physical Vanadium is an innovation that Largo has created. It is an ETF-like instrument that is used to buy vanadium and hold it, and provides a vehicle in which investors can participate as an investment alternative to follow the price outlook of vanadium. But very importantly, it has a big impact on our battery business. Why? Because the biggest challenge of the vanadium flow batteries was vanadium itself. You know, vanadium is around 40% of the cost of the battery. Sometimes it's very volatile. So it was a big impediment for the adoption of that technology, because if you get periods of price volatility on vanadium, that is something that your customers don't like. So what we have done with this Largo Physical Vanadium is we are using a unique characteristic that vanadium has, which is that it never degrades in its application of in the battery, because it's in an electrolyte form, in liquid form, it never degrades. So what we're doing is we are using the batteries as storage, and in doing so, the vanadium is working for you and providing the vanadium at very little cost to the customers. So what was the biggest challenge for the vanadium flow battery industry, which is the cost of vanadium, is become the biggest competitive advantage thanks to this vehicle. This is going to be the first time an ETF-like instrument of a physical commodity is actually doing something useful for society. Because typically, like the gold ETF, for instance, you put gold in a vault, in a warehouse, and it's being stored there. In the case of this Largo Physical Vanadium, the vanadium is actually put in the batteries and working for you, And that, in doing that, is really a game changer on the battery business.
Yeah, that Alberto, that just blows my mind in terms of like how we think about that. Like if you think about the GLD, that goes into a vault, does nothing. You actually have to, there's a cost to that. Here, this is living in a battery and it's doing something. It's a phenomenal innovation as we think about physical ETFs. It's just there's nothing like it, and I'm not sure there'll ever be anything like it in the future.
Yeah, well, we're very proud of that innovation. I think that it could be transformational to the battery business, and we are starting to see the impact this year on it.
Tom, another thing I was thinking, it sounds like the industry, they've already figured out that how to remove the vanadium at the end of the battery's life, versus you look at lithium, how much money's being spent on trying to figure out how to even get the lithium out of the battery at the end.
Yeah.
So like it's just from a technology and cost perspective, the vanadium battery and ESG is way ahead, it sounds like.
Yeah, look, and I think that's really the different, like this, it's a clear process that you can lift it out, and it's a dynamic innovation there. And just on the last part, and I know, Alberto, you've alluded to price a couple times, just China becoming net exporter turning to net importer, and then also the physical vanadium van ETF. Could you help explain to us, to the audience, how small changes changing in supply demand dynamics can lead to large spikes in the price of vanadium? That's what we've seen historically as well when you go to supply deficit.
Yeah, I think it's very, very important, especially for a company like Largo. The last time that the vanadium price spiked was in 2018, and price of vanadium generated $400 million of cash flows for Largo just on that year. That's bigger than our market cap today, which is $300 million. So what is the beauty of Largo is its position to benefit from these potential price trends, but we're not counting on them. We're transforming the industry. We're creating a very good business on our vanadium supply and also on our battery business, innovating with the Largo physical vanadium. And in addition to that, we are going to generate an additional revenue stream by the production of titanium in the form of ilmenite concentrate. It's the same ore body. We're getting more out of our ore, producing a different metal without much effort. So I think we're really making a big investment case for investors to participate in Largo and participate in the price trends of vanadium.
Alberto, phenomenal insights. It's really helpful, for us to understand. Thank you for all the great insights. Being a lead partner of Grizzle Commodity Con, vanadium is one of those unique metals that few understand. But once you understand it, you understand the power of what it can do from a application perspective, specifically on the VRFB side, and then what it does on the resource efficiency side. But then on the when you think about the pricing of vanadium, just coming back to what exactly Alberto said, just how powerful that is from a cash flow perspective when you have these big spikes. Alberto, thank you very much for all the great insights, and of course we're going to have you back in the battery metals one-on-one. You'll be a cornerstone there. Thank you very much, Alberto.
Thank you.
Wonderful. Thank you very much. Take care.
Thank you.
All right, everybody. Grizzle Commodity Con, we're just getting started. It keeps on going. Next up, we have Canada Nickel. Don't go anywhere.
All right, welcome back to Grizzle Commodity Con one-on-one. It's our pleasure to have Mark Selby, CEO of Canada Nickel, joining us. Canada Nickel, developing the next generation of low-carbon nickel. Thank you, Mark, for joining us.
Thanks for the opportunity. It's great to be here.
So, Mark, let's start things off. Just talk about big picture for nickel demand. How will the explosion in electric vehicles and battery storage change the demand growth for nickel over the next decade, in your opinion?
Yeah, so a couple of years ago, we talked about a doubling in nickel demand by 2030 versus where it was in 2020, and very little visibility on supply outside. And Indonesia is going to show up with about 2 million more tons, but the other 500,000 to 1 million more tons that's not Chinese controlled have very little visibility on, other than a few projects like ours. The news of the last few weeks is making this forecast even really understated.
Wow.
Just yesterday, the EPA announced that they're going to put emission levels in place that would require most car makers by having them to sell 2/3 of their car as battery vehicles by 2032. And in that forecast I just sent you, that was basically looking at a penetration of 30 to 40%, with the US being the laggard. So with the laggard now at 60%, those numbers are, will have to be much higher than where they are today, than where we're forecasting.
Yeah, that chart really puts it in perspective for anyone. I would check out their deck to see that chart if you want to again. So we got to do for people listening, there's probably people that know Canada Nickel, but for anyone who doesn't, could you tell us a bit about your company, where you operate, your assets, and operational milestones? Just kind of a quick rundown.
Sure. Relatively new company, 3.5 years old, founded on the Crawford nickel discovery just north of Timmins. It's the largest sulfide discovery since the early 1970s. What's even more exciting and more news on this today was we've consolidated 20 plus targets, and we think what we have in Timmins, and now we're calling the Timmins Nickel District, can be one of the world's largest sulfide nickel resources out there. And today we made a discovery at our Midlothian target. That's the fifth. We're 5 for 5 since we started stepping out around this regional exploration program. So, the world needs lots of nickel. The world needs lots of low carbon nickel, and the kind of deposit we're developing has this unique quality. These ultramafic nickel deposits have this unique quality that the host rock is able to, when it's exposed to air, spontaneously absorb CO2. So, our mine isn't going to be just a big nickel cobalt mine. We're doing the feasibility study right now and also incorporating this carbon capture and storage technology that we developed to be able to turn it into a 1 million ton per year carbon storage facility, which would make it the largest facility in Ontario and one of the largest in Canada.
Interesting. Okay, so I saw you announced some big news. It was maybe a few weeks ago that mining giant Anglo American bought 10% of your company. So what did they see in either your asset or your vision? What do you think clinched the deal in your view?
Yeah, so, it was a great endorsement. We're the first of this new generation of bulk tonnage nickel deposits to have a major mining investment. So they took just under 10% stake. In their release, and you can go to the release to see what they said. It's basically the fact that, this is a rapidly advancing large scale nickel project. We're in a great jurisdiction in Ontario, Canada, where we're getting lots of government support, lots of community and First Nation support for this project to advance. And we're in a place where you've got all the major infrastructure in place. People underestimate, when you need to build a mine, it's the value having the infrastructure in place is a huge benefit that people underestimate. And that's what they were zeroed in on.
So there's an existential question I've been asking myself, and you're an expert, so I'm hoping you can give me some clarity here. Why Canada? So what are the benefits to operating a lower grade mine in a developed country over, say, a higher grade mine in an unstable country?
Yeah, so it's not even just Canada, but Ontario specifically. So there's a few very important reasons that people need to pay attention to. One, again, in a developed country, there's no risk that the governments are going to change the rules and confiscate either the asset itself or a lot of the value of the asset. Witness what First Quantum just went through in Panama with their Cobre Panama project, which had a massive impact on the value of that asset. Number two, in terms of building the mine, again, in a place that's actually built lots of mines, you can work your way through the permitting process on a fairly timely basis. And there's lots of places If they're not familiar with mining, you can get tied up in permitting for a very long time. We expect to have all our permits in place by mid-2025. We're already 1/3 the way through the process and on the second phase of that today, an announcement out just recently. The third thing is in Ontario, we have access to low carbon electricity from the grid. So we can literally plug our mine in to the existing electricity grid, use electricity to decarbonize our operation to the maximum extent possible. So in addition to these carbon sucking rocks that we mine, we're also able to design a mine with a relatively low carbon footprint. And the last reason and the biggest reason today in the critical mineral space, just a few weeks ago, the federal government announced a whole new series of tax measures for critical minerals and critical minerals processing, where they're going to have a 30% refundable investment tax credit. So that means I spend $1, I file my taxes, I get 30 cents back on that dollar, the next year. So, it will provide hundreds of millions of dollars of free money to us to build our project right up front. Investors, totally miss that. This is going to be the best 5 to 7 years to build a large mine, to build a large processing plant, literally, probably since World War II in terms of the amount of government support that's out there.
Yeah, Mark, that just the way you put it there just really helps us understand. That's very powerful the way you've explained it. Now, if I were to think about an IRR impact with respect to the project, like, have you guys, what kind of impact? Like, that sounds like a very meaningful impact to just the internal rate of return of the project and that kind of support from a government.
Oh, for us, it's exciting for Canada Nickel, but just to give people sort of, an idea, at the end of the day, it's about, it really shrinks the denominator. So when you build a big project, you're going to fund about 40% of it with equity, right? Which needs to come from somebody other than the debt. Yeah. When you're getting 30% of your overall capital, and again, not all the money you spend on the project is going to be qualified, but let's say 15 to 20% of the overall capital bill, is eligible, for that credit, and you get that money. 60% or so of the capital is that 15 to 20% of the total capital bill that you get back. That's almost half of my equity check.
So I can get
if I can get the Ontario government to match what the federal government's doing, I almost, have almost of all of my equity. And then behind that, I've got the car companies, the battery companies all lining up who've now realized there's only a handful of projects that can come online before the end of this decade, and they all need the nickel, cobalt, graphite, lithium that these mines are producing. So investors need to, this is really going to be a once in a generation cycle. And I don't think investors realize just what's on the table from the various levels of government.
That's a great example for everyone. You hear what he said. Based on how much stock he would usually have to use to fund the project, because of these tax incentives, he'd have to fund half as much of the stock. So that's a huge
and potentially almost zero. Just with what the feds give me is almost half of what I need.
Great.
Mark, you know what we got to do? I'm just going to do an aside here. You got to join us for our Twitter Spaces to break this down. We make it into a nice because this is powerful stuff. Obviously, not only for Canada Nickel, but for the industry as a whole,
and for Ontario.
Yeah.
Oh yeah. No, the fact that after that budget announced, none of the nickel, graphite, cobalt stocks moved at all the next day. We all got dramatically more valuable the day after that federal budget announcement. And I'm not even, that's just that one program. They also announced that they're topping up all of the other sort of pots of money that they are using to make one-off investments in. And so, no, it's a truly exceptional time, to be in the mining space right now.
Very exciting.
Now let's move on to your Crawford asset. It does look to be world-class on costs and production size and resources, all of it. Could you just walk investors through the next milestones, permitting, operational for Crawford? What should we be looking for?
Sure. So, it's been a busy period of time already and a lot more to come this year. So we put our equity advisors in place. We're working with Scotia and Deutsche Bank to put the equity portion of the financing together. But again, after this government announcement, they might not have as much to do. We just announced we appointed Cutfield Fieldman as the debt advisor to put the debt portion of the project financing together. We just announced that we successfully completed the first phase of the permitting process, and we're now in the environmental impact statement phase, which is the second phase, and we'll have that done by the first half of next year, with a goal to being fully permitted by mid 2025. We're going to have our feasibility study complete by mid this year, and we're quite comfortable with where those numbers are landing. We are in discussions with a number of the people in the automobile and battery supply chain, and we're looking to have one or more offtake agreements in place. We will have definitive agreements in place with the First Nations agreement. We already have agreements in place with everything we need to do with them, and have a great working relationship with all of the local communities. And then lastly, again, around Crawford, we're doing the step out regional exploration like today's announcement. And again, you'll have a whole series of news flow around that. So looking forward to a very, very exciting 2023.
Great. Awesome. So you talked a little bit about the emissions mitigation, but you plan to use a breakthrough technique that's called in-process tailing carbonation. Can you explain what this is in layman's terms and why it may be the future of how critical minerals are mined?
Sure. So these deposits, again, have the rock has this inherent characteristic that if you leave it sitting out and come back a year later, you'll see that the surface of it has already converted itself into this new mineral. So the rock grabs the CO2 molecule and converts itself into a new mineral called magnesite, where this magnesium, where the CO2 is permanently captured. What historically has been done is people have looked at, after you've deposited your tailings, trying to find ways to get more air in there and measure how much carbon gets picked up over time. And on that passive, what we call a passive approach, within months and years, you can get to the point where your entire operation can be zero carbon if you're in the right spot. What our in-process tailings carbonation did, basically, instead of waiting for the tailings to do its thing for months and years, we literally inject a high-strength CO2 stream into our tailings as it's going through the mill. And because of where we're doing it and the conditions that exist when we're doing it, we can have that pickup, instead of being months and years, take several hours.
Oh, wow.
And
okay.
what that allows us to become is a big carbon storage facility. So, there's people trying to find ways to store basically capture carbon. The problem is that unless you're next to an oil and gas field, it's really hard to find a place to store that carbon. So, we're going to become this massive carbon storage facility. And again, we think we've got multiple Crawfords in the Timmins region. So we'd really like Timmins to become a zero carbon industrial district, where basically, you can leverage the fact that we've got all this rock that wants to soak up the CO2 and really look at, shifting the carbon balance in Canada.
So on this in-process tailings, is it ready for prime time, or there's certain milestones we should watch for that say it's now ready to be really scaled up?
Yeah, so we're developing this at kind of rocket speed. We literally figured this out last July, and
Wow.
Our team has been pushing it forward very, very quickly. We had enough success with the test work that we pushed our feasibility study out to mid-year to be able to basically build that process into the base case for our feasibility study. So, we're looking at basically 12 months from initial discovery to having it engineered to a level to having the feasibility study. So, very proud of the work our team's been doing on that. And again, part of the ability to do it is we're not inventing some funky new technology. We're not operating at some funky type of conditions that work great in a small scale lab. What we want to do is use existing mineral processing equipment and just modify it to handle CO2 rather than other gases such as air or oxygen or whatever, that have been used in other industries. So, with that in place, we think we can, get it all done.
Great.
Mark, phenomenal insights on Canada nickel market, all the incentives and how powerful that is for the industry and your company, Mark. Obviously, we got lots more to chop up. Thank you so much for joining Grizzle Commodity One-on-One. We're going to have you back for our battery metals in June. Thank you so much.
Thanks, Mark.
No, that's great, guys. Thanks very much. Have a great
Appreciate
day.
it. Thank you.
All right, remember, guys, Grizzle Commodity Con is live. Put your answers in the chat. We might answer them live. We might ask them live. But it keeps on going. Next up, we have someone lighting the silver fields of BC on fire, so don't go anywhere.
Hit the like and subscribe, though, on YouTube. Guys, see you
Don't forget.
All right, we're back with Grizzle Commodity Con one-on-one. You know, we got none other than Shawn Kunkun, CEO of Dolly, Varden. Shawn, thank you for joining us.
Grateful to be here. Thank you so much.
Thank you.
Now, Shawn, let's just kick it off with a little about your company. For anyone who doesn't know Dolly Varden, could you give us a brief overview of your assets?
Yeah, Dolly Varden's a really unique company. There's, the silver space is small. It's rare to have a pure silver mine. What makes us even more rare is the fact that we're in BC. We're in the Golden Triangle in a safe, stable mining jurisdiction. So we marry size, we marry grade in a safe jurisdiction.
Great. Now, the Golden Triangle is where you operate has seen a large number of deals recently, I've noticed. Does this simply reflect the prospectivity of the rocks, or are there other drivers of the pickup in activity?
I think there's a lot of factors that's led to $5 billion in takeovers in the last couple of years. It's definitely some of the most prospective rocks on the planet. Like, this is the highest concentration of gold and silver on the entire world. And I think what's really led to this resurgence and this all this recent activity is a few things. Number one, you've got glaciers and ice melting at a rapid rate. So that's opening up new exploration corridors. The other thing that's occurred is the government has brought in a lot of infrastructure. And when I say a lot of infrastructure, we're talking billions in road improvements, in bringing clean, low-cost hydroelectric power into the region, also upgrading deep-water seaports. So you've got the melting of glaciers, you've got the government bringing in infrastructure, and then it doesn't hurt that commodity prices are up like 10x from where they were just a few decades ago.
No, not at all.
Now, I wanted to talk about your ownership table. It's interesting. So you have a relatively small number of large institutional investors on the cap table. I just wanted to get your opinion on what are the benefits you see from having a small number of large owners versus a large number of small owners.
Well, it's
And I would add this, Shawn. This is really kind of like, this is as quality as it gets in terms of when you look at an ownership table of a company that you're invested in. This is kind of the type of names that, in terms of how a story plays out, these are the kind of players you want at the table. I just want to
there's a reason they're on the cap table, obviously, for you.
Yeah, so what's interesting is, like, when I look at a cap table and I look at that ownership pie, I view it as like the foundation. It's like the foundation of a home. You know, we're building a company and we need solid, aligned groups and individuals and companies and institutions that are going to allow me to build a business. It takes time to build a business, right? Good business is boring. And so I need that alignment and I need that opportunity. So the fact that we've got a mining company, a corporate. So these guys, who are they? They're guys who are depleting their mineral inventory every day. So they're looking at future sources of mineral inventory. They're quite acquisitive. They've made 2 big takeovers in the last 12 months in Keno Hill and up at Rakla. And so this is all in Canada. So you've got Hecla Mining, who I would argue is the best performing silver equity on the planet in the last 3 years. So they're New York Stock Exchange listed. They've been around for like 130 years. So talk about legacy in terms of history. Their CEO, Phil Baker's been running the company for 20 years. So stability. So you got Hecla as a 10% shareholder. You've got billionaire investor Eric Sprott also at 10%. You've got a company in Fury at 23%, and then you've got institutions that round up 50% ownership, including Fidelity, that owns 7.5% of the company. So you've got tremendous pedigree of shareholders, and there's some great institutions that I won't name, but are there. And my point here is, as the company grows in terms of size, market cap, as the stock gets more liquid, it's like a snowball effect. Bigger and stronger institutions now qualify. Like we saw the SILJ, which is the silver ETF, come in and buy 7 million shares of Dolly Varden. So we're starting to qualify, and we're shortlisted for another ETF that's going to make their decision on February 18th. And just to tell you, as investors or people that are looking at this as an opportunity, guys, go back and look at the trading activity on December 16th. December 16th. Why do I reference that? It's because that's when SILJ came in and picked up 2 or 3 million shares, right? And I think our stock price went up 25 or 30% that day. So when you have a structure where only 7% of the company is held by the public, the retail float, that type of a move into the equity causes a big percentage gain increase. And I think it's why Dolly Varden has been outperforming its peers and why the equities perform so well.
That's an interesting point you bring up, like in terms of as we see fund flows, and we did a fantastic pod for those who have a chance. Please do go to Twitter and also the Grizzle Pod. We had a great conversation with Shawn about all things silver and gold, but one thing we didn't touch on, Shawn, was just that the aspect of fund flows and how ETFs play a big role in this coiled up aspect, specifically as it relates to your shareholder base. I think that's very, that's very powerful.
And further that theme, if we look at like the move to like passive management in the last few decades, and we look at some of these, like you've got the GDXJ that is, managing $3.8 billion US, and the impact that would have, if they were to come into a company like Dolly Varden, and they have liquidity restraints, and they have market cap restraints, and so as the company grows, I think we're going to attract bigger, and again, outside of Fidelity, that's really the only big boy institution that's in the name. So I'm actually going out over the next 60 days and introducing the company now that we've been revalued and we've got this larger market cap and this greater liquidity to some of Fidelity's peers.
Great. That's interesting. Now, since we're on this point of the success of the company and the valuation, so since you joined Dolly Varden, you've grown the market cap from 20 million to almost 300 million at this point. What actions, as you think back, that you executed on were instrumental in getting you to this point?
So right today we're trading at a $315 million market cap.
Wow, already through the 300.
and really, like, I got to hand it to my team. I've got a team of scientists. Like, I can transfer wealth through marketing and through awareness and through my leadership on the finance side and the capital markets. But transferring wealth is one element. It's what creates wealth is the science. And so, I think what I'd attribute our success is the fact that our mineral inventory has grown. And that's grown through discoveries. So the scientists following up on where these silver veins are growing and expanding and making discoveries. And I'll also hand it to, we've got a great team of M&A bankers and lawyers, and I've led them into accretive acquisitions. So where our mineral inventory tripled is through the acquisition of Homestake Ridge. So really, if I were to summarize 3 points to point to the growth of the company, I would say it is the team, it is the $65 million of capital with those strong aligned shareholders, and lastly, it's that mineral inventory growth. And if we can't find it, we will buy it regionally, right? So that's, and we've done it in an accretive way, and where, the example I'll give you is when we picked up Homestake, we brought it into the company, and it represented about a third of the overall pro forma company, yet it represented 2/3 of the mineral inventory. So that just proves that it was a very, very, very accretive deal. And it's why we had something like 97 or 98% of our shareholders voting in favor of it.
And is that something? So it was a third when you made the acquisition, and basically, did you basically proved it out through time, or was that just kind of the economics of the deal that just gave? Like that's very impressive.
Well, if you look at it and you look at like total mineral inventory, we came to the equation with, if you look at the overall mineral inventory today, the original Dolly Varden represented 1/3 of that mineral inventory. Homestake represents 2/3. And so what should have occurred would, Dolly shareholders should have been 1/3 of that transaction, yet we were, 2/3. And so I think that just goes to show that we timed it well, and it was a very accretive deal for our shareholders.
Now, I want to talk about infrastructure a little bit more because I know it's important. You did mention that the province is doing a very good job building out that infrastructure needed, but I know you guys are working on some potential things with partners. So I wanted to ask you, you're in discussions with other miners to collaborate on some infrastructure and processing assets potentially. Can you tell us what the plan currently is or what you'd like it to look like?
Yes, but before I go there, do you guys remember the Kevin Costner movie Field of Dreams?
Yes.
Yes, we do.
Do you remember the famous line, if you build it, they will come?
Yes.
That's the approach the BC government has taken. They took a big risk 6 years ago by bringing power, bringing roads, bringing deep water seaports into the area. They invested billions of dollars, and they're doing it for mining, they're doing it for forestry, they're doing it for LNG, but it worked, and it's the reason that I've come into BC in terms of professionally. I was born and raised here, but all the work I'd done up in the first 15 years of my career was outside of the province. But when the government had that, if you build it, they will come mantra, I thought this is a time where it's going to bring down my costs, it's going to make this competitive, and they're just so willing. And not only are they willing, it's our First Nations partners, the Nisga'a, who were the first to sign a modern treaty in 1999 that has self-governance, that has 80% unemployment. Right? So they are pushing me for development, for jobs. And, I think that what you're referring to in terms of the hub and spoke model, and this is like, I have not had an original thought in my life. Like, why reinvent the wheel? So if you look at previous operators in BC, if you look at the old Antiochs, it was a hub and spoke site, right? So this is deep in the traditions of British Columbia mining. You look at what's happening at Ascot today with Premier, it's a hub and spoke. Their vision is we're going to pull in other satellite deposits. And so what we're exploring is you've got these deposits that are in the neighborhood. What if the companies work together in a central milling facility? So we've got a site that's just south of us called Kitsault that is fully permitted. It was the site of a moly silver deposit, so it was permitted for that. And so we were looking at it with our Nisga'a partners and with some other companies in the area, at a hub and spoke where that would be the hub. And there's so many reasons why it's compelling. Number one, it brings down capital expenditures. Instead of having to build 5 mills and all the infrastructure to support that, you'd need 1. But number 2, from an environmental standpoint, from a footprint standpoint, it's less impact on the environment. It's bringing everything, and even from a safety standpoint, it's reducing risks to one area. So right now we're studying it. We're doing a trade-off study. We're looking at the cost of transporting our materials to that site versus building, and obviously they're pretty compelling.
Gotcha. That's helpful. Now, for any of the non-mining investors listening, could you tell us what the next key milestones are that you think will de-risk your resources even further?
So I think the key is to look back at what's led to share price appreciation for Dolly Varden. And the 2 drivers of that is the company growing its inventory, and we do that through discovery and through acquisition. So we went through a phase where we grew through acquisition. The next phase is going to be organic growth. So we're about to launch into, call it a $20 million exploration spend. We have $26.5 million in the bank, so we're fully financed to do that. This means 4 drill rigs turning round the clock. They mobilize in a month. It's a plus 40,000 meter drill program. There's going to be a ton of news flow that'll start in the summer. It'll go through the fall, through the winter. And so the biggest catalyst for Dolly Varden is our technical team's ability to make discoveries. That'll drive value. It's what's driven our share price. The other thing that we have no control over is the price of gold and silver. 50% of our resource is silver. The other 50% is gold. As we're talking today, we've got gold at record high prices in all currencies. Silver hasn't caught up yet, but when it does, if we look at how Dolly Varden shares have traded historically, we outperform silver 3-1. So if we get a move, the leverage, the price sensitivities, like for a $5 move in silver, which would represent about a 20% move in the silver price, what you'd probably see in companies like Dolly Varden is you'd see 100 to 200% price appreciations in those because the price sensitivities, how much more profitable these mines become when you've got higher metal prices.
Shawn, that phenomenal overview of the opportunity you had, and all.
Tom, I just want to say one thing. Think about it, like, let's say the average silver miner's costs are $20 an ounce, right? And let's say the price of silver today is $25. So you've got a $5 margin there, right? If the price goes to 30, it's 100% more profitable. Mm-hmm. Right. And that's
the leverage you're talking about.
That's the leverage. I just wanted to finish with that point.
No,
that's a great example.
Great, well said. Guys, if you don't follow, Shawn's on Twitter. That's Dolly Varden. And if you haven't listened to it, give it a listen. Our phenomenal Twitter spaces. We're going to do many more of those. Shawn, thank you for joining. And guys, stay tuned because Shawn's going to be with us for our Gold Silver Conference, which is in June. That'll be a big one too. So Shawn, thank you very much.
Guys, thank you so much for having me.
All right, everyone. That was Dolly Varden, and Commodity Con is just getting rolling, so don't go anywhere. We'll be right back.
All right, welcome back to Grizzle Commodity One-on-One, the greatest show on earth for commodity investing. I've got Margot joining the stream with us, and we have Robin Dunbar, CEO of Grid Metals Corp., the next great lithium producer from Canada. How's it going, Robin?
It's going well, Thomas. Nice to be here. Nice to see you this morning.
Yeah, great to see you. Margot, let's kick it off.
Thanks so much, Robin, for being with us today. And let's just keep it simple. For those who don't know what Grid Metals is, can you just give us a brief overview of your assets to start?
Sure. We're focused in southeast Manitoba, and we in the Bird River Sill area. So we're about an hour and a half from Winnipeg East. and we're focused on lithium and nickel assets, so the critical metals in the Bird River Sill.
And let's talk about the region. You guys are located in Manitoba. Why do you think that's a good address for lithium production, or a good region for lithium production?
Well, for one thing, it's currently producing lithium. So, one of Canada's 2 lithium producers is right next door to us. And there's been a long history there of lithium exploration and development going back many years. And so, the area really got off to a jump start with, a lot of known lithium pegmatites. And in terms of the jurisdiction, Manitoba is a go-to jurisdiction in Canada. It's got the green power. It's all hydropower. It's a pretty friendly in terms of permitting. They export nickel concentrate, lithium concentrate. So, it's a great place to do business in Canada.
And so let's just talk about infrastructure. It's almost as important as the resource in the ground. Can you tell us about the infrastructure situation near your mine?
Yeah, I mean, to simplify it, like I call ours a Southern Canada jurisdiction. So the difference between, Southern Canada and Northern Canada is, we can drive about an hour and a half from Winnipeg on paved roads almost all the way to the site. People live and work in the area. And so the cost structure is very, very low compared to mines that are located in the far north, where it's a lot more expensive to operate. Your cost can be double. So, where we are is close to road, rail, power, workforce. So it's really ideal. But, you don't want to be sitting on top of a city. You want to be far enough away from, any population centers that, it's easier to develop a project. And, so we kind of meet the sweet spot in terms of, close to infrastructure and, but not too many people in the immediate area. So yeah, really good.
And you guys are lucky enough to have the only operating lithium mill in Canada, the Tanco mine, as your neighbor. Now, you guys have signed a memorandum of understanding to send your lithium to Tanco for processing. When can we expect that to happen? Like, what are the next steps for that to happen?
Yeah, the next steps are we're currently working on a permit for a bulk sample, and we would then send up to 50,000 tons into the Tanco mill to run through the circuit. And then after that, we hope to have that done by the end of this year, and then by early next year, apply for our mining permit. And we're hoping to potentially get a mining permit for the project in 2024. So yeah, pretty near term on the relative scale of lithium projects in Canada and really around the world. The toll milling, what the toll milling does is it gives you you can take a much smaller resource. You don't have nearly the capital cost, and so you can potentially shorten the timeline. So that's what we're trying to do. And a lot of people think the lithium price is going to stay high for a number of more years, not indefinitely. So we want to get in production quickly, capture the high lithium price, and make some money while the going is good. So being next to the Tanco mine, it's a unique opportunity. I think now they have the Sayona project is up and running in Quebec, and that's just Canada's second. But in terms of juniors being close to a lithium mill, ours is we're in a unique situation, and we're moving fast to develop our projects. So we're calculating a resource now. We finished the drilling. We're doing the permitting, metallurgy, all the things we need to do to move it along quickly. So pretty exciting time for us.
Yeah, very exciting. So in terms of the uniqueness of where you guys are situated as a junior and getting to market first, I think you clearly highlighted getting to market first to capture this enhancement in the lithium price is very critical. Could you could you maybe give us like at the high level view of how you see this playing out, particularly as global lithium resources come to market, maybe just how bigger picture, just the amount of EVs that will be coming on, and where you guys slot in for production coming online, but then secondarily, how much you'll have.
Yeah. So, like the latest big announcement was in the U.S. in the last couple of days with the new EPA rules that are coming in that will force US to go to 50% EVs in the next few years. So, there's things like that happening all the time. So, if you have 50% EV adoption globally, or in the major, China, EU, North America, that's going to meet just an avalanche of lithium that's going to be required, right? So the price is going to go up and down, but the trend is really, with EVs seems to be, unstoppable now. And so really, as a junior company, you want to get into production while you can, while the prices are still really high. The value of the rock is really high, and so for us, we're starting off with a relatively small scale production, but the value of the rock is $1,000 a ton. So if you did 500,000 tons a year, which is relatively small, that's gross revenues of rock you're taking out of $500 million. It's the numbers are really staggering. Wow. So we're talking in our initial deal with Tanco of doing between 200 and 500,000 tons per year, and some of our initial resource could be open pittable, and so the mining costs will be really low. So it's a relatively small scale on the world stage, but the capex is really low too. And I think that to be able to get into production and differentiate ourselves by having cash flow is really important for us, because that's the differentiating. Start to make some money and finance your growth, acquisition, everything we're doing, and that's really our plan. And our window is the next 24 months. That's really 24 months from now. We are hoping to be in production and making money. Now there's lots of things that need to come together, but we're doing everything we can to move it along.
And I'm hoping we can put up your lithium strategy slide. Could you maybe speak to what are the most important milestones facing your company over the next few years? Sure.
For the key thing in the next 18 months is submitting our mining permit to be able to mine, and finalizing we have to do a second stage deal with Tanco, so really firm up ability to mine, the terms on which we're going to do the deal with Tanco, which we've finalized those to a great extent. It's really a 50-50 split of the profits after the costs. But getting the mining permit is really the key driver for us, because then you're in a position to start mining ore. And going along with that is very, very important on the permitting side is our relationship with the First Nation in the area, the Saugeen First Nation. So keeping a good relationship and getting their support to the project is critical. We think that if we're able to keep that on track, the government permitting will follow. And then there's all the things we're doing in the meantime. So for our studies, which we'll be doing over the next 2 years as well, we have a resource. So we finished the drilling for that. That's underway. Our metallurgical study is basically complete now, and we'll have to do more work on that. But the permitting, the environmental studies, all those things are coming along. But we're well down the road, and so we can see the finish line, and we want to get the project along track, so we can get a mining permit, so we can start taking rock out of the ground and making money. So it's simple, but there's a lot of moving parts. Yeah. But it's a unique opportunity for a junior. And just to give the audience a bit of a sense, like if you build a 1 million ton a year lithium plant, or 700,000 tons a year, that can be in the range of $250 to $300 million and take you 5, 7, 10 years to get permitted. Yeah. It's just a way more complicated, and who knows where the lithium price is going to be then, right? Yeah. So that's ultimately our goal, is we want to be, establish a business and grow the business in southeastern Manitoba. But, it's a lot easier to try to plan for something 2 years out and start making some money and finance what you want to do longer term. And, you can do it on a smaller resource base. You can, you can do it for way less money, and it's just a much simpler project. So that's really, our main focus, and is to move that along and get the project close to production and into production.
It's very exciting. It's clear delineated goalpost, which is exciting. It's not it's not some magic 10 years down the road. And the way we talk about it, Grizzle, we've always said disruption at a reasonable price. Who's going to be at that cash flow inflection point 2 to 3 years out, and that those are where the real value is. And I think where a lot of the hurdles in the industry and as an investor in commodities is when you start to look at these these projects that are much further out the time horizon.
Yeah, you just don't know. There's all kinds of risks that can come in the longer term, and the battery configurations, the EV adoption rates, supply from all around the world, all those things, right? So you want to move quickly if you can.
Making hay while it's sunny outside,
That's
right?
right.
And just on a final point with respect to Manitoba, you guys have been inquisitive in terms of get geological in terms of buying land in Manitoba. Could you talk about the geological similarities to prolific areas like Quebec in Canada, North America, and also could you tell us in, let's call it non-technical language, what your hypothesis is?
Yeah, I mean, I'm not a geologist. I'll just preface that, but the main pegmatites and lithium bearing pegmatites occur along major geological boundaries, which actually, if you look at a broad macro scale geology of Canada, they trend through Manitoba, Ontario, and into Quebec. So you look along those geological boundaries, and then you go, you look at the specific greenstone belts where we are. We know the area's perspective because the Tanko mine sits on, the Tanko pegmatite, which is, a very large, highly fractionated, which means it's got all kinds of, interesting rare metals in it, and including lithium. And so the area has got a proven, pedigree for these pegmatites. And there's lots of these pegmatites around, and they tend to occur where you see one, you see more. So, for an area that's had lithium known for many years, it just hasn't had a lot of exploration because, lithium was never really worth much, and the ground was held by, Tanko, which really didn't do a lot of exploration. They were just focused on their mine. So now there's you've really got great geological prospectivity in the area, lots of pegmatites, and they may not all be sticking out of the ground, right? So, now you have to get into the hard work of finding more. So in our particular case, we started off with the two pegmatites that we did know about, and we've drilled off a resource on that. Well, we have to publish the numbers when that gets done. But, we have a very strong geological case that there's many other pegmatites in the area. And so finding bigger, fatter, better grade ones, that's always the goal. And there are many opportunities for us in the area. So that's where we go to work with our exploration team, and we've got a dedicated on-site exploration team that's going into our second season now of field work. And so we're highly optimistic we'll find more, but we know it's an established lithium district, really well positioned to supply lithium into the U.S. So I think what you'll see in Canada is you're going to see, I always call it the hubs. Quebec, clearly a hub. There's some great, large pegmatites there. The industry's, been active since, mid, 2015, 16, or even earlier. Ontario, the Thunder Bay area is a hub, and now Manitoba is developing in the hub. And what you'll see is the spodumene pegmatites feeding the downstream chemical plants that make the precursor battery minerals, like the hydroxide or the carbonate. So that's why you want to build up these critical masses of lithium spodumene production in these areas. So I think that's how the industry is going to develop, and we want to be a key player in the southeastern Manitoba hub, able to supply into the U.S. market.
Fantastic, Robin. Great overview of a very dynamic company in Grid Metals. You guys are going to get first to market. Really appreciate the insights. We will do a Twitter Spaces in the very near future to understand some more of these elements. Thank you so much, Robin, for joining us. That's Grizzle Commodity One-on-One with Robin Dunbar from Grid Metals.
Thank you, Thomas. Thank you, Michael. Bye for now.
Thank you. Margo, we got a big guest coming up next, don't we?
Don't go anywhere. We have John Ciampaglia, the CEO of Sprott Asset Management, joining us to talk about the uranium sector and 6 new ETFs they launched. So really exciting.
Yes. So stay tuned. We're back. Seconds. Welcome back, Grizzle Commodity One-on-One, guys. This is a big one right here. Sprott Asset Management, John Ciampaglia, thank you very much for joining us, CEO of the big show, the king of commodities themselves, Sprott. Thank you.
Thank you for that lively and energetic welcome. I always love your events. Whatever you're taking in the morning, you should send some my way.
Oh man, you know. So before the day starts, I got this pot of coffee that she goes. But you know what? The Commodity Con just powers me up. But critically, for those watching right now, please hit that like, the retweet. You got a legend here in Sprott Asset Management. The thumbs up on the YouTube. You know all the little digits in that. John, thank you. Obviously, a big 2023 for you. You've launched a slew of new ETFs focused on the energy transition, but I'd be amiss if we did not talk about your core franchise, which is uranium, and your great insights into that market. Grizzle has a great family in the uranium world and obviously energy transition, but just on the uranium side, could you give us just at a high level the state of the market right now as you see it? You have a very unique vantage point that not many others do.
Yeah, sure. Be happy to talk about that. So obviously, it's been a pretty challenging year so far in 2023 for most asset classes. You know, just given all the anxiety about everything from Fed tightening policy and when are they going to finally pause? Obviously, concerns about the financial some of the banks in the United States, and unfortunately, that's really taking the spotlight and it's grabbing most of the headlines and it's creating most of the anxiety for investors right now. So, we look at the uranium sector and the broader commodity space, and we say, hey, there's some really great fundamentals underpinning it, but unfortunately, the backwash of all of these other contagion type issues are definitely having an impact. So, we see the price of uranium, it's up slightly for the year. It's up a few dollars a pound. So it's been kind of the commodity that's held incredibly steady against this kind of broader, macro storm. So the price is held steady. And I think that's just because end users, which are utilities, continue to buy at very high levels. Last year, we saw the highest contracted amount of uranium purchased by utilities in the last 10. And that sounds great. It's exciting. We're finally getting a contracting cycle going. But, I think the more important part of the story is that they're not even at annual replacement rate. So yes, they're moving, but we're still a long way to go from annual replacement rate. So, we still see huge demand in front of us as the world, re-embraces nuclear energy because of energy transition and more recently, energy security. And the reality is we're getting a supply response. We're getting a supply response from, the tier 1 assets and some of the tier 2 assets that have been on care and maintenance for the last few years. But we're nowhere close to getting any greenfield production really going until we see a price that's meaningfully higher than $50 to $60 a pound. So, I think everyone's waiting for that. But, I think the contract book is really driving the bus right now. Investors are obviously on the sidelines with many investments right now. All you have to do is look at the dollars in U.S. money market funds, which are at $5 trillion and counting right now, to give you a sense of where investor appetite is for risk right now. And just more recently, we've seen some inflows into the gold space. Physical gold ETFs, including our own. That was the first month, which was March, where gold ETFs globally had a positive inflow, first time in 10 months. So even a traditional safe haven asset like gold is just starting to perk up a little bit.
That's a great overview. And from just at a high level, how we're seeing utilities, obviously you've highlighted some, big changes, but, at a high level in terms of how are we seeing the government, we really feels like we're at an inflection point with respect to governments addressing climate change through the clearest quiver that they could have, which is uranium, which has been on ice for so long. Is this that watershed moment? I would love to get your insights on, what you're seeing across the landscape, both developed markets and emerging markets.
Yeah, I think it's a great question. And I think we've seen two major inflection points in the last year and a half. The first inflection point we saw was in the fall of 2021. People got very excited about nuclear energy coming out of COP26. It was essentially, it went from kind of pariah energy to all of a sudden governments acknowledging they needed to have it to meet net zero targets. That was really the first inflection point that we experienced, where the spot price finally broke out of a very, long kind of bear market in the, trading in the 20s per pound. And then obviously, just over a year ago, we saw the second inflection point, which we believe was a combination of, concerns about commodity and supply chains related to the war in Ukraine, and utilities, I think, really starting in earnest to contract back. And I often look at Cameco as our bellwether company in that space. And just for some context, I think it's really important. In 2021, they contracted to sell forward 30 million pounds of uranium. Last year in 2022, they hit 80 million pounds. And this year, by our calculations, they're somewhere between, 60 and almost 90 million pounds contracted, depending on certain deals that they've announced with the Ukraine. It's pretty staggering. It's a very powerful investment signal that utilities are coming back to market. They've drawn down their inventories. They're obviously more concerned about security supply. And obviously, they're getting a lot of government support with reactors basically getting life extensions, getting government support, particularly in the United States. Germany, as Doomberg talked about, is in a whole other category of its own. So let's not talk about them. But I think more rational governments around the world are clearly saying, look, we cannot turn these plants off. I mean, look at California. They were on a one-way mission to close the very last power plant in California, and obviously they did a pretty significant flip-flop last year. And when we see those flip-flops, we see these utilities come back to market to procure more fuel. Utilities are obviously making a ton of money right now with their nuclear power plants, and I think they're feeling much more optimistic about the role they are going to play in terms of not just energy production, but low carbon energy. And governments are finally taking them out of the penalty box and saying, irrespective of historical events or polarizing, or misinformation, this technology is part of our solution, and they're openly advocating for it.
And so now I just want to switch from uranium to the energy transition broadly. I feel like this is a really exciting time for mining companies, which have kind of been this neglected sector. Why do you guys see opportunity in the energy transition? I know you guys recently launched numerous new ETF funds in the energy transition sector.
Yeah, we think that the energy transition is really going to be accelerated by energy security concerns. If you look at the build out of investments that we saw in the 1970s after the OPEC oil crisis, it was staggering. Governments in the West made massive investments to basically improve the resiliency and the security of their energy systems. We think a similar parallel green industrial policy is underway. And by our count, we think there's almost $2 trillion of government incentives that have been announced around the world to basically accelerate this transition. And this transition, yes, it's about decarbonization. Yes, it's about moving, to electric vehicles. But a huge part of it is energy security. As we learned, the hard way, and particularly in Germany last year, when you don't have secure energy, either commodity supplies and or insulated from price shocks, it can cause massive dislocation. The Europeans alone spent an extra $1 trillion last year just on higher fossil fuel prices to get through winter. It's mind-boggling. If you think about if they had simply redirected that kind of capital to different technologies to diversify their energy systems, how much better they'd all be off. So these shocks can be pretty profound. And, governments around the world, including Canada, where I am right now, and particularly the United States and the EU, are really in this, I don't want to use the word arms race because it has a negative connotation, but it's a race. It's basically a kind of a green industrial policy race in terms of, which governments can incentivize the private sector to make pretty significant capital investments that are going to be required for this transition. And the dollars are staggering. I mean, if you look at last year alone, Bloomberg New Energy Finance estimated that for the first time ever, the amount of dollars that went into energy transition related investments, which was 1.1 trillion US dollars, matched the amount that was invested in fossil fuels. So this isn't about, fossil fuels going to zero. This is about energy transition investments, basically gaining more of an equal share. And then we think over time, slowly, that skew is going to, move more in favor of energy transition as the world wants to build more nuclear energy, small modular reactors, more solar, more wind, et cetera, et cetera. So we think the governments are sending out very powerful investment signals to the private sector that we're behind this. We're going to put our money in the space. We're going to de-risk these projects. We're going to make it easier for companies to get capital. We find it amazing when, entities like the Department of Energy in the United States are extending multi-$100 million loans to lithium companies in Nevada, or, General Motors or Stellantis making equity investments in lithium and copper companies because they want to ensure that if they're going to be making multi-billion-dollar investments to transform their internal combustion engine production manufacturing capabilities to EVs over time, they do not want to be caught with the bottleneck, which is the critical minerals required to enable these big transitions. So we see these equity investments, we see these government loans and incentives. We see governments, including in Ontario and Canada, saying, hey, we know part of the problem is us in terms of permitting. It's a slow process. It's multi-jurisdictional. We need to accelerate, the process and make it easier for companies to make these big capital investments and get to market. So we think it's an exciting time. And institutional investors that I talk to around the world, and I obviously travel a lot too, meeting with people. I just came back from a week in Europe talking to institutions there. They're very invested in the downstream part of the sector. They're very invested in solar and wind and utilities and companies that make the equipment, but they're not invested in the upstream. And that's really where we think the next opportunity is. And it was really the catalyst as to why we created this suite of ETFs specifically focused on upstream companies that are going to be producing and developing and exploring all the critical minerals that we need for cleaner energy generation, energy transmission, and energy storage, which is another way of just saying batteries. So we think there's a really long-term secular investment theme that is just starting.
John, that's an interesting point you bring up there, that upstream versus downstream. And when you think about just where the money has been spent, capital, it's all been, at least equity raised capital, it's been really on that downstream side, and it's a lack thereof on the upstream. And I know Margot's got a great question on just that capital that's needed, for the upstream. Just, with respect to have we, I guess one question I've got, just what you're seeing in terms of the opportunity. Canada Nickel talked about it earlier, just the nature of all of these, how much the governments are behind, these projects coming to fore. That's a meaningful uplift on the IRR of these projects, right? And I don't think the market has really digested that in a meaningful way.
Yeah, I mean, a lot of these pieces of legislation are fairly new. If you think about the Inflation Reduction Act, which just came out in August of last year. I mean, there's $369 billion of goodies there for everything from nuclear energy to critical minerals, hydrogen, you name it. There's all kinds of incentives there. Governments have realized, and I give them credit for this because usually governments are always so far behind the curve, but they've realized that in order to enable all of this, they need to make it easier for this to happen. They need to provide capital, kind of crowd in capital, but they also need to ensure that this is done locally. They want to build these supply chains in North America or with friendly allies and countries. So if you look at the Inflation Reduction Act, for example, obviously it's still a little bit in flux in terms of what are the requirements for an EV battery cell in terms of, getting the full $7,500 per car. But, it went from, it's all got to be in the US to, okay, now it's going to be in free trade partners. So Canada and Mexico are in. Okay, now it's going to be other countries that we have free trade agreements. So, maybe the Koreans and the Japanese can participate, et cetera, et cetera. So it's still in flux. But I think the main takeaway for investors is that the US government, the EU and Canada clearly signaled that they want these transitions to happen and they want to do it locally. They do not want to be beholden to countries like China, which one day are good trading partners and the next day are not. And right now, obviously, there's a lot of concern with China controlling, 70% of EV battery production, 60% of rare earth production, 80% of solar panel manufacturing, et cetera, et cetera. So there are going to be massive investments locally in Canada. You're seeing it right now. You're seeing Ford and Volkswagen in Ontario, where I live, just announced massive investments in EV battery plants. And Canada, I think, is going to be a great destination of choice. Why? Well, we've got the critical minerals, we've got the mining experience. I think that's a big incentive for these car companies to set up shop because they can get nickel, they can get cobalt, they can get lithium. So we see a really great opportunity for countries like Canada and other tier one mining jurisdictions like Australia and the US and Chile that I think are going to get the disproportionate dollars of investments as governments around the world want to build these supply chains in more locally and with more friendly partners.
Interesting. And just moving on to your investment strategy amid all of this, you guys recently launched the Sprott Energy Transition Materials ETF, which is a pure play critical minerals ETF. Can you tell our audience a bit about the fund?
Yeah, I mean, we basically I've been talking to investors the last 2 years about uranium, globally, and one of the things we realize is that uranium fits within a lot of different buckets within their portfolios. But many investors we've talked to have said, look, these uranium investments are part of our energy transition sleeve, or we run an energy transition, fund or climate change fund or clean tech fund. And what we realize is that many of these investors are not just invested in uranium. They're invested often in things like lithium and copper and nickel because they've kind of pieced together the story of all of the critical minerals that we need in order to make this happen. And as we started to think about our expertise and, what can we bring to the table? Well, obviously at Sprott, we've been involved in the mining sector for a very long time. We looked at a lot of the competitor products in the marketplace, and you could very quickly tell they were not designed by anybody that had any understanding whatsoever of mining. And what we really did with our team here in partnership with the NASDAQ indexing team is we created a joint venture with them, and we used a lot of our experience in mining to basically build these indexes with NASDAQ. So we really went through all the companies in the world. We basically assessed them to try to determine exactly what is their role with critical minerals, what exactly are their exposures from a revenue and or asset base. We basically scored all the companies. And that gave us a much more pure play exposure. So, what you'll see in our indexes is that you won't see the really big mining companies. And that's not because we don't think they're great companies and they don't have a meaningful role to play, but, they don't provide the exposures that we think are the more pure plays to the theme. So for example, if you have a big mining company, well, maybe its primary business is iron ore. Is iron ore an important component of energy transition? Well, it has a role to play. And yes, there might be some uptake in demand over time. But where we see the really big demand shifts happening are things like uranium, like nickel, cobalt, lithium, though rare earths, obviously. These are the areas that we think are going to be disproportionately benefit from these big shifts. So we've built our indexes to really focus on the pure play companies that are going to be producing these critical minerals over the coming years.
Interesting. And just on that point, as you were alluding to, you guys have other energy transition ETF funds that offer exposure to nickel miners, copper miners, uranium miners. Some of them are junior miners. Why did you decide to go with junior miners over some of the large cap miners?
Yeah, so we basically looked at the landscape and tried to figure out, what does the market not have? What could we do better? What we don't want to do is more Me Too products. And ETFs, I think it's very important to have a unique value proposition. We think that in copper, for example, there's going to be a lot of M&A activity. There is obviously a hunt for copper right now in the world, and particularly in friendly jurisdictions. So we think there's a very interesting long-term story in copper, and we think a lot of these junior companies are very well positioned as their deposits become more and more attractive. We've seen a lot of M&A activity, some of it hostile, in the last few weeks, as lithium companies and nickel companies have unsolicited takeover bids because the bigger companies want their deposits. And, we've seen in the last few weeks, some lithium companies that were up 60% in a single day, some of these smaller cap companies. So we think it's important to get exposure right down the market cap spectrum, having some of the big producers in lithium, for example, but also have some of the smaller lithium companies as well. And so, we put together a suite of funds to allow investors to kind of pick and choose. Some investors have very, specific views about lithium or copper or nickel, and they want to get very pinpointed exposure to those. Other investors are like, I don't want to pick. Why don't you guys just pick for me, and I'll buy the broad diversified index with some copper in it, some lithium in it, some uranium in it, etc. So, we really want the market to kind of vote with their feet in terms of which solution they would like. Now, we launched a lot of these funds. We think we're at the very early stages of this secular bull market, which is, in our opinion, going to be very much driven by energy transition materials, which is different than, let's say, the commodity bull market that we experienced in the 2000s. Which were really driven by a lot of bulk commodities. Why? China was industrializing, China was building 30 new cities, etc. So this one we think is going to be very raw material heavy related to critical minerals for energy transition. And that's why we built the suite the way we have.
Yeah, John, I thought that point was very interesting. You mentioned on M&A and you have the Sprott Junior Copper Miners ETF, but I do want to touch on a core franchise for you, which is uranium. Obviously, you have the Sprott Uranium Miners ETF, which is a very sizable fund. Now, the Sprott Junior Uranium Miners ETF. Could you maybe comment on that? And obviously, the same sort of dynamics I would assume would be attracting the investors as well. M&A is a core component, but also just resources and accretion.
Yeah, sure. So obviously in the uranium sector, there's a very small subset of companies to invest in. We think it will grow over time. And what's amazing is that if you just take out the two big producers, which are Cameco and Kazatomprom, and you take out the vehicles that hold physical uranium, it's amazing how you take out a few holdings and a fund could be 50% different from each other. So if investors really want to play the basket of the next generation development companies and exploration companies, we think taking the basket approach is a more prudent way to obviously play the junior sector than just trying to pick one or two or three individual names, to basically avoid any company specific risks. So we definitely have noticed there's a segment of investors that want this very high operating leverage, high optionality kind of trade with the juniors, versus the slow and steady producers, and obviously the physical uranium behaves a little differently than the juniors. So yeah, obviously there's a market for both, and we thought it was kind of a novel way to bifurcate the market. It's the same thing we've done with our gold equity ETFs, where we've got a senior and a junior fund and let people decide which way they want to play it.
Yeah, that's a great point that you brought up with respect to the the large one and the concentration, and now you kind of you get more beta but more diversified. Fair to say.
Exactly.
And just as we wrap up here, are there any other themes or trends you're watching for in the energy transition beyond what we discussed today?
Yeah, I mean, I think we're really interested in watching the way other technologies play out. I mean, personally, we're very interested in any kind of technology that we think can help deal with climate change and deal with decarbonization. And so, there are some other technologies that I would say are still early stage, but we're hugely interested in small modular reactors and how that's going to play out. We think there will be hundreds of those built globally over the next 10 to 20 years, hundreds, which nobody has any of them built in any kind of demand forecast for uranium. So we think that's a very exciting development. But other technologies that we're watching.
Can I ask you a question on that small modular reactors? Is that like what's a timeline for deployment of that? And maybe I'd love to understand that a touch more, but it sounds very meaningful.
Yeah, well, sure. Well, right here in Ontario, where I live at the Darlington nuclear power plant, they've broken ground on Canada's first small modular reactor, which is being built by a partnership between GE and Hitachi. But there are a number of companies, including NuScale, TerraPower, Rolls-Royce, X-Energy. They're all developing technologies to build either small or micro reactors. And this is everything from miniature versions of basically light water reactors to different types of reactors that can be used for industrial processes, creating high heat. There are a whole bunch of different concepts that are moving through development, regulatory approval, commercialization. And it's a very exciting part of the next phase of nuclear energy, particularly in the West. I think countries with very large population centers like China and India are going to continue to build the big scale reactors. But countries like Canada and the US and certain European countries, I think they're going to really gravitate to some of these smaller reactors. I think they're more versatile. And the Department of Energy's, essentially put out white paper saying, we think we have up to 300 existing coal-fired power plants that could be converted into SMRs over the coming decades.
Oh, wow.
As those plants decommission, what do you do with them? Well, I think everyone's realizing there's a lot of infrastructure, local jobs, and local transmission infrastructure there to basically piggyback on and do the conversion to SMRs. So it's an area that we're watching very carefully, and I think it's going to drive a lot of demand for uranium in the coming decade or two.
Fantastic.
John, thank you so much. That was John Ciampaglia, the CEO of Sprott Asset Management.
Guys, thank you, John. Really appreciate it. Obviously, a lead partner. Grizzle Commodity Con is made possible because of Sprott. Guys, check out the ETFs. It's a bunch of new ones and also the core uranium ones. And you've added the new wrinkle, the junior as well. So it's very exciting, John. Thank you.
Thanks for having me.
Guys, thank you very much. Stay tuned. Hit the retweet, the likes. We got more nuclear coming up, more uranium coming up. Stay tuned. Grizzle Commodity Con 1-on-1. We're back in a bit. All right, we're back. Grizzle Commodity one-on-one. The nuclear, uranium, the future of energy trade just keeps going. It's the big show. Guys, thank you for joining. We have none other than Corey Diaz, CEO of Anfield Energy, joining us. Corey Diaz, thank you for joining us. Anfield Energy, a uranium leader in the U.S. nuclear renaissance.
Oh, what an intro.
Oh, Corey, I think you're muted.
You're muted.
Hold on. Oh,
So you can unmute.
can you hear me?
Oh, how are they?
There we go.
There we go.
Corey, tell us what you're going to tell us.
It was a thunderous
Awesome.
intro.
I know. Thanks, guys. That was a fantastic intro. I feel like I should be wearing a hat, though. I feel
Oh,
like
hey, no, that's
Nah,
us. It's
you love what it does.
NFL game day. It's a Commodity Con game day for us. So yeah, no, it's
All right, so Corey, let's kick it off with, there's some people watching that know Anfield. They want to hear more from you, but there's some people that don't know Anfield. Could you give us a brief overview of your assets and what your company's all about?
Sure. Just very briefly, we are a U.S. near-term uranium and vanadium producer. All of our assets are in the U.S. We've got assets that we think can play in the current cycle, and I think we're going to be, if not the next producer, one of the next two producers of uranium in the U.S. market.
Great. Okay. So you recently released the results of an important report on the viability of your uranium mill, which is one of only 3 permitted in the U.S. What were the key conclusions from the report that you think investors should know?
Well, look, I think there are a few things. I'll just do some background. There was a preliminary economic assessment tied to 3 of our assets. So 2 mines, the Velvet Wood Mine and the Slick Rock Mine, and the Shooting Canyon Mill. As you mentioned, one of only 3 licensed, permitted, and constructed conventional uranium mills in the U.S. The economics for the report were robust: $238 million NPV, IRR of $40 million. We think it validates our hub and spoke production strategy. So the 2 spokes are the Velvet Wood Mine and the Slick Rock Mine, and the hub is the Shooting Canyon Mill. We also believe that it's important to note that through our production process, the first 8 years of the mill are filled to capacity. The first 7 years. And then in year 8, we actually have another mine, West Slope, which could fulfill the remaining 8 years of capacity at the mill to stand in line with what's coming out of Slick Rock. So we could fill the mill for 15 years just with our current mines in hand, which also brings into question whether or not we should be looking to expand the size of the mill. So that's another important point. We may be looking at expansion.
Great. Now, I wanted to kind of drill in a little bit to the Shootaring uranium mill. It's one of only 3 in the U.S. that's permitted and has no environmental liabilities. I dug in a little bit, and there's one that's been producing lately. The other one is not even going through the movements of being restarted. So it really is kind of one of 2 if you don't want to wait half a decade for things to be restarted. So it seems like it's a unique asset. But I have to ask, the mill has been shut for over 3 decades. So what are you seeing in uranium and vanadium markets that are telling you now's the time to go through this process?
Well, I'm sure your previous guest touched on the nuclear renaissance, and I wholeheartedly agree. I think you're looking at the build out of nuclear worldwide. Look in North America, look in Europe, look in Asia. The demand side is going to be incredible as we go forward here. I think you look at the supply side. You've got dwindling mines. You've got Kazatomprom, the largest producer in the world, talking about reduced production this year and next. You've got Japanese restarts, which once again pushes the demand side even higher. You've got the U.S. dwindling in terms of production, less than 1 million pounds a year, despite being the largest consumer of uranium in the world, 50 million pounds a year. You've got some places in Europe which are prohibiting production starts. Berkeley Energia in Spain was denied the possibility of bringing on 4.5 million pounds per year of production. And then you've got the funds like Sprott and Yellowcake, a new fund out of Europe, Syria, and Fast, looking to buy spot market material. So it means that the supply side is drying up and demand continues to grow. So, the resolution for that is higher prices. And so from our view, we think that higher prices are going to be coming and they're inevitable. And certainly we're in a good position with an existing mill to take full advantage of that opportunity.
Okay. All right. That was a good rundown. So now you have this preliminary economic assessment in hand. What's the expected timeline to bring the mill online if industry pricing continues to support it?
I think we're targeting a 24-month timeline here. As I said, it's an existing mill. We're not rebuilding a mill from scratch. We have a PSE at site, Precision Systems Engineering, putting together an activation report to determine what pieces we can keep, what pieces we need to switch out, and what the cost and timeline to get those new pieces would be into the mill and ready to move forward.
Okay, so what are the next few milestones in the mill restart and in preparing the nearby uranium deposits, which are going to support the mill for, it looks like almost a decade, now that you have that assessment in hand? Kind of help investors figure out, like, okay, what should we be watching for? This, okay, leads to this, that type of thing.
Yeah, so I think importantly, we don't have the final report yet from PSE. It's a reactivation report. It's a reactivation of the mill. We'll have that this quarter. And that report will show what we'll need to do to actually get the mill back into running state. So that's one thing that people should be looking for. The second thing is we are working on the mining permits related to the two spokes that I discussed before, Velvet Wood and Slick Rock. We'd expect to see some work being taking place, towards the latter half of this year. There may be the potential of doing some drilling on those properties in order to expand the resource and once again increase the time frame that those mines are viable. So that's another thing that people should be looking forward to. So there are a number of things that will show that we're making progress and advancing ourselves towards production.
Okay, all right, that was helpful. Now, there's two popular uranium mining techniques for anyone who doesn't know: in situ and conventional mining. You've chosen traditional conventional mining. Can you tell us what are the benefits over in situ that investors should be aware of as they evaluate both options?
Sure. And let me just preface this by saying that we used to own ISR properties in Wyoming. At the time, we had a relationship with Uranium One to use its existing facility. With the sale of those assets, from Uranium One to another party, that relationship changed, and so we decided to divest our ISR properties in exchange for conventional assets. And so I think the key for us is to have assets that can go through our mill, and all the assets that we now have within our portfolio can flow through our mill. So that's the first point. But in terms of ISR versus conventional, I think that, in general, ISR is at the beginning, it's cheaper to start production, given the low cost of building a processing plant, because you generally tend to deal with smaller mines, because ISR mines tend to be smaller than conventional mines. But the sustaining costs of production within an ISR portfolio is higher because you're once again taking smaller mines and building out smaller mines along the way as you deplete your current mines. So the wellfield cost to build out more mines to fill your processing plant is much higher. Whereas on the hard rock side, the upfront costs are higher in general when you're building a new facility, because you tend to build a bigger facility for bigger mines. And so the upfront costs are a little bit higher. But once you start producing from larger mines, you're not looking to develop more and more mines very quickly because you've got larger mines. So your sustaining costs tend to be lower for conventional, but the upfront cost is a little bit higher. So essentially, it's a wash, but it's all down to what assets you have within your portfolio. And I think from our perspective, the advantage we have is that we have a mill that's already built. So the cost to build a new mill, refurbish a new mill, is low versus the cost of building a whole new conventional facility, which would probably be 3 to 4 times higher than what we're spending to refurbish our mill.
Makes sense. You're trying to get best of both worlds. Your upfront costs, CapEx is going to be lower now because you already have this mill, but the mining technique you're using is lower CapEx going forward as well. That makes a lot of sense.
Correct.
Okay. Now, one of the most important takeaways for us from the preliminary economic assessment was that your current uranium resources are enough to support the mill for at least 7 years. I think you just said 8. How do you think about additional resource purchases versus development at this stage?
Sure. So let me clarify one thing. So we've got 3 hubs at the moment that we're looking at in terms of, 3 spokes. So we've got the West Slope properties, which is not part of this PEA, and then we have Slick Rock and Velvet, which are both part of the current PEA. So right now we fill our mill for the first, call it 7 years, without excess capacity. We can actually add in or layer in West Slope once Velvet Wood is depleted in order to fill our mill to capacity for about 15 years. So that leads us to the idea of whether or not we look to expand, because we will certainly be in the market for acquisitions, upgrading of our current mines, and the potential of tow milling. And so, we think we're in a really good position, because we think there's certainly opportunities out there to acquire assets that could, push us into a decision to increase the size of our facility. Because right now we're looking at about £1 million a year, and we're considering something like closer to £2 million a year, which would be a bit more significant in the marketplace.
Okay, got it. Okay. Now, maybe to round things up for investors, put all in perspective, what are the key milestones that we should be watching for from you guys over the next 12 to 24 months as we see, press releases come out, and you're obviously pushing a lot of things forward?
Sure. Look, I think there's, we've touched on a few things already. I think the PSE report, the reactivation report, is going to be a key milestone and give you a better sense as to timing and cost to update the mill. I think that's very key. I think the PEA related to the West Slope that's not included in the current PEA is going to be another milestone. And we could certainly look at an opportunity to amalgamate that PEA with our current PEA to see what the economics would be with a fully fledged and fully functioning kind of 15-year production timeframe. I think acquisition is another big part of it. We've been very active in the marketplace. We haven't, we haven't transacted on everything we've looked at, but certainly, we've been kicking the tire on a lot of assets with this idea that we want to get a long-term sustainable plan of production, pushes over 20 years or more, or the possibility of having to expand our mill in order to accommodate new assets. So we've got a few things and a few different directions that we can go, notwithstanding the fact that we'll be looking to advance the current assets we have within our portfolio. So talking about mining permits and getting other regulatory approvals from whichever state we're working in.
Corey, thank you so much. Always great to get insights from Corey Diaz, Anfield Energy. Corey, we'll have to do a breakout Twitter Spaces in the near future. If you guys haven't, you follow our Friday Twitter Spaces. Corey's always a great special guest that provides great insights on those, but we're going to do a full one with Corey in the not too distant future. Corey, thank you so much. A lead partner in Grizzle Commodity One-on-One. Thank you.
Thank you, Corey.
Great. Thanks for your time, guys. Take care.
All right, everyone. Commodity Con keeps rolling. I hope you had a little bite to eat. We don't need any food. We just keep going. We're going to go into the night. Stars come out. Commodity Con still streaming. You know how it goes.
Stay tuned. We got Cerrado Gold. Give us a few. Welcome back to Grizzle Commodity One-on-One, the greatest show on earth for commodities. There are probably better shows, but not for commodities.
And not right now.
Guys, if you haven't already, please give it a retweet. Give it a like. If you're on YouTube, just give it the thumbs up, the subscribe. You know what to do. Scott,
All right, so I'm excited because we have a gold producer here. We hear a lot from really interesting exploration companies, but these are guys that are already producing. They found the resource. It's all about now scaling and ramping up. So we're excited to be sitting down with Cerrado Gold and Cliff Hale-Sanders. He's the president. Cliff, thanks for being with us.
Great. I'm happy to be here and look forward to talking to you today.
All right, so to kick things off, for anyone who doesn't know your company, could you give us a brief overview of what you're working on in your assets?
Sure. I'll give you a quick overview of the assets, but I also really want to highlight the team that's here at Cerrado Gold has built and operated and developed mines in South America over the years. You know, we're led by Mark Brennan, who led the Largo Resources development of America's vanadium mine down in Brazil. So a lot of experience in our chosen geographies. Right now, we have two core assets. Our first asset is operating, as you indicated. It's the Minera Don Nicolas asset in Argentina. In 2022, it produced around 52,000 ounces of gold. We acquired that in 2020 and really have worked the last couple of years to turn it around and make it a very robust operation from a failing operation when we bought it at a very attractive price. So that operation continues to grow and move forward, and we're looking to expand that to roughly 60 to 70,000 ounces of production in 2023. The real crown jewel of the story is the development of the Monte de Carmo asset in Brazil. That is focusing on what we call the Serra Alta deposit. That's about 1.3 million ounces in all categories. We did a PEA in 2021 with extremely robust economics, and we're now at the point of moving to full feasibility study, which will probably be completed in, call it, the next month and a half sort of time frame. And we think that'll underscore the tremendous economics that we see in that project to move forward. I can't hear you guys.
Now we're muted.
Apologies, we muted. Yeah. So that was a great overview of the company. Now, what piqued my interest is that you're guiding for a 300% increase in gold production over the next 4 years. That's pretty robust. Yeah. Can you tell us the key contributors to that growth?
The first part of that was obviously getting the MDN mine back to running at 50,000 ounces. So with that, we're going to grow MDN from adding 2 heap leach circuits over the next, call it 18 months. That'll grow MDN to roughly 90,000 ounces of production capacity. On top of that, with the completion of the feasibility study and the development timeline for the Serra Alta deposit in Brazil, we expect to be in a position to commence construction in the latter part of in 23 when we get our final construction license, construction in 24, and production commencing in early 25. And that will probably add an additional 100 to 125,000 ounces per year, commencing in 2025. So at that point, we have this tremendous growth profile that I think is probably second to none in the industry in terms of the junior space in our valuation.
Yeah, definitely seems that way. So Monte de Carmo mine in Brazil certainly looks like a world-class asset from all the numbers coming out right now. What are the key remaining milestones and catalysts to get it to production, do you think?
I'll step back for a second. As you highlighted, it's a robust asset, and that's a function of the geology of the deposit. So at Serra Alta, we put out a PEA in 21, had an IRR of 95% at $1,600 gold. So extremely robust, almost to the point of a little bit embarrassing, and people, wanting to know if you can continue that as you move to feasibility. Obviously, we've seen a little bit of capital creep in terms of inflation around the world, but obviously gold prices are now, $2,000. So we expect the feasibility study to continue to underscore the profit potential of this mine, because we're not just in the business of making gold. We're here to make money, and that's our focus. So I think that's the key differentiator. And you look at the Monte de Carmo asset compared to a lot of the other development projects out there right now, they're 25, 30% IRRs. They're still okay. But because about 85% of our gold is recovered by gravity, it means it's very low cost and a very robust cash generator very, very quickly. And with 85% of the gold recovered from gravity, the capex for the project in the PEA was only 125 million. So maybe it's, call it 150 million now, but it's still, again, relative to these other projects, very manageable for a company of our size. So the first thing, I think, as you said, what's going to drive the value over the next little while? One, completing that feasibility study and showing the updated numbers as we go forward. And I think that'll underscore the value potential of this asset. But then we also want to continue to grow the resource base, because in the mine plan, there'll probably, be a million-ish kind of ounces. Not everything always gets into the open pit. But we have at Monte de Carmo, roughly 85,000 hectares of underexplored land with a plethora of targets to continue to follow up on. We have a 30-kilometer mineralized trend to continue to explore. The actual Cerro Alto deposit is fairly compact. It's within about an 800-meter strike length. So we're looking at this kind of a hub and spoke sort of operation, get the cornerstone asset up and running, and then continue to explore to extend the mine life. I just want to underscore the PEA outlined a project with an all-in sustaining cost in those first 5 years of roughly $500 an ounce. So a very, very robust operating environment going forward. And I guess the comfort level also comes from the fact that the guys in Brazil have done this plenty of time. We're led by Kurt Mencken out of Brazil. He used to run the Jacobina mine. He was part of the team that built the Largo mine as well. So we know the people, we know the landscape, and the project just really benefits from all the core infrastructure being in place, be it the power line, the water, the road. So very easy access and very easy and rapid construction.
Fantastic.
Oh, that was a great overview. Now, as an aside, I want to ask you, because you're already producing and you buy a lot of consumables, what has inflation been like? I know COVID has led to some serious kind of overall inflation in the mining space. What have you been seeing lately? Like, we're seeing inflation of goods cool off. Have you been seeing that? What are you expecting around, inflation in the mining industry going forward?
There's two things. Obviously, in Argentina's unique jurisdiction at this point in time. They're running with about 100% inflation. So that is very unique. But obviously, we're generating US dollars. We're not operating in local currency. So that we do have a natural hedge there. And we are seeing, inflation across the board on be it labor costs, consumables, and what have you. So that is driving it. And that's why we're being a little bit cautious on the capital numbers for Monte de Carmo. It's not going to be 125 million. That number is 2 years old now. So that's why we're sort of guiding to that 150. We're very comfortable with that kind of, ballpark number. That's what we're seeing right now. So we're very comfortable with that. Brazil is a very attractive place to operate because the real is actually going in our favor relative to when we used to operate in Brazil. It used to be almost call it 1.5 to 1. Now it's 5 to 1. So it's, again, that is offsetting a lot of inflation that you're seeing domestically in Brazil because we're generating US dollars. So from that perspective, we're very, very fortunate of the jurisdictions we're in.
Oh, wow. Yeah, that's an interesting aspect to it. Now, there's one slide that I saw in your deck that I want everyone listening to be able to see. So I wanted to ask you a question on it. You expect costs will fall significantly as your new production assets start up in the next few years. But what I found more intriguing is you expect to cut all-in production costs by 15% over the next 2 years. And this is even before your new mine comes on. Yeah. So what are the drivers of this significant cost declines in the face of what we've seen as significant mining cost inflation?
I guess in the initial years before Monte de Carmo comes on, and it's obviously a very low-cost operator, at Minera Don Nicolas in Argentina, that is a very remote site, very much a fixed cost operation. So every unit of production we can increase production by, we're going to spread that same cost base over more units. So as we grow from roughly 52,000 ounces in 2022 to roughly, call it 75, 80,000, because it won't be fully ramped up in 24, you're just going to see that cost base being spread over that many more ounces. And we're really not going to see an actual cost increase at the mine site. We're using the same people, the same equipment. We're just having more ounces produced. And that goes back to the previous operator not being a mining savvy group. They were looking at this for various different reasons. Our team has gone in there and is now looking at utilizing the high-grade open pit. We're looking underground. We're looking at heap leach operations, which is exactly what you see at the neighboring mines at Cerro Moro, which is now owned by Pan American, Cerro Vanguardia, which is owned by Anglo American. And both of those assets over the decades of operation of Cerro Vanguardia grew from a very modest mine to what it is today, which is multi-hundreds of thousands of ounces of production over the course of 20, 30 years. So we expect over time, as we continue to explore, we'll continue to grow that resource base and fully utilize both the low-grade and the high-grade material that's there.
Interesting. So your operating leverage far offsets any inflation that's still in the system.
Yeah, at this point in time, yeah.
Great. Now, you mentioned quickly the quality of your management team. I wanted to dig into that a little bit more. You guys, I looked at your history. You have an incredible history of success across precious metals and industrial metals. What do you think are the team's key strengths that allow you to keep succeeding over and over? Because, everyone can get lucky, but to do it more than once shows that you really know what you're doing.
Well, I think a big part of it is keeping the team together. So everyone knows their weaknesses and their strengths, and we're able to utilize that, in a very positive manner. As I said, the team really started back better part of 20 years ago in the Desert Sun when they acquired the Jacobina asset, turned it around, sold it to Yamana for roughly $700 million back in the day. We were able to bring that team back together for the Largo mine back in the early part of the 2005, 2006, and the team has kind of stuck together ever since. I've always had a little time off in between ventures, but really the team has stuck together, and I think that's a big part of it.
It sounds like you guys are straight out of The English Patient, romantic in the desert, finding the gold and the silver. It's bringing a tear to my eye.
We like what we do. We're not really fixated on commodity specifics in the sense we want to make money. And at Cerrado Gold, the board and the management team owns roughly a little bit under 40% of the stock. So we're very much incentivized to get this thing going the right way.
That's great.
Yeah, that focus on just cost and return is it's very unique, right? It really just what you need to do and get it done, and that's the type of IRRs that you're seeing in your project.
Yeah, and we don't shy away from commodity. If the opportunity is there, the project is good, we'll continue to look at other things. Obviously, Cerrado is primarily a gold vehicle right now, but who knows what the future holds.
Yeah,
got it. Now, it looks like you traded a significant discount versus peers on a net asset value. What do you think are kind of the key milestones that could close that gap?
Well, I think continuing to get out and talk to various people and institutions. Unfortunately, with such a tightly held share structure, the volume and liquidity is a little bit weak. But also, the story is relatively new. We've only been public now for just under 2 years. Just under 2 years. So we're really not that well known in the market. A lot of the other stories have been out there for the better part of a decade, have a following. So it just takes a little bit of time. And I think right now we're in that typical development cycle curve. Everyone's waiting for the numbers. So what are the feasibility numbers? How close are they to the PEA? And then how are you going to build it? So I think if the project numbers in the PEA in the feasibility are even close to the PEA, we don't see any trouble financing this project.
Great. Now, maybe to round things off, as for everyone watching, they're like, all right, if I'm following you guys, what should I be looking for next? What would you say are the important milestones or catalysts that we should be watching for?
I guess the key ones will be in Brazil. We'll probably get the feasibility study, as I said, by the end of May. We should get what's called the preliminary license, which is the license to continue the process. Then we will go through the engaging and talking to various funding parties. That's already going on in the background, but clearly they want to see the feasibility results as well. And that'll be the key catalyst, I think, to drive that the value really is there. And I think as we continue to see the performance in Argentina continue in the background, that's a nice differentiator from just an exploration co. We have exposure to today's gold price as well as the future.
Great.
Fantastic. Cliff, thank you so much for a great overview of a very exciting opportunity. That's Cerrado Gold, a low-cost gold producer. Big IRRs on that with multi-million ounce potential. A partner of Grizzle Commodity Conference. Thank you so much, Cliff. Appreciate you joining us.
Thanks, Cliff.
Great. Thanks for having me on today.
Thank you.
All right, Grizzle Commodity Con, we keep on rolling. Remember, subscribe. If you're getting some value out of this and you see who's coming next, we got some more oil and gas guys. We got mining. There's going to be a lot of insights. Make sure you share with a friend so they don't miss out on the opportunities here.
Yeah, exactly. So we've got a unique story coming up next. If you like yield, dividend yield, stay tuned.
All right, everybody. Welcome back to Grizzle Commodity Conference. Keep on rolling. Next, we're joined by a longtime commodity producer. They've been producing copper for over 30 years and without a mine, so very interesting. We're excited to be joined by Aurora Davidson. She's CEO of Amerigo Resources. Aurora, thanks for being with us.
Thank you. Thank you for chatting with me again.
So Aurora, for those viewers who may need a reminder, do you mind giving our audience a quick refresher on Amerigo's business model?
Absolutely. Amerigo has a 100% owned operation in Chile, which is called MVC. It produces copper and it also produces molybdenum as a byproduct from the waste material of the world's largest underground copper mine, which is Codelco's El Teniente mine. By recovering this copper, Amerigo essentially eliminates the world's need for a mid-sized copper mine. We have been doing this since 1992. We have a simple and proven technology and a very streamlined business model where we sell the copper and the moly that we produce at market prices. So in other words, we provide our investors with full exposure to copper and moly prices. We have predictable operations and therefore we have predictable cash flow. And just to end up on that description, because we do not need growth capital, we are able to return capital to our shareholders through a multi-pronged return of capital policy.
Okay, great. That's very interesting. So I saw you exceeded your production guidance for was the third year in a row in 2022. So in your view, what are the keys to your operational success?
The key to our operation success is planning what we will do, how we will do it, and also thinking about what could go wrong as we try to do it. We look at these variables constantly and we have a very well-defined list of objectives that we need to achieve in the year. So we have this in front of us at all times. You mentioned production. For example, in 2022, we produced 64 million pounds of copper compared to a budget of 63.4 million. We focus not only on a global list of meeting production targets, we have monthly goals, we get a daily production report. So if something is coming out of line, we know it quickly and we can adjust quickly. For example, another element of 2022 was inflation. Everybody will remember 2022 as a highly inflationary year, but through this attention to detail, we were able to keep our costs under control and our cash cost was only 2% over budget. So this may sound like a boring answer, but the key to our successful operation is careful planning, not having distractions, and having daily attention to detail.
I like boring answers. In mining, boring is always good. So next, I wanted to ask you about the waste tailings that you process to produce copper. They come from the El Teniente mine. That's one of the largest copper mines in the world, if I'm not mistaken. So what gives you confidence this mine can continue to produce tailings in the years to come? And does Amerigo have access to the tailings from El Teniente for the life of mine?
That's a great question. And you're right, El Teniente is a significant mine. It is the mine from which we get our material. It is the largest underground copper mine in the world. But let me give you some dates. El Teniente began operations in 1905 and has not suspended operations since. It has a current life of mine projected to run to 2082. So when you look at those dates, this is quite critical. There is no question that El Teniente can continue producing tailings for longer than you or I essentially will live. And now, the second part of your question was how long do we have access to those tailings? Right now, our contract runs to 2037. Originally, the contract expired in 2021, and years before it was set to expire, we extended it by 16 years. So we expect a similar extension to occur as the contract continues to evolve and we get closer to that termination date.
So now I want to move to your dividend yield. It looks like right now you have about a 7% dividend yield. That's the highest it's one of the highest in the copper mining universe, small cap, mid cap, large cap. And that's even though you have more cash than debt and you have low leverage ratios. So that makes it unique from our perspective. Do you have an opinion on what it will take for the market to start bidding your yield down in line with everyone else?
That's also a very good question. Thanks for asking that one. We started paying our dividends in the fourth quarter of 2021 and have now paid 6 consecutive quarterly dividends. So we have started building a foundation and the company is starting to be known as a company that pays steady dividends. I think this is a critical quality element for yield investors. No one goes into a dividend paying company that may run out of steam and be forced to reduce or suspend the dividend. If you look at 2022, for example, it was a year with high copper price volatility and falling copper prices. Irrespective of that volatility, Amerigo was able to weather the storm and still return a healthy amount of capital to shareholders. So that ties into the question that you asked at the beginning of our chat. Amerigo is starting to be known for operational excellence and financial strength as our return of capital strategy unfolds. The market is recognizing that. In 2022, we outperformed many of our peers, particularly mid-tier copper producers with respect to share price performance. So I think it is a question of establishing that quality and that predictability that's going to do that jump on share price to equalize our dividend yield to a more attainable level.
So the way I read that is that you've set the dividend at a level that you believe is sustainable, and then you'll build off of that as you go through time.
Correct. That is correct. But I also think that having a consistent dividend in it, and also the other tools that we have on our capital return policy, which are the performance dividends and the share buybacks, is starting to be recognized by the market and pushing our share price forward.
Now you almost answered my next question. On performance dividends, which you did pay last year, you recently commented that you expect to be able to pay performance dividends on top of your regular dividend based on where copper prices are year to date, around $4 per pound. So what copper price is the minimum you would want to see to be comfortable paying out special dividends? And do you have an expectation of paying out special dividends this year?
Look, performance dividends will depend on various elements, and we haven't paid one yet, by the way. One of the factors for performance dividends is obviously the spot copper price. Where are we sitting in respect of copper prices at the current moment? But we also have to look at the assessment of the global macro environment, the copper price outlook, and also the interaction with the other elements of our return of capital policy. For example, share buybacks. Right now, we think that buying back Amerigo shares at the current share price makes a lot of sense. If that were not the case, and we didn't have that additional element of buying shares back in the market, the performance dividend could start at $4 per pound copper, given the rate that we have on our quarterly dividend and the ability of generating a substantial amount of surplus cash at the current copper price environment. So there are a number of elements, but the easy answer to your question is if we didn't have any share buybacks, or if buying shares does stop making sense to us, anywhere from $4 per pound copper is a territory where performance dividends can kick up for Amerigo.
So the way investors should think about this is that when there's free cash flow, it's a decision between buybacks or a special dividend, whatever has the best return for investors.
Yeah, or a combination of both. It doesn't have to be one before the other, right? It could be both, but it's always looking for that opportunistic buyback on the market. In absence of that, the decision becomes quite easy, really, in terms of the performance dividend.
Aurora, just a final question with respect to your maiden first ESG report, which you just released. Could you talk us through the importance of sustainability, and I think just particularly with respect to institutional investors, and just how they view it? And also, I struggle, bigger picture, I struggle to think of a company that's more sustainable than Amerigo, with respect to everything you're doing from start to end with respect to ESG credentials.
Absolutely, and that's why we wanted to show this, Thomas, in a very simple way with a very easy to understand and read scorecard. It's a one-pager, but that one-pager basically is telling you a very compelling story. The first element, of course, is that we're producing copper from waste material. The waste material is there. If no one else was taking care of this material, it would be essentially a mine of copper lost to the world in an environment where the world needs that copper. Then we go into how do we do it? How do we produce that copper? We produce it with clean energy. This is not a plan where we want to have 100% renewable energy in 10 years from now. We already have it. We've had it for 3 years. We have low water withdrawal. We have a great safety record for our employees and our subcontractors in Chile. Our location is essentially almost a suburban mine inserted in central Chile, next to agricultural land, next to vineyards. We're not, an ugly corporate citizen polluting the environment. And we have a very diverse team, right? All of our team in Chile are local. We don't have any expats living there. Our management team, extended management team for Amerigo, is basically comprised of that Chilean team. We have a major Hispanic presence on the management team, women presence on the board and on management, etc. So these are attributes that are there now and that are compelling to investors. Not to substitute performance. I think that investors first look at performance, first look at, this is a business, but if that business has a strong ESG acumen, it provides a significant competitive advantage.
Aurora, great insights there, and clearly investors have gotten the best of both worlds, particularly in 2023, both performance and strong ESG credentials. Thank you very much for being a part of Grizzle Commodity One-on-One.
Thank you so much.
All right, everybody, you just heard from Amerigo Resources, Commodity Con. I think we're not even halfway done, so we're going to keep on rolling. Don't go anywhere, because we're going to have a lot more insights on the commodity space. We'll be right back.
where should I begin?
What's wrong with me?
All righty, everyone. Grizzle Commodity Con, we're back. Powered up, got a little bit of water. That's all we need to keep going. But again, remember, this wouldn't be possible without our sponsors. We got to give them a quick shout out before we talk to an investing legend.
Yeah, so guys, and you know, this is our halftime show, and it's a good one. Leigh Goehring from Goehring and Rozencwajg, a lead partner of Grizzle Commodity Con, along with the great green chicken Doomberg, and of course, Sprott Asset Management, the kings of physical commodity investing, and Hill Tower Resource Advisors, a boutique natural resource research firm.
Then we gotta thank Largo, a leader in vanadium, a metal critical to the energy transition. Next, we have Canada Nickel, developing the next generation of low carbon nickel. Dolly, Varden Silver, a precious metals leader in BC's prolific Golden Triangle. And Amerigo, your copper leverage play with a compelling dividend yield. And then we have to thank Anfield Energy, uranium leader in the U.S. nuclear renaissance. Grid Metals, Canada's next great lithium producer. Cerrado Gold, a low-cost producer with multi-million ounce potential. And Summa Silver, American silver, there is no substitute. Last but not least, us, Grizzle, Research and Quant on Substack, sector ideas, commodity insights, stock ideas.
Yes. All right, let's hit it. We got a legend coming up.
Let's get him in.
Leigh.
Hello, my friend. Hello, my friends at Grizzles. It's great to be back on again.
A pleasure, Leigh. Thank you so much for joining us. Always a pleasure having one of the greats, Leigh Goehring from Goehring and Rozencwajg. You guys have done so much work for such a long time in the sector. You guys are really viewed as one of the bastions of insights in commodity investing, energy, and beyond.
Yeah, I've been enjoying your quarterly letters for a while. So thank you guys for sharing your insights with everyone. And I know there's going to be more insights to come here. So I wanted to kick things off with a commodity near and dear to our hearts, natural gas. We've been spending a lot of time in it. I know you've been spending a lot of time in it. Last time we spoke, Adam was very bullish on the opportunity in natural gas. So were you. Are any of the fundamentals driving the current price weakness giving you pause on that view? Or do you think gas looks even more attractive when it's at 2 versus when it was almost touching 10?
No, in fact, nothing has changed in our viewpoint on our bullish outlook towards natural gas. It's funny, we wrote that big, huge paper back, I think, in the first quarter of 2022, where we outlaid our thesis that we were going to see a convergence of North American natural gas prices, which were basically, say at the time, $3 or $4 an MCF, with international gas prices at the time were close to $50 an MCF. And we outlined all the underlying fundamentals, why that convergence trade had a very high likelihood and probability of taking place within the next year. And of course, one of the things that happened is that, it started off okay, and gas prices rose all the way from, that, like I said, $3 to $4 an MCF, and they almost hit $10 an MCF in August of last year during the hot summer. And we got a lot of people say, "Oh my God, you guys are brilliant! You guys are brilliant!" It's like, why don't you have 100% of your portfolio invested in natural gas equities, things like that? And we said, well, there's always there's a lot of things that are outside our control that could very well negatively influence the natural gas markets, and we always have to take those into considerations. And actually, two things actually happened since we wrote that original piece. First is that the Freeport LNG facility in the Gulf Coast, which has the ability to export 2 BCF per day of natural gas, turn it into LNG, had a fire back in June of last year, and they had to shut the facility down. And this facility has been shut down basically over the last 8 months, and it's back up and running now, if you believe the reports. Now, what's interesting about that, you lost 2 BCF of demand. That is actually going to influence natural gas balances over the next year if it's offline that year. And I'm going to bring back those numbers in a second. Second, we had a very warm overall winter here in North America. We did have a couple very short cold spells, and the western part of the North American continent was very cold, but the eastern part was very, very warm. In fact, looking at my NOAA heating degree population weighted models, I think that the winter was actually about 12% warmer than normal. So on average, so it was a warmer than normal winter. Plus you had almost a record warm winter in Europe, which put a lot of negative feeling towards international gas prices. And I know we'll talk about international gas markets and the LNG in a second. But what happened is that it definitely, between the LNG export facility fire and warmer winter weather, this past winter, you were able to actually loosen up the gas balances. And of course, prices, which almost hit $10 an MCF back in August, are now back a little just over $2 an MCF. First is that this is a great buying opportunity. Everything that we wrote back about a year and a quarter ago is still in place. And I'll talk about that. And you have on top of that, every person, every hedge fund is wildly bearish natural gas right now. And they're short the equities, they're short the natural gas futures. And so we are now in a perfect position for that convergence trade to potentially take place the next year. Now, what's so interesting is that when that Freeport plant went offline back in I think it was June 7th or something like that last year, U.S. natural gas inventories were about 325 BCF below 10-year averages and a little bit less than that versus 5-year averages. Now, since then, like I said, we had a hotter than normal summer last year, but we've had a much warmer than normal winter this year. As of right now, we are only about 225 Bs above. 125 Bs above 10-year averages. We're only a little bit above 5-year averages.
Okay.
Adding those two numbers together means that we have added about 450 Bs of extra storage since Freeport came online. If you take 9 months times 2 times 9 months times 30 times 2, that I think that gets you almost 500 Bs. The Freeport outages explained almost all the inventory increase. So Freeport's back online. Yeah, that's no one wants to even look at those numbers. Right. But Freeport explains almost 100% of the inventory increase that we've seen over the last 9 months. And so the thing is, now Freeport is back online. So that's good. It's gone from big negatives, it's going to go to a positive. And if we have we don't know what's going to happen to weather this summer. My gut feel is that if you're into persistency weather models, we've had a lot of hot summers. We're going to have another hot summer this year. So you're set up for a significant tightening in natural gas balances between now and in year end. And that's your first bullish data point right there. The second is that what's going to happen in 2024. There are 3 new LNG facilities that are going to come on in starting in basically the first and second quarters of 2024. First is the big Golden Pass LNG export facility, which is basically run by Exxon. That's going to add 2 BCF a day by the end of 2024. Then you have the Corpus Christi Stage 3 expansion. That's going to add another, I think it's 1.5 BCF of LNG capacity. Again, that will be fully on by the end of 2024. And then you have the Plaquemines brand new LNG facility, which is going to add another 1.5 to 2 Bs a day of exports facility. So the thing is that you're going to be adding another potential up to 6 Bs a day in the next year and a half on LNG export demand. And so that's another positive thing. Now, one of the other things is that people don't want to talk about is that our theory on convergence is based upon that two of the 3 great natural gas producing fields in the U.S. here are in the process of plateauing and should begin a rollover process in the next year to 2 years. Most prominently, the Marcellus. Remember, the Oh, and I want to step back here too. Remember, don't forget that never before has U.S. gas production been so concentrated in so few fields. Just 3 fields in the U.S. constitute about 65% of U.S. production, of which by far the biggest is the Marcellus. Marcellus is producing 25, 26 Bs a day, and that's represented about 25% of U.S. dry gas supply. We believe that the Marcellus, it's plateauing right now. People don't want to admit this. It's plateauing right now. People say it's plateauing because there's a lack of pipeline export capability out of the Appalachian Basin. That is not true. You look at all the 5 companies that produce Appalachian production. Each one is down over the last year and a half. So that's what Range Resources would say. They would say, we are beginning to see for the first time pipeline capacity being freed up. So the thing is that it's plateauing right now, and based upon our modeling, which you can go back and read all our stuff, we believe that the Marcellus is tracing out the same production curve profile that the Barnett field did in 2011, 2012, and what the Fayetteville field carved out in 2013 and 2014. Now, remember, today, both those fields are over 60% below their peak productions. And we believe the same thing is in the process of happening in the Marcellus right now. Marcellus has been plateauing for a year and a half, bumping around between 25 to 26.5 Bs a day. And we believe that the rollover could happen at any point. The other field is the Haynesville. You remember the Haynesville produces about 13% of 13 to 14% of U.S. gas, and it's still growing. But our analysis says that the Haynesville will enter its plateau phase sometime in the next 6 months, and so those 2 areas of gas supply, which have been primarily responsible for the massive surge in gas supply over the last decade, are both in the process of going away as a source of supply, and that only leaves the Permian. And what's interesting, for those that like to follow us, we're going to be writing a huge essay piece.
Ooh, I like the word huge.
Yeah, on the Permian Basin, and the idea of when the Permian Basin too will plateau and begin to roll over, because the Permian is that represents I think it's maybe 16% of U.S. gas supply right now, and it's not a gas field; it's an oil field. That's all associated gas. But what's interesting about the Permian is that the Permian's gas production on a year-over-year basis is up about almost 20%, and that is much higher than the oil production, which is only up 600,000, which is up about 12%. And what's interesting is that the reason why the gas production is surging is because that's another sign of field exhaustion in the Permian. And the idea is, as a field, the total reservoir pressure of fields drops, you will produce more and more gas. Your gas to oil ratio will increase. And we're seeing that big time in the Permian today. And that's another data point that's emerging, that the Permian is getting pretty close to reaching a plateau phase. So
whenever there's not more oil wells being drilled, you would expect that if they're just producing, say, from their old wells, the gas cut is going up, and so you'd have gas production increasing.
The gas cut goes up not only in your old wells, but it also goes up in your new wells, because you're drilling into sections of the reservoir that have slightly lower pressure than what they had before, and that allows the oil to liberate itself from the oil as it comes up pipe much more easily. So the thing is that you will definitely, over time, as the field ages, it will become gassier and gassier, and you are seeing that hugely in the Permian today. So again, the Permian still is going to be a source of gas supply growth over the next year, but the Marcellus is done. The Haynesville should enter plateau phase anytime in the next several months, 6 months, and the Permian still got a ways to go. But in the next year or so, we're going to see potentially the Permian begin to plateau as well. So the thing is that you've got 6 Bs a day of new demand coming on, and you're going to begin to severely crimp supply going into the next year. So I think convergence is going to happen. And even today, the international gas price is about 13. So
It's Leigh, you've really laid it out in a very clear, quantitative way to think about it. So many the levers with respect to Freeport coming back on, the Marcellus. We obviously look forward to that Permian report. Anyone who's listening, watching, that was just an incredible breakdown of how you want to look at thinking about natural gas. That's just like, from a quantitative perspective, Garen Rozencwajg throws down.
Yeah. So that was a really great overview on the supply side. I wanted to ask a question about the demand because we're talking about, has anything changed even though the price is 2 versus 10? Now, I'm wondering, do you think that if the longer prices stay at 2, are we going to see more LNG facilities in the U.S. end up taking final investment decision? And that means demand for gas will be even higher in the future than it was when prices were at $10. Do you have an opinion on that?
I suspect that it takes so long to get both a permit and then a final investment decision on a project that, yes, there are a number of projects that are online in the post 2025 period, which is going to add another, I think it's 4 to 5 Bs a day. I mean, we're talking by the end of mid part of 2027, 2028 to being close to 20 Bs a day of export capability. So you don't need a new generation of export facilities to basically overload the system with new demand. I mean, it's pretty incredible when you think about it. Pre-2016, the U.S., other than the small plant up in Alaska, U.S. exported no natural gas. Now we are by far the world's largest exporter, and we're going to increase that lead going forward in the next 5 years. So we don't even need any more new plants to be announced. We've got enough in the pipeline right today to basically overload the system with demand.
Yeah, that's part of why we are bullish on natural gas as well. Now, can we move across the pond to Europe? Based on what you're seeing, do you think is Europe out of the woods for the coming winter, or is it really still weather dependent based on decisions they've made since they got bailed out by the weather this year?
No, it's the global gas crisis has another leg left to run with it. Now, remember, on a very broad basis, looking at the whole world, the whole world is structurally short natural gas supply. And there's a couple reasons for that. But the biggest reason is that we are in a period of developmental history in a huge number of emerging markets where their natural gas demand is going off the charts. And the reason it's going off the charts is a phenomenon that some of the big LNG consulting firms have never quite understood. Although I should point out that some of the big LNG production firms like Shell Gas really does understand. And that's that when you're poor and you're trying to get rich, one of the ways you generate a lot of electricity is you burn a lot of coal. Why do you burn a lot of coal? Because it's really cheap. It doesn't require minimal. You have to transport it, but it requires no storage. It requires, all these very, very minimal things, and you just throw it into a big, huge boiler, and you boil water and turn it into steam. Very, very cheap. However, there's a lot of externalities that are associated with coal. Huge amounts of air pollution. And anyone who's ever gone to China between like 2000 and 2020, you just look up at the sky and it's brown. And why is it brown? That's all because of burning of coal. And so as you get richer, however, you don't want to live in a degraded environment. You want to go out and see a blue sky. And so what you want to do is you want to change your fuel mix. You want to go away from burning coal, which is very, very cheap, and you would like to burn something that has a lot less externalities associated with it, and that's natural gas. But the problem with natural gas, it's not a solid, it's not even a liquid, it's a gas, and it requires a huge amount of infrastructure to transport it, to store it, and use it. And so it's something you don't consider when you're poor. However, when you get richer, you begin to switch over. You start burning a lot more gas and you start burning less coal. And we've gone back and modeled every emerging market in the post-World War II period, and have a model that where you are at certain per capita levels of GDP, where should your fuel mix.
So Leigh, actually, just on that point, you kind of took the answer. So where China is right now, is that per capita GDP inflection point, and India, I guess, would be the next. And we're hitting those key levels. Is that fair to say?
Yes. In China actually, basically the levels start when you get past like $2,000 to $3,000 of per capita GDP. That's when you begin your switch over. And what's so interesting about China is they're about $10,000 to $12,000 of a real per capita GDP. They are way behind what our models say that they should be as far as switching over from coal to gas. And of course, they've talked extensively about wanting to burn more gas, but it just hasn't been available on a global basis. And, a lot of it occurred because of Fukushima, where, obviously Japan had to re-enter global LNG markets to make up for all the lost nuclear power that happened when they shut down their 50 operating nuclear plants and never brought them back online. And so there's been this structural shortage of gas. And so China is way behind where they should be. And I don't have all the models in front of me. I could tell you, we've written about it before. And what's so interesting, it's not only, China's gas demand needs are just going to increase and increase and increase going forward. And what's interesting is China's demand needs are now going to be met by India. And India has already said, I believe that India today, that natural gas represents 5 to 7% of their fuel mix. And of course, their coal consumption is growing very rapidly, unfortunately. And they said they would like to get that up between in 2030 up to 10 to 15%. Now, that's going to be extremely difficult, but that's the type of switchover that happens when you become a middle-class income country, which India now aspires to. But look at countries like the Philippines, look at countries like Vietnam, look at countries like Bangladesh, look at countries like Pakistan. They're all building LNG importation facilities. They don't have an internal LNG source of supply. They are planning on importing natural gas to accommodate this fuel switchover. And so what happens is that any LNG supply, whether the new Qatarian projects come on, West Africa, and someday Mozambique, things like that, that is going to be absorbed immediately. And so the thing is that they'll, depending on weather, we'll go through periods where the natural gas will be priced way above the price of oil, and there'll be times when it'll be priced below. But from here on out, all natural gas supply gets absorbed. And the thing is that Europe is going to be competing for natural gas supply against the structural shortage that exists in the rest of the world. Now, Europe, what did they were so desperate for gas last summer. What did they do? European natural gas prices peaked out at almost $90 in MMBTU. That is that's equivalent to almost $600 per barrel oil. That's how desperate they were to fill their natural gas. And that price, that was significantly above the world price. They bid that gas away from everyone else. We're going to find out that that we could wind up again them getting in a bidding war with the rest of the world to fill their storage by the end of the year. Everything looks good now. We're in a great situation where Europe burned a lot of wood, burned a lot of coal. Their CO2 production now has made an all-time new record high. Thank you, renewables, for all the contributions you made. And the thing is that they still are going to have to really worry about their gas supply going into the coming year. And of course, if they do have a cold winter, then all bets are off for what could happen.
Leigh, this is an absolute masterclass in understanding the global dynamics of natural gas. We used to always do Goehring and Rozencwajg as the closer, so we could just have an open-ended close. And honestly, we could go on.
We may have to bring it back because there's always so much to talk about. We'll have to, you guys will have to help us bookend things.
Yeah, Leigh, I can't thank you enough for your time and we got California Resources coming up next, but Leigh, always a pleasure. For those who want to find some of the highest quality commodity research, go to GoRozen.com. That's where you'll find Leigh, a longtime friend of the Grizzle family, Chris Wood, Grizzle. Thank you, Leigh. Really appreciate your time.
Thanks,
okay, well, thank you very much, my friends at Grizzle, and I really enjoyed being on here, and enjoy helping form an investment opinion among your listener base. So
appreciate it.
All right, we'll talk to you soon.
Okay, very good. Bye bye.
All right, everyone. Coming up next is a spinoff from Warren Buffett's favorite oil company. So we have California Resources coming up next. Don't go anywhere. We'll be right back.
Welcome back, Grizzle Commodity Con one-on-one. The big show continues. I hope you guys caught that Leigh Goehring. That was a masterclass. If you haven't, watch it after the whole show is done. Rewind, watch. But right now, we got a fantastic guest, Scott.
Yes, we have Francisco Leon. He's the new CEO of California Resources, one of the most interesting companies in the oil space. They were a spinoff a number of years ago from Occidental. They're doing very interesting things, kind of pioneering a new industry. So we're excited to have Francisco with us. Welcome.
Thanks. Really excited to be here. Look forward to the interaction and loving the Grizzle platform. So let's get started.
Thank you.
So Francisco, you've shepherded California Resources through a pretty volatile time in energy markets, and so well-deserved promotion to run the company now here. Maybe just to kick it off for people who don't know your company very well, could you give us a brief overview of your assets?
Yeah, absolutely. Happy to do that. So California Resources, it's an independent energy and carbon management company. We're fully committed to the energy transition, a transition that should take time and should be done in the right way. I think we need to be very thoughtful about the things that we have and the benefits that the energy today gives us, and not rush into something that's going to put us behind and get us into more expensive, unreliable energy. So we're driving that from a California-only perspective. So in terms of our legacy oil and gas business, it's a very low carbon intensity production. This is third-party validated. If you compare the oil and gas that we produce in California, that's going to be already the lowest carbon intensity, and we're looking to make that better. We're looking to actually get to net zero. Certainly, we're looking to maximize value for our shareholders as a publicly traded company, and we're doing that by really leveraging off our assets, oil and gas assets. We're one of the largest landowners in the state of California. We also own a lot of the minerals. And we're pushing to decarbonize not only the oil and gas sector, but in industry as a whole in the state through carbon capture and sequestration. So we're looking for emissions in primarily third-party emissions. We want to provide solutions to the state of California who they have their own net zero objectives. We think oil and gas companies, we think CRC is the natural company to push that business forward. We have the assets, we have the pore space in reservoirs that we're repurposing from oil and gas operations to permanent sequestration. So we're excited about that. So on the oil and gas side, low decline. This is not a shale company. You probably talk to a lot of shale companies. Definitely that's not CRC. We're low decline. We're conventional. It's about recovery factor. It's not about the IP. It's about drilling efficiencies in investment. It's about getting as much oil and gas out of the ground with the least capital that we can. We have about 90,000 BOEs of production. That's oil, gas, and NGLs. We have a very large midstream infrastructure. We own a power plant at Elk Hills, our largest field. We have a trading business, a real estate business. So we kind of do it all. It's a nice integrated company. One of the largest owners of land in the state. And we're pushing this carbon management business through Carbon TerraVault. Carbon TerraVault is an unrestricted subsidiary of CRC. That's the entity where we're doing all of our decarbonization strategy. So overall, the company looks very healthy, strong balance sheet, very high cash flow. We're returning a lot of cash to shareholders through a fixed dividend and through a buyback program. And we have the leading California leading carbon management business with a very good strategy to get to first injection by 2025. So we kind of do a little bit of a lot of things all in the energy spectrum.
Let me drill into each of those, a lot of different things you're doing here. First off, when I was looking through your deck, what really caught my eye is you have a 3% dividend yield today, and you're going to generate between 12 and 16% free cash flow yield if oil is $80 or above. And you're planning to buy back more than 20% of your stock. So you're doing all of this with declining production, which I thought was interesting. So especially if they don't know your company, what do you want CRC to offer investors? What should we expect from your company over the next few years from a capital returns perspective?
Yeah, and more of the same. We think the value proposition is really exciting. The stock is it's interesting. I went through all the things that we do. And it's a particularly interesting company. You have a lot of companies in the oil and gas space that they own leasehold, right? They lease land, they drill the wells. Their primary asset is just the reserves that they're either pulling from the ground today of oil and gas or future opportunity to get more oil and gas down the road. CRC has that. That's a key component of our business, no doubt about it. But we have all these other assets that we can do extract the value and do a nice return business. That all comes together in the form of very good free cash flow. As you pointed out, the yield is good, but the valuation of the company, again, publicly traded, CRC is our stock symbol. We trade as if we were an oil and gas company only. So we don't see the value uplift to all these other verticals, all these other exciting things that we're working on. So we're focused on generating that value, and we see a lot of that through the buyback program because, again, I think the value of the sum of the parts of our business is much higher than where we trade today. So therefore, I'm going to try to buy back as many shares as I can of the company as we take a lot of that cash flow and take it to buy back as much of the company. We bought back about 14% in the last year and a half. We're going to continue doing that. So very focused on shareholder returns. We see more value in buybacks, but we also have, as you said, a fixed dividend. You're not going to hear us talk about variable dividends. If we have extra cash, we'll do it to buy our stock, given the price point that we have. Right now, as I'm taking over, I take over as CEO at the end of April, focus on savings, right? So can we right-size the company? Can we take some cost out of the systems? I'm targeting $25 to $50 million of run rate savings, have a lot of really good participation from the teams, looking to see if we can do better as a company, doing better as a business. We're targeting $450 million of free cash flow for the year. So that should continue. And again, it's about delivering a differentiated strategy with a differentiated return policy. In terms of CCS, carbon sequestration, it's really interesting. We've been at the forefront of pushing this business, this initiative in California.
And right? You've been instrumental in building the business too internally.
Yeah, you can say key architect or one of the key architects. Our current CEO, Mac McFarland, and I started really honing in on this strategy. It's interesting. You mentioned earlier, we're a spin-off from Oxy. And in fact, Vicky Hollow, the current CEO of Oxy, was my boss when we were together. And we've been looking at doing CO2 projects from decades ago. So it's not a new concept. We're not trying to do something that's kind of novel in terms of injection of CO2 into our reservoirs. We've been planning for this for a long time. But the change in the strategy was to have a business that's taking the emissions out of the air, capturing its anthropogenic capture of CO2, using our depleted reservoirs, but doing permanent sequestration that's not tied to oil, right? So this completely bypasses the oil production aspect of a business, and we're going to store those emissions in permanent caverns, and we're going to seal them off. And basically, that's the way to help decarbonize the industry. So we kind of shifted gears. We brought Brookfield as a partner, a Canadian, one of the largest companies in the world in terms of investment. They're co-investing with us in unlocking the value in this space. And we recognize that ultimately, there's different costs of capital, different pools of capital, different interest levels. In an energy transition, there's investors that want to leave behind the legacy oil and gas business. They're looking at the exciting growth opportunities of CCS. There's still very much investors that like the returns and the cash flow in the oil and gas business. So we're looking at the right way to combine that. But the strategy to launch Carbon TerraVault started 2 years ago. We sent in permits with the EPA, eagerly waiting for those permits to be approved. We expect those to be done, at least in draft form, later this year. And then we're going to be off to the races to inject carbon in a few years. Hey, I'm not hearing the question. Can you hear me?
Oh, sorry. My apologies. We muted ourselves. So I have an existential question for you here. Given the legal challenges in California, would you say maybe when does it get to the point where the best way forward for shareholders is to say we're going to operate the E&P business in blowdown mode, return cash to shareholders, our stock is undervalued, we're going to buy back shares, and put that into the carbon business, which we think has a bright future? For you in your decision making, when does it get to that point where you say, I think really this is the best way forward?
Yeah, no, it's a great question. Not a believer in running a business to blow it down. I think we have a lot of resources, but let's take a step back. So California is the fourth largest economy in the world, right? If California decided to separate from the US, maybe some people want to separate California from the US, I don't know. But if they were the country of California, it would be the fourth largest economy, bigger than the UK, bigger than Germany. It's a big economy. It's a big industrial state. I mean, people associate Hollywood stars, the Lakers, the Dodgers. It's big industrial centers, not just the tech world either. In the big port of Long Beach, where if you had a gift that never made it home during the pandemic, it was stuck in the port of Long Beach, no doubt. A lot of the products come from around the world to the port of Long Beach. So it's a state that has a lot of industry. There's a lot of emissions as well, and there's a lot of needs for our products to help ultimately decarbonize. The state needs us to be successful. And when you talk to the regulators, they have the California Air Resources Board, as an example, who the governor of California kind of tasked on setting up the policy and the strategy over multiple decades. In their latest scoping plan, they have 2040 is still very much oil and gas being produced in California. So our view is the state still needs that production. So the question is, do you develop it in-house or in-state, or do you import? California has been importing more. 70% of the oil, 90% of the gas gets imported into the state. So California is becoming an energy island. And it's, we talked about I think the prior speaker was talking about how the Europe dynamics, where they're burning coal, they're burning wood, because they've also created kind of, they isolated themselves from developing the resources internally, so they're dependent on imports. Energy security is key, right? In a place like California, we need to develop that resource locally, and we have it. And again, it's the cleanest form of oil and gas. They do, obviously, there's going to be an impact to burning oil, to burning gas, but that's what we're working on our CCS business, to lower that and get to a net zero. So the state needs our production. The state needs us to be there. So when we talk about a blowdown, the blowdown basically says it's better to import than to develop it locally, and all the benefits that the state gets from tax, from jobs, from, again, delivering the very clean energy that's under the regulation and the supervision of the state. To me, it's pretty obvious we need to increase that local production. Oil, gas, power needs to be developed in California, and that's what we're pushing for, is to basically, it's not about blowing it down and leaving it behind. The state needs it. It's about domestic, local production versus imports, and I think we have the winning strategy there.
That's a great explanation for your thinking on that. Thank you. So, Francisco, Leon, we've really enjoyed talking with you. Unfortunately, in this venue, there's always way too much more to talk about than you can really get through, but we'll be watching you guys closely, and congratulations on your promotion, and best of luck in your success at CRC.
Thanks, guys. Really appreciate the invite. I look forward to connecting again.
I appreciate that. Thank you.
Take care.
Guys, the train keeps going. We got Crescent Point up next. Don't miss it. Retweet that. Hit the like. All that good stuff.
All you guys.
Minutes away.
The oil train's rolling, so we'll be right back in a minute. All right, everyone, welcome back to Grizzle Commodity Con. We got a little bit of a Brady Bunch situation going on here. You can see all our friends from Crescent Point up here. Thank you guys so much for joining us. We love talking with you and hearing what's going on in your company, so welcome.
Appreciate you having us.
So, Margaret, maybe you want to kick it off.
For sure. Just starting off, could you guys give us a brief overview of your company and your assets and both your roles here at Crescent Point?
Sure. Yeah, I can kick it off here. Maybe I'll start off with just a brief overview of the assets, and then we can get through maybe our background. So size-wise for us, current production guidance for us this year in 23 is about 160 to 166,000 BBs per day on an annual average basis. And that's going to generate for us about 1.1 billion of excess cash flow at a $75 price tag. Now, keep in mind, that's relative to our current market cap of 5.6 billion. So pretty significant free cash. At the end of March, we announced an acquisition of some Alberta Montney assets, which closes here next month. And for us, that pro forma run rate will be closer to about 180,000 barrels a day moving forward. But when you think of the asset mix, we're essentially in three main areas. We got about 15 years of premium drilling inventory with additional locations beyond that. But the mix is in central Alberta, which is about half of our pro forma production. That's comprised of our Kaybob, Duvernay, and Montney assets. That provides us a combination of free cash flow and long-term growth. Our Saskatchewan assets, which represents about a third of our production. And really, this is a cash cow for us that generates significant free cash over a 10-year plan. And then lastly, North Dakota Bakken, which is about 15% of our production. I'd say also in terms of our asset mix, we're about 75% oil and liquids, which is pretty unique when you look amongst the peer group. And that allows us to have one of the highest netbacks or cash flow margins when you think about it within North America across the peer group. So When you think about it indirectly, when you combine that with our return of capital framework, where we give 60% of our excess cash flow back to shareholders, that's a pretty compelling return of capital yield and proposition. As far as our backgrounds, I'm Vice President of Capital Markets, been with Crescent Point for about 9 years. I look after our investor relations, ESG, and stakeholder relations functions in the company. And then Justin, I'll pass it to you.
Sure. Thanks, Shawn. Justin Foray, Vice President of Engineering and Marketing. I've been with the company for close to 15 years now and am responsible for all the corporate drilling, completions, development, and marketing activities here.
Great. Thank you, guys. So you just announced a significant acquisition of oil and liquids-rich assets in the Montney play in Canada. Can you just take us through why these assets make sense for Crescent Point?
Yeah, thanks for the question. Yes, this deal is definitely one we're excited to talk about, and one that we think will fundamentally re-rate both our business and our outlook. It was a very strategic acquisition for us, and for anyone who's followed our story the past 5 years would have heard us talk about our two key pillars, balance sheet strength and sustainability. And this deal checks both those boxes for us. By the way of sustainability, this transaction was accretive to our asset portfolio by bringing in around or over 20 years of premium drilling locations that are top quartile in our inventory. As for our balance sheet, it was accretive financially by increasing our excess cash flow per share by 20% and our return of capital profile. In terms of the assets and their fit, they're located in the oil window and our oily assets, which is the focus of our company. But more importantly, they align with our defined asset criteria and strategy of focusing on high return assets that have scalability and generate free cash flow and have strong market access and ESG characteristics. Geographically, they're on the Alberta side of the Montney play, and we're adjacent to our Kaybob Duvernay asset with similar attractive reservoir characteristics. And as a reminder, we've been delivering exceptional results in Kaybob over the past 2 years since entering that play, and really like the opportunity set here to transfer some of that knowledge. On top of that, we've identified some optimization opportunities within this asset that we think we can unlock to create value for our shareholders.
And so you guys have been busy acquiring and disposing assets lately. From a high level, how are you attempting to change the asset profile and growth trajectory of Crescent Point with these deals?
Yeah, I can take that one. I think as Justin touched on, everything we're trying to do here corporately, strategically, is centered around our two key pillars, balance sheet strength and sustainability. And that also plays into our A&D strategy. And when we talk about sustainability, Justin sort of talked about that, but inventory depth, your free cash flow margins, your decline rates. And you're right, over the past 5 years, we've been pretty active, but also diligent in terms of how we're trying to transform the portfolio. We're not interested in just getting bigger. We've done about $2 billion of non-core dispositions, and I don't think we're done. We're looking to do more. On the acquisition front, we've essentially done two large deals within the Kaybob and Montney areas with some tuck-ins around it for $3 billion. So pretty good track record of cycling assets in and out. And I think if you analyze most successful companies in our industry, they have a pretty good track record of doing this, and all centered around the goal of enhancing profitability and your per share metrics going forward, which is exactly what we're trying to do and what we've been active here over the last 5 years. So it's not necessarily to get bigger, it's to get better. We've been moving out assets that have high operating expenses, just significant asset retirement obligations, limited scalability, et cetera, and bringing in higher quality assets like the Kaybob and Montney.
Now, I'm hoping you could get me into management's head a little bit. I noticed that since the last time we spoke, you went from having flat 135,000 BOE a day kind of expectations. Now you're trying to get to 195,000 BOE a day by 2027. What drove your decision to switch from kind of maintaining production? Was it what's happening in the market, macro factors, the company, to now you're looking at significant growth? What changed?
Justin, you want to take that?
Sure. Yeah, that's a good question. It's probably worth putting those 2 5-year plans into context. But essentially, we're still targeting a very conservative, low single-digit annual growth rate of around 2%. So since we last spoke, we did a small tuck-in acquisition in Kaybob that took our production from that 135 to 140. And then from that 140,000 BOE a day production, our expectation in our 5-year plan was to grow that production to around 152 BOE a day by 2027, or about a 2% CAGR. Now, post our recent Montney deal, our pro forma production at closing is around 180,000 BOE a day. And we now expect to grow that production to 195,000 by 2027. So again, it's about a 2% CAGR. So for us, still a very disciplined 5-year plan with continued focus on maximizing returns and free cash flow generation.
I get it. So it's similar type growth. It's just you saw an attractive asset, so you jumped on it.
Absolutely, yeah.
Now, I wanted to ask about your capital return strategy. So before this Monty deal, it may have looked a little bit different. While you're paying off the debt that you used to fund the Monty deal, will you prioritize buybacks over hiking the dividend just to give yourself a cushion, or do you think you could see hiking the dividend significantly before that $1 billion of debt is totally gone?
Yeah, good question. So for us, we're a dividend-focused company. We believe in that and having that as part of the overall, capital allocation, return to capital framework. When we think about the dividend, it's got to be sustainable at low commodity prices, and it grows as the business grows. We're not looking for a high dividend yield that we have to grow into or something that would get cut at lower prices. So for us, our current dividend yield right now is about 40 cents per share on an annual basis, close to a 4% yield. When you look at it at a $50 price deck, it's about a 15% simple payout ratio, so pretty conservative. And obviously, we want to grow that. I think for the immediate focus for us, our attention is going to be directed towards buybacks. Just given the disconnect, we think that there is in valuation and the opportunity that's ahead of us. And as we work down some debt here over the next year and continue to work on that through some dispositions and other things, and those shake out, then we'll continually revisit the dividend levels with obviously a goal to increase that. But our return to capital framework that we've put in place prior to this deal and post this deal have stayed the same. We're continuing to pay out roughly 60% of our excess cash flow back to shareholders.
Okay, that's helpful. Thanks.
And so you guys said the dividend is funded down to $50 oil. At what oil price do you believe the dividend is sustainable pro forma for your recent Montney deal?
Yeah, I'd say these two, our base business and the Montney asset that we acquired have similar break evens. So I wouldn't really expect any change from a funding or capital perspective when you include the dividend. And I think in reality, in a $50 world, we probably would see price concessions. We probably would make some adjustments on spending as well. So realistically, I think a fully funded price even below 50 would be more realistic. But all things being said, pretty similar break evens and no change to that overall view of funding down to $50 WTI.
Okay, can I move on to the hedges a little bit? So you've had a significant amount of hedges roll off in the past 12 months. You're now at, it looks like, about 20% hedged. What's the right level for you over the next year, would you say?
Yeah, we think something in the 20 to 30% range makes sense for us. But now after we roll in the Montney acquisition, look for us to position ourselves at the upper end of that range for the rest of 2023. We've been adding volumes lately as prices have strengthened, and our hedged oil volumes now sit closer to 30% in Q2, 20% in Q3, and 10% in Q4. We're adding these volumes using a combination of instruments, swaps, collars, puts, and we'll continue to add in the short term if these prices hang in and as some of the backwardation continues to come out of the back end of the price curve.
Okay, great. That's helpful.
And so last question here. Could you guys just talk us through your highest priority ESG initiatives over the medium, long term, and why, and main ways you guys are going to cut emission intensity by 50% by 2025?
Actually, that target that you're mentioning, that was actually our old target. We had an old target in place there to reduce our Scope 1.
Perfect time to give us the new target.
Perfect, yeah, by 50% by 2025. And that included a 70% reduction in methane emissions. So we actually achieved that 3 years ahead of schedule here in 2022. So since then, we've implemented an even more ambitious target. So our new target is to reduce our Scope 1 and 2 emissions by an additional 38% by 2030. So, we're planning to get there a number of ways. First, continued gas conservation initiatives where possible, where we can reduce flaring and venting, We're implementing detection equipment to further reduce our fugitive emissions. We're installing combustors in areas where maybe we can't tie in and gas conservation is difficult. And then from a Scope 2 perspective, we've also been implementing some solar power in some of our field projects just to move off the grid and rely on some of those solar initiatives.
Great. Well, this is an amazing conversation. Everyone listening, you just heard from Crescent Point. They're one of the leaders in the Canadian oil and gas industry. Shant and Justin, thanks so much for joining us, Grizzle Commodity Con.
Thanks, guys. Look forward to our next conversation.
Looking forward to it. All right, everyone. Commodity Con, we're never stopping. We're just going to keep going. So we're moving. We had our oil and gas moment. We're moving back to some metals. Hopefully you caught some of our earlier speakers because there's been a lot of great insights coming and there's more to come. We're going to, again, take a very quick break and we'll be right back up with white gold. Don't go anywhere.
Dave, how's it going? There's a good friend of the Grizzle here. Grizzle Commodity One-on-One. I need everyone to give the thumbs up, the retweet, the friendliness. The friendliness is happening because we got a good friend of the Grizzle, David Diafrio from White Gold, CEO. How are you, brother? What goes, man?
I'm pretty good. Look, you guys, you never stop impressing me. You pick a day to do a gold conference on like when gold's going to rip through the all-time high here. How do you always so far ahead of the curve? It's unbelievable.
Well, you know what? 3 months of the planning, I said, listen, this is the day, guys. It's a make it or break it day for Grizzle, and we gotta have white gold there just to pop the champagne bottle. So thank you.
My only recommendation, I think you guys need to be wearing a white gold hat.
we need to do a jersey swap, hat swap. We'll kick it off.
So, David, could you give us a history of White Gold Corp and what drew the company to the White Gold District in the Yukon?
For sure. This company here, it's relatively new company. It's only been around for 5 or 6 years, but the history is, let's call it 125 years old. It's one of the most remarkable places in Canada. Just as a bit of a backdrop, we've been investing in the Power One Group in junior gold and multi-metal exploration companies for 20 years now. And this one has really sort of checked all the boxes in terms of what it takes to make a world-class, successful exploration company. In this particular instance, like what's so unique about it, we're in what's known as the white gold area of the Yukon, hence the name. It's also known as the Klondike or the Dawson district. This was the area where 125 years ago was made infamous by the legendary gold rush, right? Guys, went there 125 years ago with little more than a metal pan and were able to discover more than 20 million ounces of gold literally sitting right on the surface in the creeks. You've all seen the pictures of the old-time prospector doing it, but that's real. And that's still, in fact, happening today. And there's shows, it's so unbelievable, like Gold Rush Alaska, Gold Rush Yukon, all these shows, like this is still really happening. Now, here's where it gets crazy. You have about 20 million ounces of gold on the surface. Why has no one gone there to explore for, where did this gold come from, right? Like that's the obvious, multi-billion-dollar opportunity, but nobody did it until about 15, 20 years ago when our partner in White Gold, Shawn Ryan, a gold prospector from Timmins, is like, you know what, guys, like this gold did not come from the ground. It came from the earth. I'm going to go figure out where it came from. And when he got there, he actually figured out why. Like that was our first big question when he came to us, why? And the reason is this area of North America was not glaciated. So most gold prospecting, early stage discoveries are based on finding outcrop, like you see in Quebec and in Timmins. So it's been glaciated, the topsoil's been moved, and now you have these chunks of earth there. The prospectors go with their little hammer, they see some interesting mineralization, they take their chunk, they bring it to the lab. Oh, hey, look, there's gold, there's copper, there's nickel. And that is what they use. But when it's not glaciated, now it's covered in this blanket of topsoil. So you can't see the rock. So people just didn't go, right? Their tools didn't work in this part of Canada, and they just went to where they could work, except for Shawn. Shawn's like, there are other places on earth that have this situation. Let me go figure it out. And he went there. He spent 5 years using soil sampling, also known as soil geochemistry. And he's gone and built the largest soil geochemical database in the world. And through that effort, he was able to identify what correlated in the soil to the bedrock. He identified the mineralized systems. And with that information, we do additional exploration, then partner with other mining companies to drill it, right? At the end of the day, it's the drill that's going to tell you the truth. And within a very short amount of time, his work led to 2 major multi-million ounce discoveries, both of which were acquired by major mining companies. So, it's got all the factors we love. It's got this highly exceptional history of placer mining, shows there's gold there, but it's underexplored. It's in an incredible jurisdiction. Like, jurisdictional risk is always something we prioritize at Power One.
Yeah.
More so these days than ever. You're in Canada, you're in the Yukon. This is an area where the government has put up their flag and say, we want more and more mining and exploration and commodity. That they know there's a ton of value there, to the extent that they're putting up hundreds of millions of dollars between the territorial government and the federal government specifically in support of that. So, those are huge factors. It's underexplored, and we were able to partner with a guy that's been there and basically tied up an entire district. We have over 1 million acres. So now our goal, our dream, and we are actually, making strides, and this is happening in real time, is, we look at this as, let's say you could go back in time and own 70% of Timmins or Val-d'Or or Nevada 100 years ago. What is that worth today? We think we're onto that now. And we're 20 years into that with the work that Shawn's done historically. And today, we've not only have the package, have the prospectivity, but we proved that the gold is there. So White Gold itself has nearly 2 million ounces of gold in its own deposits, high grade, open pit, which is, very few of these types of assets of that size and tenor are around. Plus, we have this incredibly exciting discovery portfolio where, now that we've seen what led to the success, we think we've cracked the code, and we think we're just going to be able to do it over and over again. And we really believe that this has the opportunity to be one of Canada's next exceptional mining camps.
David, you bring up a great point. And Yukon, Margot's going to go to the Yukon. We're sending her up there. We want to see this in action.
Hopefully, I'll get to visit your site. That would be awesome.
No, you have to come. There's no way you can be in the Yukon and not be at our site. It's
in the middle of winter. I suggested. She pushed back and said the middle of the summer. I don't know.
No, yeah, it's and it's gorgeous. That's the funny thing. And people might think the Yukon's remote. You get to Vancouver, you're 2 hours there by plane. It's 29 degrees in the summer. It's beautiful. It's daylight, 23 hours a day. It's an amazing place to work.
So just on this one, Shawn, with respect to with respect to Shawn, and he employs a unique high-speed exploration program to evaluate targets. I'm going to use this quote: "The more targets, the more frogs you kiss, the more princesses you'll find in the end." Very poetic, very beautiful. Shawn is your chief of exploration, is clearly a poet and finds big finds.
This exploration, it's everything. It's a game of probabilities, right? So the more opportunities you have, the more chances you set. And unfortunately, the mining exploration game is a game of bad probabilities. It takes one in 10,000 targets becomes a resource. Think about that. So that's one of the things I love so much about White Gold. Like, we've already beat the odds. We have a resource. It's huge. It's growing, and it's great grade, and it's in a great place, right? So think about that. So people don't, appreciate that fully. Sometimes when something new comes out, it's exciting. The odds are tough, right? It's a very tough business. So when you have success and you have prospectivity based on that success, you cannot, understate that. Like, this company has spent over $100 million It's found the deposit. It's practical, like I said, and to validate what we think we're onto and the opportunity, we've been able to attract two major mining companies as our partners already. We have Agnico Eagle and Kinross. Like, these are some of the best miners in the world. They do their homework, right? So by them putting their money where their mouth is, I think that says a lot. And for investors in the junior space, considering how risky it is, I think to follow the lead of companies like that is a wise move. And just to sort of leverage that, not only do we have those partners, if you look at our little district, which is not little, it's big, in the last 2 years, there's been 5 major mining companies that made investments into that district. Our neighbor to the south is a company called Western Copper and Gold. They have a huge copper gold porphyry. They've been able to attract Rio, the second largest mining company in the world, to put $25 million in last year. 2 weeks ago, Mitsubishi put in another $20 million, right? Like, think about these companies. Next door to them, also our neighbor, Newmont, the largest gold mining company in the world, bought Goldcorp, another Shawn Ryan discovery, for $500 million. They're getting that permitted. Hecla, a large silver company, just bought a company in the Yukon. B2 Gold just made a major investment in Snowline. These guys know what they're doing, and I think they see all the things that we see. This place is underexplored. It's in a great district, tremendous opportunity, and it's just ripe for more and more discoveries.
And so I think we have a graph we can put up, but could you provide an overview of the current property portfolio out in the Yukon for white gold?
Yeah, for sure. So we're about 350,000 hectares. Our portfolio stretches about 120 kilometers from Dawson City down to the coffee project, which I just mentioned. Newmont is moving through permitting. Part of what's also really exciting is a road is being built from Dawson down to the coffee project as part of that permitting and mine plan. What does that do for us? That basically puts a road right through our entire land package, making it now driving accessible. And that is such a huge value unlocker, because now, like any major mining camp in the world, Timmins, Nevada, Quebec, if you can find something that you can put on a road, it doesn't have to be a 2 million ounce discovery. You find 3, 4, 500,000 ounces, you truck it to whatever the nearest mill is. And in this district, we're in the process of having these mills being built. You have coffee that's got their heap leach project. Our Golden Saddle is going to be a traditional mill. So now anything we find is going to be able to be economic, we think. And that is the real opportunity. So we truly see this as being able to be a project generator for literally decades to come, considering what we've seen and now what we're seeing with the drilling. Like, we've done all the preliminary work. We're in the drilling phase now. We're making new discoveries. Just a year and a half ago, we announced a discovery on our Betty property. This is right beside Newmont's coffee deposit. We drilled 3.5 grams of 50 plus meters from surface. That is a world-class hole, bar none. We drilled it a little bit more this year. We had more high grades over exceptional widths, and it's right beside, it's on the same fault system that hosts this Coffee Creek deposit. It's contiguous to Western Copper and Gold's huge porphyry. This is elephant country. The best place to find gold or copper is here where there's already been gold and copper found, and we are sort of right in the heart of that. And this is at a totally different project from where we have our big deposit already that's continuing to grow. We've also had some great success on this year.
And speaking of drilling programs, can you just walk us through what your drilling programs are planned out for 2023 and maybe targets of interest?
Yeah, for sure. So we're still in the final phases of planning out our 2023 program, but at a high level, what we're going to be doing, this Betty discovery we made a couple of years ago, this is what's gotten the market kind of very excited. We definitely need to do more work there. These sort of high grade, good tenor type discoveries are really exciting. You're able to build ounces really fast. So we'll definitely be focusing on that. We've discovered a new trend beside our existing flagship deposit. Last year, we had some tremendous results on that on our Ryan Surprise. We think the ability for new zones and mineralization near our flagship deposits can significantly increase our ounce count. We actually have a resource update coming the next few weeks. I think that's something very exciting to look forward to. So a lot of interest in working there more. And we still have these incredible targets that have never seen a drill hole. If you can imagine our Nolan property, which is actually road accessible just west of Dawson, it's sitting on a major fault system. It's in a prolific placer camp where there's been hundreds of thousands of ounces of gold found right on surface. It's got a 2-kilometer long geochemical soil anomaly, just like these other discoveries, sitting right on top of that fault. and has never seen a drill hole. So we're really itching to drill that as well this year.
Dave, thank you. And last question: among your peers, White Gold trades at a discounted valuation versus peers. We can put that image up. What would be, among your peers, which companies would be the best comps by jurisdiction and type? Maybe you can talk us through that. And
Yeah, it's funny, and this is kind of not great for us, but this is why we're trying to do these types of conferences and get the word out there. I think part of the issue is have been very tightly held, like between Kinross, Agnico, management, like the Power One Group, Shawn Ryan. We probably hold half the company, and 2 or 3 years ago it was probably 70% of the company. So the story is not well known. We're going out there to tell the story. We are covered by Stifel. They have a 250 or 245 target on us. We're trading in the low 40s right now. So I think the opportunity from a risk reward perspective is tremendous. I think if you look at some of these other companies with sizable ounce counts, like Sino, although that's in Namibia, but Namibia is a great mining jurisdiction. These companies all have 150 plus type market caps, and I think there's no reason why White Gold can't be in that sort of realm with only what we have now, right? Like part of the double-edged sword of having too much going on is you don't get the full value of everything. So, we need to start to monetize some of these assets, pay the shareholders, and then reinvest that capital to make more of these discoveries.
Dave, can't thank you enough. Incredible overview of White Gold. We're sending Margo up to the Yukon to verify all facts that we can see gold coming out of the ground, and we're going to send her panning. We're going to send her panning.
We'll have it set up. You will find gold yourself. There's that much gold up there. It's crazy.
We're looking forward to it, Dave. Thank you very much.
Thank you.
Thank you. That was
Thanks,
Dave
guys.
D'Onofrio from White Gold. The Grizzle Commodity Con train keeps going. We got a very unique story coming up next. Enviro Gold. Stay tuned for that. And if you are following the Grizzle, please hit that the thumbs up on YouTube. The algorithm likes that kind of stuff. And the retweet and the likes. We'll see you back in a sec.
All right, everybody, welcome back to Grizzle Commodity Con. We have a very special speaker on. He's working on a potential process that may kind of revolutionize how the mining industry works. So we're very excited to talk to Dr. Mark Thorpe. He's CEO and director of Enviro Gold. Welcome.
Thank you so much. Pleasure to be here.
So why don't you kick it off, Margo?
Yes, Mark, thank you for joining us. And as Scott alluded to, you have an extremely unique business model among our commodity speakers today. For anyone listening who doesn't know what you are building, please give us a brief overview of Enviro Gold.
Sure, it'd be my pleasure. We're a tech company, and we have developed, by putting together a series of existing processes, a technology to recover critical, strategic, and precious metals from complex tailings. More specifically, we're aiming at VMS tailings, and we're very excited to be progressing with our first project.
Perfect. And maybe we can put up a slide that shows the type of technology you use. Could you tell us the history of Enviro Gold's technology and your work on mining sustainability? What does your technology do that hasn't been done before? And are you comfortable with your patent protection, or do you plan to file more patents as you scale the technology?
Yeah, that's great. Thank you. Well, our technology is an acid leach The difference from the previous technology that was used is we're operating at atmospheric pressure and at about 85 Celsius. So it's a low pressure, relatively low temperature leach. We've been able to recover gold and silver and copper and zinc from tailings where it was unable to be done before. And as part of our process, we actually then are able to reduce the environmental liability of these wastes moving forward. We're very happy with our patent filings so far. We've got a suite of 22 patents plus the patents that we've filed related to the acid leach technology. And we plan on filing more patents as we continue to develop the new technology to actually recover some of the other base metals that we're looking for.
Got it. Okay. Now, a few weeks ago, you announced an important preliminary test result that had 75 to 90% recovery rates of various precious and battery metals, not to mention an expected net present value of 144 million Canadian, and that was at 1650 gold, I believe, compared to your market cap is somewhere around 42. It was 42 when I looked the other day, million. So that's pretty big difference there, a gap. What did the report tell you, and what are the key next steps for you?
So really the key piece for us from this work that we're doing with the ALS laboratory in Perth, Australia, is it confirms the work that we've done at the Tingalpa laboratory and with Core Resources. Core Resources Lab worked with us for about a year and a half to further the approach here. We validated this independently, and we're moving on now to the next stages of the pre-pilot plant testing, which in the next few weeks will result in us starting the pilot plant for the recovery of the base metals and the gold and silver from the Helia tailings.
So what's kind of the timeline on that? You said you're moving to the next. How long would that process ideally take for you? And then what would we look for after that?
So we're working to update the technical report in Q2 this year, which will be the catalyst to then move on and complete the definitive feasibility study. This is all really exciting stuff because we're a very fast to market project. We get the tailings, we can be back, we can be in production 18 months to 2 years after we start the project. So it's a quick to market story. The tailings are there on the surface usually. Either that or they're live tailings coming out of an existing facility. So we can actually do the analysis. We've got great records. We don't need to drill in very much. We can do a little bit of sampling in the tailings storage facility to know exactly what's there. Why? Because the metallurgical manager is paid upon the tailings that go, knowing what goes out to the tailings storage facility. So there's a huge record. Daily sampling. On the Helia project, we've got about 4.5 million ton bulk sample. So it's really exciting, really very, very fast to get us to market and cash production.
Got it. Yeah. So the market opportunity is huge here. And so, and you've said in your deck that you believe you have at least a $5 billion pipeline of conversations you're having. Could you just tell us about your commercial team and their industry experience? Because I'm sure that's important to get the word out on this technology you have, because it can be used by so many different miners.
Yeah, our team is a small team. We've got 8 people working with me. In that 8 people, we've got over 300 years of experience. Sounds scary, but most of us are slightly more than 50 and working for it. Our technology team, Sergio De Giovannis and Brock Hill, fantastic group of people. They've done stuff around the world. They're operators, so they know what they're doing. This is not theory. This is operation. I've been in the ESG space for over 30 years on 40 countries on 4 continents. So the team is phenomenal. John Walsh and David Cam have financed and brought in money for projects. David sold his previous company to Caterpillar. So the team focused on execution and focused on securing the financing that we need for the construction.
As you look, say you've proved out the technology and you can deploy it when you need to, take us through the process of you've signed a contract with a company. What's the timeline? What has to happen from the ink is dry to when you could be, say, on site processing tailings?
So the process is elegant in its simplicity. The first thing that we do is we get tailing samples into the lab, and we run a series of samples on the acid digest to make sure that the acid releases all the required precious metals into the sludge, and it brings the critical metals such as copper and zinc into the acid. We then separate that out, recover the base metals from the acid, and recover the gold and the silver from the sludge. That validation of that process takes about 6 months, which would result in both a PEA and then an update to the PEA. We would then probably spend 6 months getting to DFS, and then we would start the construction phase. Implementation on the construction phase, 6 to 9 months. So as I mentioned, between 18 months and 2 years, and we're actually processing material.
Got it. That's really helpful. So one last one for me. As I understand it, you have two business models that you're looking to sign with customers: profit sharing from a modular plant, or just technology licensing. They take your technology, they pay you a cut. Can you briefly talk about how each would work? And if you had a perfect world, you could pick whichever contract you wanted, which one would you prefer?
Well, the opportunities are such that the technology application for us is we split the free cash flow with the owners. The tailings that we're looking at are essentially a waste. So it's part of the circular economy, which is really nice. We can then recover the gold and the silver and the base metals, and then we split the free cash flow with the owner. The other model is a licensing model where we would run the first stages of testing in the technology, run it up to DFS, and then the owner would then build and install the plant. For us, I mean, ideally, we would like to do the licensing model. However, we recognize the stage of the company that we're at right now, and we need to go ahead and build one or two of these plants to validate everything, because there's always an naysayer. And what we've found is that the work we're doing at ALS is right on point. Our team has predicted exactly what's going to happen, and like we said in our last press release, that's exactly what happened. So once we get the pilot plant up and operating, we'll be very pleased to update that technical report and then move on to the next stage of the project.
Okay, so you think there's an opportunity, you have to build the plant, prove it out, but once you've done that, you think that people might be more amenable, where you could shift towards that kind of capital light model of licensing?
That's the model that actually Glencore is using for the Albion process. The Albion process was worked at the same location in the core lab that we worked in. They proved up that it's a higher pressure, slower timeline process to work on similar material to ours. Ours is quicker and more elegant as a solution. So we believe that we can prove it up exactly the way that Glencore did, and then license out the technology in the same way that Glencore is doing it.
Yeah, great.
And just maybe wrapping up here, could you maybe tell us what milestones we should be watching for from EnviroGold this year? I think we have a 2023 catalyst chart we can throw up for our audience.
Yeah, we're very pleased that we were able to raise some money in the in a difficult market, shall we say. The lab scale testing program is on. We've got the independent pilot plant going on at ALS in Perth. We'll get that those results in Q2, which then go into the update to the technical report, which will be published. Then we will start with Sedgman Engineering to complete the DFS, and then we'll start the construction as soon as the DFS is complete. So we're very, very excited on all of the catalysts. It's quite quick. In parallel to this, obviously, we're working with other potential partners. So we're working to get some other projects signed up so that we can apply our technology across. And we're looking at some of the other opportunities with larger companies, shall we say, to look at some of the bigger opportunities that they have available. So we're very pleased with the way that things are working, and we think it's a great story, and it's a great time to follow EnviroGold.
Well, Mark, we love interviewing companies across the value chain, and you guys are a unique one there with your technology. Looks like it has a lot of promise. So we'll definitely be following you closely as you go through the year, some important milestones for you. So for everyone listening, that was Mark Thorpe. He's the founder, CEO of Enviro Gold.
Thank you so much. Real pleasure to be here.
All right, take care. All right, Commodity Con, let's go. It may be afternoon, but we're not stopping. So we have some great guests coming up, including anyone from Twitter watching, someone you're going to know very well. So don't go anywhere. We'll be right back.
Your voice, it echoes in my mind. Voice, it echoes in my mind.
Welcome back, Grizzle Commodity Con. The trade keeps going. On a good day for precious metals, we are very fortunate to have Galen McNamara, a CEO of Summa Silver, join us. Thank you so much. And a partner of Grizzle Commodity Con. Wouldn't be possible without Galen. Thank you so much. I appreciate it.
Great. Thanks for having me on the show, guys, and great to be here. I hear it's going great so far, so really good to hear.
It's been an incredible day. We had White Gold on. You said, you picked a great day. You guys, when gold's going to crack through all-time highs. I go, you know what? That's the kind of foresight you need to do this stuff. You need to look out.
3 months out, we were like, I think it's time. Let's do it.
So
Great. Looks good.
As everyone knows, gold's nice, but silver's better if you want that torque, right?
Yeah, you know what? That's what it's been like historically, and seems to be that in almost every bull market. Silver wants to outperform gold substantially. That's just such a small market, and there's just so few names that you just can get really, really torqued.
Yeah.
All right. Why don't we kick it off for anyone who doesn't know your company? Can you just give a brief overview of Summa Silver, your assets, and your strategy?
Sure, sounds good. So Summa Silver is a company that's now about 3 years old, give or take. It's a company that I founded with the idea of going into these historic mining districts in the United States that were like totally famous back in their time, these Wild West places in the 18 and 1900s, and just haven't seen much modern exploration. Because whenever you go into these places, and I'm a geologist, when you find that you do the modern work, there's always these new targets. Everyone's probably heard the saying, the best place to find a new mine is next to the old mine, right? And that's totally true. And really, the best analogy I can give you guys is that, it's like kind of going back in time with modern weapons. They just didn't have the same tools that that we have now. They did very good work, and we have to stand on the shoulders of the people that came before us. But they just didn't have the same tools that we have now. So, for us, what I really like to highlight is that in our opinions and as technical people, that these are really the two best high grade properties in the United States. And, hey, putting our money where our mouths are, the results so far have been very, very strong and lots more coming.
Great. Good. Thanks for that intro. So you believe the Mogollon district in New Mexico could be one of the great remaining vein fields left in the United States. Could you tell us the history of the asset and what you see there that's getting you so excited?
Yeah, you know what? That's a bold statement for me to make, isn't it? And I remember kind of reflecting on that one in the past few weeks, and we just did a meeting with all of our technical people a couple weeks ago, and I kind of put that question to the team as well, and all I got were nods all around the table, and really, I'll give you the background, and the reason is that this is the largest historic silver producing district in New Mexico. Produced something like 16 million ounces of silver and 340,000 ounces of gold. That sounds like it's all good, but even a little bit more perspective, it produced between the 1880s and 1942, and production only shut down in 1942 because that's when the U.S. went into World War II. So that's when all silver and gold mining stopped there, stopped in the country by law, basically. They wanted all the guys to go do stuff that would help in the war effort, and which was fair enough. So between then and the 1970s, not too much happened in this district. Around that time, people were really looking for the open pittable gold deposits, the stuff we call low grade now, the open pittable gold deposits, the open pittable copper deposits, and not much love was put into these old districts. But more recently, with the return of companies like Silvercrest and now Vizsla and several others in Mexico, who have really proved this thesis that these old districts can have a lot left in them. It's not like we need to reinvent the wheel here. And, let's not forget that, Mexico is great and all, but these are U.S. assets. And there's really is a new developing theme about these metals that are critical to our economic development, like silver is. Having them domestic sources of these things is very, very important. So that's where we're at today. We've drilled something like 19 holes there now. Holes still. Yeah. So very.
Galen, we're losing you a bit. Can you hear us all right now?
I know. I don't know what's going on here. I apologize, guys. Yeah, I can.
You sound like you're good right now. Why don't you just back up about 5 seconds? Keep on going.
Sounds good. So, because of those reasons, and it's got great numbers on it already. We're really just starting to scratch the surface there, and that drilling is just getting started. There's a lot of potential that we're going to need a long time to drill out. Because of that, and because of the history, that we just see the potential here is very, very strong, and our guys are just really, really excited, and I am as well, to keep going on exploration.
Gotcha. Now, just looking more specifically at your drill plan for this asset, what are your target areas for 2023? I think we have a map we'll show that shows all the different areas you could be drilling. And what additional information would you like to have by the end of the campaign?
Sure. So yeah, this is a really good map in that if we look near the center of it, there is a green rectangle. That's about 500 meters of vein that we're just drilling out in this past year, give or take. But then all of the red lines on there are the rest of the veins and structures on the project. So there's something like 50 kilometers of vein on the project. So we drilled half a kilometer of that. There's 50 kilometers of vein on the project. I mean, you're potentially you're really only scratching the surface there. So one of the things that we did last summer was we went out and sampled all the veins at surface. Is there any good mineralization left at surface here? And it turns out there really is. If we can, I don't need to read out all these numbers, but you're getting anywhere from a few hundred grams per ton silver equivalent to 4,000 grams per ton silver equivalent still at surface over an area of about 2.5 kilometers by 2.5 kilometers. So with that, those are the areas that we really want to go in and drill when we get back here in the fall. There'll be 4 or 5 target areas that we're developing now that are going to give a few of these a real shot at saying, hey, what's left at this? And let's not forget, we've been very successful just on the first target area. So we're pretty optimistic about what's coming here, guys.
Great. Yeah, that's a very helpful chart. So related to this project, to stay on it, you're in the process of earning your 75% stake. Can you just update us on your ownership currently and what payments and work commitments are left to get to that full 75%?
Yeah, so actually 75% is just the first part of it. After that, well, at our election, we can go up to 100%, which is what we will do by the end of this year. And the nice thing about that is that all of the payments remaining, or everything except a very small amount, is in stock. So we owe something like $4.65 million on it to get to 100% remaining. But basically all of that is in stock. So that's a nice position to be in, and that, yeah, we have $11 million in working cap now, and that there's not a big hit to our cash position coming, and that we can get to that 100%, using our stock and just put the money into the ground. And the nice thing about our partner on this, the company that we're auctioning off of, Allegiant Gold, they believe in this project just as much as we do. They see the potential as well, and they've been great partners. They've been great partners to have, and they've been very supportive of the project and the stock. So we're building a partnership here where we, by the end of this year, will have 100% of this project.
Oh, great. Okay, so from that chart, it looks like you've worked through a lot of those commitments. You're basically almost done.
Yeah.
Okay, great.
We have, exactly. We worked through a lot of the commitments, exactly.
Now, can you tell us about the infrastructure near your mines? I know this is going to be an easy conversation compared to if you're off in the Yukon or something like that. So is all the needed infrastructure available except what you would have to build to specifically start processing gold and silver?
Yeah, more or less, especially in a place like Nevada where the project is like literally right on two highways, right adjacent to two highways in a mining town that has, been mining going back to 1903. For sure that infrastructure is there. And then in New Mexico, you can drive right to the project. And I've worked in some, it's a little more remote, don't get me wrong, but I've worked in some really remote places where, it's helicopters all over the place, and you're in, in northern Canada somewhere, and there's no roads or no anything like that. Right? So that's another nice place. The nice feature about working in the United States is that oftentimes the access and the infrastructure is already very good.
Yes, that's not a huge concern when you're looking at the economics of projects.
No, exactly. It's one of the advantages of these projects is their locations.
Got it. Now, I wanted to move to your Hughes project. Kind of what are you hoping to find there? And can you take us through, I'll put up another slide that compares I guess, is it Tonopah? How do you pronounce that?
Yeah, that's right. Yeah.
Okay, got it. All right. Comparing the Tonopah district in Nevada to other prolific districts with similar geology. Oh, did we lose him?
Oh no.
Here, can we cut this slide?
Guys, I think I just lost you there for a second. You know what? I apologize. I've never had this problem before, and I'm pretty embarrassed.
No worries. That's how live shows go. It only pops up now.
Right?
I was out of the chat here, and now I'm back, so I apologize for that. But we were talking about Tonopah, and you were showing a slide.
Did you catch my full question there?
I did. Yeah, I did.
Okay. All right. Great. Go ahead.
Yeah. So, speaking of Tonopah, and this is the project that I was, very interested in, and in early 2020, late 2019, and I thought to myself, okay, well, if we're gonna build a company around this project, how does it compare to some of the famous Mexican districts that the Spanish have been mining going back 500 years? We take Tonopah, and I've got a chart there in the upper half of the slide where the mined length, the strike length, is 4 kilometers. And the district historically produced 175 million ounces of silver and 1.9 million ounces of gold at grades of like 1,200 grams per ton, by the way, silver equivalent. Well, comparing that to the Mexican districts or the Comstock in Nevada, the Guanajuatos or the San Dimasas or the Pachucas of the world, there's a lot more strike length there, 18 kilometers, 7.5 kilometers. And of course, many more ounces produced, over 1 billion ounces in a couple of these districts. Well, that just makes sense if we think about that intuitively. So moving to the bottom part of this slide here, well, the length of those white bars is the mined length for each of these districts. So you take Tonopah and, that many ounces over 4 kilometers. Well, we've now stepped out significantly from Tonopah to the east, about 1.3 kilometers. And we've hit some really interesting mineralization. Like the highlight is about 500 grams per ton silver equivalent over 2 meters, with a high grade kicker in there of about, like I've got listed here, 1,400 grams per ton silver equivalent over half a meter. Well, if you take that strike length, step out that 1.3 kilometers where we've started to hit at what we call our Ruby discovery, and even let it run, well, it fits in quite nicely with how big these districts can get when they get to be truly world class. And it was that realization that was an aha moment for me. And I actually got on a plane and went down there and staked claims myself, and stayed there for a few days and put a bunch of posts in the ground. So that's for me the big picture part of Tonopah. And this is the area we're going to be starting to drill here in about 3 or 4 weeks from now. We're going to be expanding from the mineralization that we've already intersected at Ruby in this area, and testing several more really high conviction, high priority exploration targets to see if we can't really take a big swing and hopefully hit a home run.
I love that chart. I've never seen it put that way. It's just very easy to visualize where these other like geologic trends, what they look like, and then how underexplored potentially where you're looking is.
Yeah, well, exactly. Sometimes, as geologists and I obviously exploration, I've been doing it for 15 years now. Sometimes the best thing to do is to just keep it simple.
I like it. Yeah. Now, you were talking about it. You have a lot of things going on. So I wanted to kind of jump to the next important milestones and catalysts. For investors watching, they're always like, all right, I'm following you, but what do I look for? How do I know when something comes out? Oh, this is important or it's not. So what are kind of the most important milestones and catalysts that will be coming from you guys next, 12, 24 months we should be watching?
Yeah, you know what? For us, I think, one of the main separators for us, and, everybody talks about management and projects, and that's great. But I mean, for us, we're very well financed in that we've got $11 million in working capital. We've got 2 of the best high grade silver exploration opportunities, certainly in the US, and I think potentially in the world. And we're going to be drilling both of these properties out, in ways, stepping out from where we already know there's high grade mineralization, in places that have produced prolific high grade mineralization before that haven't seen any modern exploration. So for us, it's basically really like we're going to drill as many holes as we can. License to drill is a cliche I'll use, and communicate to the market what I think are going to be some very positive, high grade, strong drill results over the next year, while we push both of these projects towards mineral resources.
Galen, an absolute pleasure and a good, phenomenal overview. Now, what we will do, we got to do a Twitter Spaces. We did a great one that was last week with none other than Shawn, who was on earlier today. But you know what? It's very timely for us to dig deeper. Obviously, a great introduction to the company right now. But it would be great to do a Twitter Spaces with you. I
can tell also you have a gift for explaining that not everyone else has. So it would be great to put you in front of the Twitter audience, other investors who are interested in this space, because I'm sure you could teach them a lot.
Well, yeah, and the idea with that whole series is mining 101. So, just because I think there's so much still base level of understanding that we need to get to, that, there's much to learn.
Guys, I'd love to. Let's get something on the schedule sometime soon and get into it.
Appreciate it. Galen, thank you very much. That was Suma Silver. As we enter a gold, silver, all things in the ground commodity bull market. Very exciting. The Grizzle Commodity Con train just keeps going. It's been 10 a.m. nonstop.
We hope you guys are having a good time. You can tell we're having a good time. That's what we live for.
We're getting into the final stretch here. We got 2 more companies, then we got none other our good friend Tracy from Hill Tower Resource Advisors coming up to close the big show.
Shy girl.
Yeah, close the big show. So stay tuned. We'll be back in a couple minutes.
All right, Grizzle Commodity Con mixing it up a little bit, but we still got a really interesting guest here. We got John Pasalacqua. He's CEO of First Phosphate. Stand by. You're going to learn more about phosphate and how important it is to the battery industry and where things are going with electric vehicles. So, John, thanks for joining us.
Yeah, thank you, guys. Thanks for having us.
Thank you, John.
So first, just to kick it off at a high level, for anyone who doesn't know First Phosphate, could you give us a brief overview of the company?
Yeah, so First Phosphate is likely the only company in the world that is fully dedicated to extracting and purifying phosphate for the production of cathode powder for the lithium iron phosphate battery industry. Our plan is to integrate vertically from mine source all the way directly into the supply chains of North American LFP, that is lithium iron phosphate battery producers that require material that emanates from an ESG-driven, consistent, and secure source within North America.
Great, that's helpful. So when it comes to mining for phosphate, why are igneous deposits so desirable? And I'll throw up a chart while you're talking to that.
Yeah, sure. So, in the world of phosphate, 95% of the world's phosphate is sedimentary deposit. And sedimentary deposit is good for making fertilizers. But at a certain point, it doesn't have the capacity. It's got the heavy metals inside of it that you cannot make a large amount of purified phosphoric acid from it, because inside of the battery is purified phosphoric acid that needs to go into the battery. Igneous rock is very rare. It's like volcanic rock, and it's only 5% of the world's phosphate. And furthermore, 1% of the world's phosphate is igneous anorthosite rock, which comes from Quebec. And the Quebec rock is the purest form out there. And you can purify that with, our partners Prayon, who have a special technology that they've been practicing for 70 years on the purification of phosphoric acid. And we can convert 90% of that into purified phosphoric acid. So whereas sedimentary deposits, only 10% of it can be around 10% can be converted into purified phosphoric acid. With sedimentary rock from Quebec that we own, and with our technology partners Prayon, we can get 90% of it to purified phosphoric acid. And that's big because it allows us to focus entirely on the lithium iron phosphate battery industry. And we're a technology provider of, technological material and not fertilizer.
Gotcha. So from a purity perspective, you're in kind of the perfect area code.
Correct.
Got it.
Good way of putting it. I like the area code analogy.
Thank you.
418.
Right.
So can you tell us a little more about lithium iron phosphate batteries? What demand trends are you seeing with that battery chemistry, and what are the benefits of LFP, as it's called, versus other battery chemistries?
Yeah, so I view all the batteries as complementary. Every single battery chemistry has got its own use. We know the nickel, manganese, and cobalt batteries as they are, and they still lead the market. But the LFP battery is really coming up and really occupying a space for itself within what are sort of the low to mid end vehicles, because it's a cheaper technology. It's got good fire safety. It's very low cost, and it's also got really good stability. And also the sourcing of the materials doesn't have ethical concerns, and the materials are relatively easier to source than others. And because of all of those factors, it really gets to a point where the auto manufacturers are starting to compete on it. If you look at what Tesla's done, now it's going into most of Tesla's new vehicles. It's going into their trucks, and they're driving down the prices in the industry, and they're forcing mass adoption from it. So we look at the lithium iron phosphate battery, and everybody really needs to wake up to this. It's becoming the battery of mass adoption. It's not going to become your battery for the ultra high end uses. We'll always have NMC for that, and in that way, NMC and LFP are very complementary. But what is in the smaller vehicles, the vehicles that get us into the city, drive our kids to school, go to work, go shopping, do all that other stuff, the LFP battery is perfect, and it's really occupying a very important niche, and it's actually helping mass adoption to take off for all of electrification. So a very important role for LFP battery.
Okay, that's interesting. Could I ask, I'm curious, you have all these different components to add up to the total cost of a battery. Do you know how much phosphate is as a percentage of your total battery? If it's like a $20,000 battery, how much is phosphate?
Yeah, so I'll talk to you just in percentages. That might be a little bit easier.
Sure.
And please be aware that every single battery and every single manufacturer has different specifications. So what I'm going to tell you is just very generically here, right?
Yep.
So in a lithium iron phosphate battery, for instance, the phosphate will occupy maybe 20% of the cost of the battery. The iron sulfate probably 15%. The lithium, again, as we know, lithium's been a bit of a yo-yo ride, but about 40% of the battery cost. And then, energy to make the battery about 15%, and then labor is probably about another 10%. And that gets you, really rough approximation of what the components are of making a lithium iron phosphate battery.
So that's important for us because obviously the higher the cost, the more incentive there is to replace that. And so for phosphate to be lower than lithium, that means, it's important part, but it's not a game changer. If it, doubles in price, it's still an important part of the battery.
Yeah, so basically what you're doing is you're kind of swapping out the nickel, the manganese, and the cobalt for iron and phosphate. So that's where your cost savings are. Those are two relatively cheaper materials out there. Even though they come in different forms, you got to get the phosphate up to phosphoric acid, purified phosphoric acid, which is difficult. It requires purification, and you need to get the iron sulfate up to iron sulfate, which makes the iron, which is not that plentiful in North America. So there are logistical challenges around it, and also the purified phosphoric acid itself is in great demand. And unless we bring on the capacity, like First Phosphate is planning to do, that's going to shoot up like a hockey stick, just like the price of lithium has.
Interesting. So you received some promising metallurgical test results on the mineralization sourced from your property. What were the results and what did they tell you?
Yeah, so the results are great, because the phosphate is so pure and it doesn't have, it's got very low sulfur content in there, which is really important in mining for the environmental aspect. It's got low radioactivity in it, and it's got low amount of trace elements. We're able to basically purify our phosphate up to, 40 and a quarter percent, which really is about, 95% purity inside of what is, apatite, which is the host mineral for the phosphate. So, we're almost at, pure phosphate, which allows us to make a high quantity of purified phosphoric acid. But it also means that when we're purifying the phosphate into phosphoric acid, you use sulfuric acid to do that, and that creates gypsum. The gypsum that we're creating is actually going to be able to be recycled, and you'll be able to recycle that into plaster. So that's really important for the standpoint of circular economy. Not only do we achieve a high amount of purified phosphoric acid, a clean tech sort of solution, but we're also, into full circular economy, which is really important when you're making a battery. Because, if you look at these batteries right now and, where they're coming from China, no one's looking deep enough. But if you really had to look into it, you really wonder if it's really worth to be driving that electric car in the first place. I mean, does it make any sense that we're electrifying our transportation to save the world, and then we're polluting the world to make the battery? It's illogical. You've got to make the battery clean. The whole process has got to be clean. It's got to be ethical. It's got to be, respectful of the new ideals of society. And you've got to follow that right through the whole cycle. You just can't import it from China anymore. So what we've got to do here is we've got to take our industry back to North America, and we've got to do it properly and clean, just like First Phosphate is proposing. And that would be, a full solution for North America for the battery and for everything.
Great. Thank you. That was helpful. Now, I wanted to just talk about what the state of phosphate production infrastructure looks like in North America today. Is phosphate currently produced at scale outside of Quebec?
Yeah, so right now there is no production of phosphate in Canada. There were some mines, they were shut down. Right now, phosphate, you only find it really in two regions of North America. You find it sort of in the North Carolina, South Carolina, Florida basin, and that's mostly run by two companies. That's Nutrien and Mosaic. That's mostly dedicated towards fertilizer. That's the only place where there's a little bit of production of purified phosphoric acid, which is at capacity and cannot be expanded, and that's by Nutrien. Those mines that are in that area, some of them are completely depleted, and the rest arguably have between 10 to 30 years of life left. The amount of phosphate rock produced in North America over the last 20 to 30 years is in decline. It's in bad decline. There's also some rock in Idaho, Wyoming area. Again, sedimentary rock, just like the rock in North Carolina and South Carolina, and it's all dedicated towards fertilizer for food. It's already all at capacity, and there are no other reserves or even no reserves in the horizon anywhere in North America, other than a few smaller deposits, but especially what we have here in Saguenay-Lac-Saint-Jean, Quebec, and the entire district that First Phosphate has locked up.
So I see why you're doing this. There's a lack of supply. You have very pure supply that you've found, and there's kind of exploding demand locally. So it makes sense.
Yes.
Got it. All right. Let me end off with, I want to hear about next important milestones and catalysts, because a lot of people, they watch us and they're like, this is interesting information, but I don't really know what to watch for to come next to say these guys are executing on what's going on. Tell us kind of what you're working on and what we should be watching for.
Yeah, so obviously, we're a public company. We're traded under the ticker PHOS, PHOS. So I have to be careful about my disclosures. But in general, what we've already been putting out there in the market is, we're working on our beneficiation plant, which is a pilot plant to produce phosphate concentrate. So when you take concentrate out of the ground, and like you were asking us about our mineralogy just a second ago, and we concentrate that ore from the ground into what's called phosphate concentrate. So we've done that process in the lab. Now we have to create a pilot plant to make that process happen on a larger scale, so that it gives us enough of a sample to then send to our partners to create purified phosphoric acid for us. And then that purified phosphoric acid will eventually go into making LFP cathode active material on a very small scale, and it will create a powder that will go into the lithium iron phosphate battery cells. So that's one of our big catalysts. Another catalyst is our main property, Lac L'Orignal. It has a 43101 report on it. We've started our PEA, preliminary economic evaluation, that sort of gets around the whole logistics of the mine, the first level of it. That should be out by the year end. And, the other deposit that we're working on, Bégin-la-Marche, which, is 75 kilometers from the deep sea port and shows the highest grades of phosphate ever found in the Saguenay-Lac-Saint-Jean area. We hope to continue to drill that into a world-class deposit, and to get that, hopefully as quickly as possible into PEA as well.
Well, this has been a very interesting kind of teach-in, understanding the area of the market, and it seems like you guys are going to be busy over the next year or two. So thank you so much for coming on. That's been John Pasalacqua, CEO of First Phosphate Corp.
Yeah, and thanks to Grizzle. I really love the energy. Thank you to you and your
John.
your
Thank
audience.
you. And yeah, John, and very unique as well. I know we've had a lot of unique battery chemistries today, and this is obviously one of them. We've talked about vanadium, early vanadium redox flow batteries, but I think that's the kind of interesting part about what we try to do is just try to bring insights into new angles that may not be so mainstream, but appreciate and help us understand where unique opportunities are. Appreciate that, John.
Well, great. Thank you very much, guys.
Thank you.
All right, take care. All right, Commodity Con.
It keeps going. So John was kind enough. We had a little. We had Dean Hanisch from Stria Lithium. I think he may try to join us from his phone. See, listen, we if people can't join in any way, shape, or form, we try to get them hooked into the.
We want them on. We want you to hear from these people. Yeah, we brought them on for a reason. So.
Yeah. So hopefully we can switch into Dean. Stay tuned for a second, and also we're closing it down with none other than Tracy, Shy Girl, Hill Tower Resource Advisors.
We'll be right back, everyone.
That's at 3:15, but we got Stria Lithium up next. Stay tuned.
voice.
Hey, there we go, Dean. It looks good. We have Dean Hanisch from Stria Lithium. Glad we could get you on. I'm glad we can make the technology work. Listen, laptop doesn't. The phone is always there. Dean, how are you?
I'm very good. Thanks very much, and thanks for having me.
Yeah, thank you.
So, Dean, let's kick it off as I've been doing. For anyone listening who doesn't know Stria Lithium, could you give us a brief overview of your assets?
Sure. So basically, we're located in the James Bay UHC region, where most of the lithium mines have been found. A lot of that going to go into production. So your Sayona, your critical lithium, Nemaska lithium. So we're in that James Bay area, very close to the road. We have a flagship project called the Pontax project, which is set up mainly with a large spodumene pegmatite that's outcropping. We've been putting drill holes in it. We've hit on most of the holes. We've hit mineralization. We've just finished a winter program that our partner has just completed. We're waiting on about 9,000 meters of drilling, about 32 holes of assays, and so far so good.
That's great. So can you maybe tell us why you believe Canada, especially Quebec, is the right address for lithium exploration?
Well, I think Canada, specifically Canada, North America, are important places and definitely going to be leaders. And I think part of that is the government has been excellent in their foresight with funding companies through both their the government with Inflation's Act from the United States, the Canadians as well with subsidies. So I think between the subsidies and the loans and the grants that provided, they've been bringing and attracting a lot of battery companies and battery plants here in Bécancour, Quebec. So I think everything's kind of coming in place to make Quebec really a world-class battery park technology center. That coupled with obviously flow through and other things. So it's a good mining-friendly jurisdiction historically.
Great. Yeah, I mean, we heard from Canada Nickel earlier, and they were saying it really sounds like Canada understands the opportunity for the resources they have in the ground, and they're starting to support the industry. So that's definitely that's good to see. Now, I wanted to move on to infrastructure, if I could.
Yeah. Yeah, I was just going to say, to add that to that as well, they also, one of the biggest things with mining historically has been the time it takes to permit. But you see that a number of mines have come into permit recently, and the Minister actually of Natural Resources at PDAC mentioned that they can no longer take 10 to 12 years to permit mines. So I think that's another big factor why I think it's going to help benefit Canada.
Interesting. So we know infrastructure is almost as important as the resource in the ground when it comes to mining. Can you tell us about the infrastructure situation near your mine? That map we threw up, it looks like there is a bunch of activity around there, but I'm interested.
Yeah, let's get that map back up while Dean talks.
Yeah.
Yeah, so I mean, specifically infrastructure for our project, I mean, we're 22 kilometers from the road. We have hydro going right through the plant. We're able to get hydro if we need as well from the Illinois mine. That's about 18 kilometers away. So, you know, location's important. Obviously, hydroelectricity in Quebec and in this region it's where it's created. It's the lowest hydroelectricity in North America. So that's another benefit. And then, you know, if you look at that map and see all those companies, it's a lithium belt, I would say, and you're going to find more lithium companies and funds there. And I think that, coupled with the fact that you have 4.7 billion being spent by the Quebec government to, you know, map out railroads and put in the proper infrastructure in those areas so that, you know, those minerals can be exploited as well as rail. So I think it's when you have government matching with lithium deposits being found, plus the processing plants and the rail systems being put in, I mean, these are the type of things that obviously help to move things forward in this region. I think it will definitely be, you know, I like to call Quebec Saudi Arabia of the next 30, 40 years.
I love it.
I love it.
Now, I wanted to talk about Cygnus Gold, Cygnus Metals. They have an option to acquire 70% of Stria. But as I understand it, they have to spend a certain amount of money on exploration to earn that interest. So where are they in their milestones and what's left?
Yeah, so with Cygnus, they in order to own 51%, they had to spend $4 million and give us $3 million. So they've given us 1 million so far, but they had up to 18 months to do it. And, you know, this was something that we signed up in September. And in Australian fashion, you know, highly aggressive, they blew through that already. So I think, you know, any day, you know, they should have spent that $4 million on the expenditures, and we should be looking for, you know, a $2 million check from them. But yeah, we're really pleased with how things went. I mean, they did 11,000 meters of drilling from December till now, so with about 9,000 meters that we're waiting on assays for.
Fantastic.
Great. So they've been a good partner so far.
Fantastic partner. I mean, you notice it, right? I mean, if you look at a lot of the lithium, it's the ASX companies and the Australian partners, your Patriots, your Winsomes. You know, these guys, they go out, they don't put one drill rig. You know, we had 3 drill rigs and they wanted more drill rigs. We just didn't have place for those people to stay. Otherwise, they would have put 4 or 5 drill rigs. So it's fantastic. It's the best way to go about it.
And Dean, just, you know, as we wrap, and we have an image for this with respect to news flow, what are the catalysts investors should be looking for with respect to Stria over the next 12 to 24 months?
Yeah, I mean, obviously you can't say everything, but we are looking aggressively for new projects. As far as their flagship project, Cygnus has said that they expect to have a resource sometime in June on the actual Pontac Central project, our project. So I think that's one of the things you can expect. Also, we have, like I said, 9,000 plus meters, 32 holes of assays to come in, which will be very interesting. And some of that is resource definition drilling and some outstepping drill holes. So I think you'll see, again, Cygnus continue to drill probably in July, August with some helicopter-borne drilling, and most likely we'll be building the same road again to put the drill rigs in for next year. And for us, we're going to look to strengthen up our board, and we'll be looking at some new projects and continuing, because we really believe that, you know, this is the future, and with the government support, both in legislative as well as supply, we feel that this is a win-win situation and a generational opportunity for us.
Great. Dean, thank you for a great quick overview. Obviously, we're going to be doing battery metals conferences in the future. Would love to we're in the near future, a couple months actually. So yeah, we look forward to a better internet connection and talking to you with you in more depth. That's Dean Hanish from Stria Lithium. Dean, thank you so much.
Thank you, Dean.
No, thank you guys.
Thank you. So guys, the show, man, since 10 a.m.
I can't believe it. I've learned so much. I hope you guys have too. That's the whole point of these commodity conferences, right?
Man.
I don't want to sit here and hear what I've heard 10 times before and what's consensus or what everyone knows, right? You got to dig down. You figure out where the opportunities are. That's what it's all about.
Exactly. So we've left a Grizzle family member. If you guys follow our very well attended and lively weekly Twitter Spaces.
When do we usually do that?
Every Friday, 12 o'clock or 1 o'clock, depending on the guest schedule.
Nice lunch hour. You can pop in.
Yeah,
hang out.
And Tracy's there. Joins us always, and we always join Tracy's Spaces. Shy Girl on Twitter. Hill Tower Resource Advisor. Stay tuned. We're gonna be with her in a matter of moments, guys. Stay tuned.
You're gonna want to watch this one. Don't go anywhere.
Tracy, how are you?
Hey guys, how are you?
Very good. Guys, for the Grizzle Commodity Con, one-on-one, the big show, the biggest show of the year, and it wouldn't be the greatest show on earth in commodities if we didn't end it with Tracy Shuchar. Thank you very much, Tracy. The Hill Tower Resource Advisors. Can't thank you enough. We got a crowd. Thank you, Tracy. Always good fun. Always a blast.
Always. Thank you for having me. I really appreciate it.
Thank you.
And I like that we're matching today. We're both wearing black dresses.
it's the black tie event.
Last night we were like, let's be twins.
Exactly.
Oh, well, save the best for last. Margo, hit it.
So, Tracy, you're a longtime commodity investor and are the CEO of your own research firm. Can you tell us more about your company and how you got involved in commodities in the first place?
Yeah, so we are a new boutique research firm, and we focus on natural resources, geopolitics, and investing. So we have all levels of research to suit retail, to hedge funds, to institutions, analyzing everything from the macro view of natural resources sector to geopolitical risk assessment for different countries. As far as natural resources are concerned, all the way down to analyzing individual companies. So we have something for everyone. On our team, I have a team of global analysts that cover every part of the world. So we are very excited we'll be launching in May. So.
Well, we look forward to that, and we're super excited. And I just want to pull up, I can't interview without pulling up some of your tweets, because you tweet a lot, and you tweet some fire graphs. So in the past, you talked about mining capex and about the lack of investment in exploration production for mining companies, saying it's similar to oil. Do you think this trend is about to reverse, or is there something else going on that's going to keep investment low and potentially support prices?
Yeah, I mean, absolutely not. Not even close. I think we're still just at the very beginning of this commodity super cycle. And if we just look at the metal industry, if we take EVs, for example, EVs are made with 6 times more minerals than an ICE vehicle. So just for example, a battery for one Tesla Model 3 is 56 kilograms of nickel, 7 kilograms of cobalt, 6.6 kilograms of manganese, 85 kilograms of copper, and 8 kilograms of lithium. So the IEA actually estimates that we're going to need a 40-fold increase in production in lithium and nickel, and 20 times as much in copper, graphite, and cobalt compared to 2020 levels. So there's just not enough projects in the pipeline. This literally means we need 300 more mines to meet just battery EV needs, not including solar, wind, charging stations, and battery storage. So physically, we don't have enough supply. Even if one wanted to start funneling money into projects right now, you still have at least a 10-year lead time when you're looking at, before you even get anything out of the ground, between permitting red tape plus lawsuits from environmental groups. So, I just think right now we're just starting the super cycle for metals.
Tracy, you raised a great point on that with respect to the red tape, right? A lot of people talk about the ESG around money going in, like capital flowing into these companies, but ESG is a two-sided coin, right? There's also the fact that it's the permitting side of ESG that I know we've talked about it extensively on our Twitter spaces, but that in a lot of ways is almost as formidable as the fact that this whole sector, this whole industry has been starved of capital.
Absolutely. And you have to take that account, especially when you're looking at a place like Europe, where they have their own IRA, Inflation Reduction Act. I forgot what it's called, but they have their own thing. They want 10% of those minerals mined in Europe. I mean, their permitting process is even longer than the United States. So it's going to be very difficult.
And so you cover a lot of commodities. Which ones are the most compelling to you right now? I know you recently tweeted a chart that highlighted a jump in copper material needed for use of EVs. Just which commodities are the most compelling to you right now?
Yeah, I mean, a copper, I've kind of been pounding on the table for that one for a couple of years now. I mean, inventories are decades low. There are not enough projects in the pipeline. We're going to need more copper by 2035 than we have mined in all of history up to now. But I think there's a couple others worth mentioning that maybe people aren't really looking at, and that would be aluminum. This market's already in tight supply. The Russian invasion of Ukraine has led to wide-ranging sanctions. In February of 2022, the EU enacted sanctions on Russian aluminum, but there was an exemption clause. So in the next 9 months, the US and Europe, both imports of Russian aluminum skyrocketed. Well, that just changed last month when the U.S. Put a 200 increase on tariffs on Russian aluminum, produced, smelted, or cast in Russia. And then right after, the London Metals Exchange swiftly followed up with its own ban on Russian metal being warranted in its U.S. Warehouses. So right now, demand has been kind of soft due to the decline in construction and automobile manufacturing in the EU. But taking into account this market is already in severe deficit, any improvement in demand will probably lead to far more reactive environment with prices and premiums vulnerable amid a very tight supply. And then one more.
Yeah, go ahead. Sorry, don't interrupt you.
One more. I think platinum is definitely worth looking at after 2 years of significant surplus in platinum. This market is supposed to move into a material deficit in 2023. We have automotive demand up for 2022 is up 12% year over year, and platinum demand was supported by an increase in production, especially with higher platinum carrying hybrid vehicles and an increase in China's new emission standard compliant heavy duty vehicles. And we've also continued to see a lot of switching from palladium to platinum as a substitution in gasoline vehicles because palladium's gotten so expensive. So I expect this to grow in 2023 and beyond. And also mining supplies can continue to be restricted by the electricity shortages in South Africa and sanctions related challenges in, of course, Russia. So I think that's also worth looking at.
Interesting, and I can't ask.
So I'm going to recap. Hold on, I'm going to recap. Okay. So copper, aluminum, I've written them down, and then platinum. Right, got it.
And platinum. And I could go into, there's a PMG technology, which is hydrogen related, which involves platinum. That really is supposed to take off. I don't want to go into the technicals of it because it's kind of technically oriented, but anyway, that industry is supposed to grow from 2024 out to 2040, and by then that'll account for 35% of the total annual supply of platinum. So we're very bullish on platinum going forward.
Great.
And we also can't interview you without asking you about your outlook on oil and gas. And I kind of want to merge it in with the energy transition. Some say that oil and gas will also do well in the energy transition because it will require a lot of energy to mine these rare earth metals. What's your outlook on that? Do you agree or?
Oh yeah, without a doubt. Mining, first of all, is super energy intensive. You're going to need a ton of diesel, heavy fuel oil, light fuel oil, and lubricants to get this out of the ground. Plus, all the fossil fuels needed to provide power to mining sites. And even renewables need fossil fuels. People forget that even wind turbines still need to be serviced with oil-based lubricants. And not to mention that solar panels, those photovoltaics that turn the sunlight into energy, are typically sandwiched between layers of copolymers, which are made out of ethylene, another petrochemical-derived oil and natural gas. So any way you look at it, I think going forward, you're still going to need a lot of oil and gas. no matter if we completely switched, which is impossible, to wind turbines and solar panels tomorrow, you're still going to need oil and gas for those to be created. So
absolutely.
And just switching over to the macro right now, what are the most important geopolitical risks you're keeping your eye on right now in commodities?
Well, obviously China for one, right? War with China for one. I mean, if something happens with Taiwan, this could have a huge impact on commodities, as China is the single largest producer and processor of the world rare earths, right? And all of these are needed to create all of these renewables, particularly solar panels. So should those be sanctioned, or should China choose to cut the West out of the supply? That could really throw a wrench into at least renewable goals. And also I always kind of Africa. A lot of mining happens in Africa, and and in some cases, in some very corrupt and politically unstable countries. So this is always a worry for both metals mining and oil and gas extraction.
And I wanted to ask you a question about Russia in terms of oil. Do you think Russia's supply will eventually get squeezed out of the market, or will they always find a way to sell to other buyers like China and India?
They will always find a way to market it, period. Sorry. And if you look at Iran, for example, which is the most sanctioned country in the world by the U.S. in terms of the length of sanctions and how many sanctions, and they still managed to get their oil to market via various shell companies. I mean, back in 2012, they were trading oil for gold with Turkey and to bypass SWIFT until they were caught by the international community. So there's always a way around sanctions. And we are also seeing a pickup for Russian crude and products in North Africa and even in the Middle East. UAE and Saudi Arabia are buying products from Russia on the cheap, then selling their own products and oil for higher prices. So largely the rest of the planet, unfortunately, doesn't really care about the West sanction, and that's just hard truth. And in an area where energy security is paramount, it's every country for themselves. And in reality, the West, I always want to bring this up. In reality, the West can't afford Russian oil and products to be totally taken off the market because gasoline prices and energy prices would skyrocket and gouge these economies. And politically, that's a terrible position for Western countries. So they have to walk a very fine line here. And this is why we haven't seen secondary sanctions on Russia, and why there is a price cap instead of a total ban internationally, even though price cap is useless. So that's one thing. That's why we haven't seen the U.S. Even harsher sanctions, because they really do need that oil on the market, so it would hurt their economies. And I would go even one step further to say, remember that Europe is still importing that gas, though very small amounts, and LNG from Russia. And we'd actually not be surprised if Europe at some point has to go back to Russian piped gas in larger amounts, because realize they're forcing their companies to cut consumption, and this is hurting their manufacturing and chemicals sector in particular, which are moving to China instead. And we just saw this with BASF and Mercedes in Germany, for example. And so and also for consumers, prices, although they've come down 85% from those summer of 2022 highs, realize that nat gas is still well above historical norms in the EU, and energy bills are still sky high there, which is not good for the economy.
Tracy, one thought on that, just that differential, so if I'm simplifying, right, you've got these Russian barrels going to emerging markets, if you will, right, that aren't, that are less, they're just not adhering to, this global sanction protocols. And then you have, then you have the developed markets, which obviously, have their oil. So I just think it's interesting. What will end up happening is you'll have maybe a higher price on the oil that comes to landed, developed regions, lower price for EM, but what it net does is actually increase overall demand of oil in a weird way, because where it's more sensitive, like in emerging markets, you're more price sensitive, so they should ultimately consume more. And in the West, it's such a essential that we'll all just consume the same no matter what the price, really.
Right.
And just lastly here, because we've covered the metals, we've covered oil. Now I just want to finish with your outlook on natural gas. It's down a lot from last fall. Are you optimistic that this coming winter, if we get normal weather, we should start to see higher prices again?
It's the $1 million question, isn't it? Actually, I do. I think Europe got very, very lucky this winter with weather, but we could start seeing summer consumption could kick up if we see excess heat, as we would need it for cooling as well. Next winter might not be as lucky. In addition, you have to remember they're not buying many long-term contracts because they still unrealistically believe that they can phase out fossil fuels by 2030. And now that the energy crisis has subsided, suddenly they're back on the green kick, right? They do have a few deals, long-term deals with the US and with Qatar, because Qatar said, we won't sell you any unless you sign a long-term contract. So this means they're going to the more expensive spot market. However, with a lot of those cargoes going now to Asia, with an uptick in Asia demand, then that means that any uptick in demand in Europe and needing to refill their storage means that they'll have them scrambling, and we could see another price war again.
Tracy, incredible. You just took us through the entire periodic table, every BTU. Tracy Schuchart, an absolute pleasure. As always, a member of the Grizzle family, really. It's always fun when we get together every week on Twitter Spaces. For those who are following us, and I think most do follow you, but if you don't, it's a must follow at Shy Girl on Twitter. But Tracy, I wanted to ask you, Hill Tower Resource Advisors, you just launched boutique advisory. Could you talk to if they wanted to find you? I know there's a Twitter handle as well, but maybe more details on what to expect in the coming weeks, months.
Yeah, absolutely. So our website should be up shortly within the next week. Right now, there's just a placeholder when you go click on it. But it will be up shortly. And then, they'll have a chance to meet the members of my team. Also, if you go on it's Hill Tower RA is our Twitter handle. If you go and I think my pin tweet, if you want to keep updated on what is going on, and how everything is going, you put your email in. We won't spam you. We'll just send you periodic emails about what is happening. But by May, we should be up running full bore.
Fantastic. And for those who don't know, Tracy does a weekly podcast, Drop the Mic. It's just been incredible. I think that just literally launched 2 weeks back, and we were fortunate enough to be a part of the first one, Scott and myself, and that was incredible. You know what? I think you'd planned
it for 2.5 hours. It was amazing.
You know what? That's the problem with good things. Nobody wants to. It just kept going. And then geopolitical experts came, and it was fantastic. Tracy, you are a gem of financial Twitter, and a core reason why everyone in Twitterland is fortunate enough to have great commodity insights. Can't thank you enough. So a couple things we have to do on the agenda. We definitely have to have you down here for the next PDAC mining conference.
Oh yes.
That's and then we got to find a nice destination for oil and gas, a nice one. Not a cold one, a nice one. Where we can have martinis and
find something like the Caribbean or something.
Yeah, that's exactly what I'm talking about. You know what I mean? Tax-free destination. You know what I mean? Lots of just a kind of nice. The exact vibe. We'll start to screen the universe for that. Tracy, thank you so much. Can't thank you enough for a phenomenal segment here to close off the largest conference we've done in the history of Grizzle, and it's Commodity 101. Thank you.
Thanks.
Thank you for letting me be part of it. Thank you.
Our pleasure.
And I'll see you on the Friday podcast, and of course you'll be back on mine.
Of course, and we'll be having a fancy drink at some oil and gas conference in the Caribbean.
I'm down.
Awesome.
Enjoy the weather in Florida.
Yeah. Oh, guys, thank you very much. That was Tracy Shukart from Hill Tower Resource Advisors. Whew, Margot, that was a day. That was
quite the day.
Well, so you know what? It would not be possible without our lead partners. Why don't we get that slide up there? Grizzle Commodity One-on-One, our lead partners. We kicked off the day with none other than the Green Chicken, Doomberg, the #1 Substack in finance. That's doomberg.substack.com. And then Sprott Asset Management, kings of physical commodities. Sprott Asset Management, you know where to find them. Goehring and Rozencwajg. Leigh put on a clinic today for natural gas. Please do follow them at gorozen.com, the original contrarian resource investors, and Hill Tower Resource Advisors. That was Tracy, boutique natural resource research firm. She holds it down on Twitter. The queen of resources on Twitter. You know where to find her at Shy Girl, CHIGRL. And then our companies. Margot, you want to kick that off?
Largo, yes, a leader in vanadium, a metal critical to the energy transition. Then we got Canada Nickel, developing the next generation of low-carbon nickel. Dolly Varden Silver, a precious metal leader in BC's prolific Golden Triangle. Amerigo, your copper leverage play with the compelling dividend yield.
And then going to Anfield Energy, a uranium leader in the U.S. nuclear renaissance. Grid Metals, Canada's next great lithium producer. Cerrado Gold, a low-cost producer with multi-million ounce potential. And lastly, but not least, Suma Silver, American Silver. There is no substitute. And then, of course, Grizzle Research and Quant on Substack. You can find us, your source for commodity insights and stock ideas. You can find us at grizzleresearch.substack.com. That is the show. We're gonna get a drink. It's the weather's gotten a little more tropical here, right?
The weather is beautiful. It feels like summer.
so yeah, you know what? We don't have to go to those fancy destinations. We got a patio waiting for us. We got to thank you everyone for joining us for 10 to I don't even know, like 8 hours of nonstop commodity entertainment. If you haven't already, please do. Margot does some incredible work. If you go back to our history of interviews that we've done on the YouTube channel, who did we just do, Margot? That was incredible.
Cuppy. Cupperman.
That's on the pin. You'll see it. That was incredible. Cuppy's a good friend of the Grizzle. And
Rory Johnston.
Rory Johnston talked about the OPEC. Guys, if it moves and it matters, we're there. Margot's covering it. Follow our YouTube for all of that. And obviously our Twitter handles. You can find Margot at Margot_Rubin on Twitter, myself, Thomas G_Grizzle, and Scott at Scott W_Grizzle. And the Grizzle masthead is at Grizzle Media on Twitter. And then obviously our Substack, grizzleresearch.substack.com, and obviously home is grizzle.com. So much, so little time, actually no 8 hours. It's over. Boom.
Have a great weekend, everyone.
Thank you very much.